Okay, good morning, ladies and gentlemen, and welcome. My name is Steve Torso. I'm the founder of Wholesale Investor and CapitalHQ. I'd like to officially welcome you to the CapitalHQ Investor Day. We only do this day once a year, and to me, some of the topics that we're going to be talking about today is different to what you'll normally find at our investor conferences. So if you think about, our journey over the last funny enough, October is always an interesting time for me. It's a bit of a reflection time because we actually launched Wholesale Investor in October 2008. And it's so funny, I only realized how old we are. It's like, do you know, as you get older, you only realize your age when it actually comes out of your mouth. It's the same other thing with a company when you think, wow, the amount of time we've been going. But when we launched, we actually saw, literally in 2008, we watched the Dow Jones crashing 18%. And over the last 15, 16 years, we've built our reputation around effectively the innovation space and then also in property and funds. What a lot of people don't know is since 2012, we've actually been hosting a yearly property and funds management showcase. Now, of course, this year we called it private credit because pretty much for the last 6 months, the AFR has been relentlessly selling the area of private credit. So we leaned into that as an area. But today is a bit different. Today is really around the direction of where we're taking our business, where we're taking CapitalHQ, and then also, we want to start providing. By the way, if you're outside, feel free to come in. There is some seats up the front and also in the middle. If people can move into the middle, that would be great, just to create some space on the side. And it's an important thing for us because, said throughout our history, we do our best to try and understand where the trends are going and then align what we're doing with those trends in advance. And likewise, the area of private credit became hot this year. We placed a focus on that, but going back to January, February 2023. And the simple reason was because of high interest rates. So to give you some sort of understanding of our history, we obviously did launch in 2008, 2012, and when we launched, we actually launched as a magazine. Does anyone remember the magazine out of curiosity? See, a few people have been around us for some time. So, and then 2012, we got rid of the magazine just because, we couldn't track anything. It was very difficult to see what was actually taking place with it, but it was a great branding tool actually at that time. And 2014, we started taking companies overseas, and that's when we really realized how much interest there was in Australian innovation overseas. But also, really this market started to become a lot more global in how it actually operated. So 2018, that was a pivotal year for me. And the reason was because we did so much in that year that it almost broke me, in the sense that we did 48 showcase events across 7 different countries, right, including the likes of Korea, Malaysia, Singapore, New York, London, etc. All the stuff that, I said, I haven't seen anyone else willing to take on their back is doing. And that is without government funding, all as a private company. And that really marked the change when we started going down. That's when we started building what has now become CapitalHQ. And every year, at the end of the year, I typically go and reflect on, what I think is coming down the pipeline. And so in my presentation that I'm going to give, I'm going to be going through what my perspective is and how we see things, because, to me, that really does align with what all of you are either thinking or looking at in this space. And it also addresses some of the undertones of conversations that I have with people on a day-to-day basis as well. So today we have got an incredible day lined up for you. To start with, a lot of these topics we're going to be talking about today cover areas that we haven't really covered before. For example, one of my favorite panel sessions that I can't wait for, and this is as a founder, and likewise I'd say this for you as an investor, is the one that Phoebe's hosting, where we've got Sam Riley, Kenneth Shaw, Peter Neal, and Rob Neely as well. That is all focused around exit. So every single one of those guys have actually built a business and then been able to exit. And I believe the majority have been for 9 figures plus and one for 8 figures. So that session is completely around the process of going from seed to scale to actual exit. Then we've got a session completely focused around debt solutions. We notice that a lot more companies are looking at debt solutions for their capital requirements as it's become harder from an equity side. So we've got a great session around that. And then also we've got a session called Inside the Buyer's Mind. And the reason for that is I noticed there's a great undertone of how many investors are either looking or investing into companies that are thinking about exits, or that are or founders that are actually looking to go through the exit process, or people looking to get involved more in the actual exit space. And then also we've got a session around, from an advisor's perspective, is how to create as much value as possible in going through an exit. So all the topics today, around the sort of normally would have and we do have that for one of our upcoming events for the Future Disrupted, but all the topics today are really focused around unique areas that we haven't typically covered before in this environment. So we're really excited about covering that. As I said, we've got incredible people that are all, you're talking about 15, 20 years experience in business, in advisory, in scaling and exiting businesses, etc. And that's what excites me about today's session. Now, we've also got a great lineup of companies which are going to be featured today. All the companies that are going to be featured are actually have got an exhibition, have got a stand inside the exhibition area. So during the lunch and networking break, we'll obviously have the food inside there. I recommend to chat with all the companies. They're all going to be providing a presentation today as well. One of the things I always articulate is that, the founders that we deal with, they spend 24/7. They've spent years building their business. And if they're relevant for you, fantastic. Have a conversation. Engage with them via the CapitalHQ app. If they're not relevant for you, think about who could be in your network that they actually could be relevant for, because that's what's beautiful about this space, is the ecosystem does play a role in actually helping to build it. And so inside, you'll find all the companies inside the CapitalHQ app. So you would have all received an email this morning, which gives you direct access into the app. Inside of that, you'll find the complete agenda for today as well. By the way, there was one speaker I just missed. Is the one session I didn't mention about is that we actually do have a talk from Yash Varma on AI. I remember having a conversation with him going back to October 2022, right? So this was literally just before the release of ChatGPT, and it was actually maybe July of 2022 as well. And so for him, he's become one of the leaders in the Australian ecosystem to talk about what he's seeing in AI. He's been funding companies in that area. He's built a fund in that area, and he sees probably sees some of the most deal flow in the country as it relates to AI opportunities. As an individual investor, as an angel, but also with his own fund as well. So he's going to be doing a keynote around the future of business in relation to AI. So as I said, inside the app, the best, when you go in there, not only will you be able to see today's events, but if you go into the opportunities tab, you'll be the way we've actually designed it is so that you see the most relevant opportunities for you. I said a lot of you'll be new. Out of curiosity, who's coming to a Wholesale Invest or a CapitalHQ event for their first time? Just so you can see. Okay, who's been to our events before? Okay, looks like almost like 50-50, 60-40, etc. So, you can find everything in there. Every company that's been featured today, you can get access to their information inside the CapitalHQ app. We've done it to make it as simple as possible for you to access the information and access the companies that are presenting. They also got a bunch of news, announcements, etc. The whole idea behind the way we actually built this is to help you get access to the information you're likely to want to know about before you have to ask for it. So that was the real sort of simple design in how we sort of built it. And then also there is a underlying of AI ML matchmaking in that you see the most relevant deals for you, right? And the companies which are featured, they see the most relevant investors for them. So we just want to encourage proactive communication between the two parties. And then also today's event is completely hosted inside the app. So when you go in there, you'll see a nice big red button. Just click on that and you'll be able to see, as I said, the full agenda. You'll be able to network with everyone else here as well, which we encourage. Make sure if there's relevant people to you, make sure you reach out to them and try and connect whilst you're here throughout the day. And then also, the companies being featured as well, they all have their own sort of virtual exhibition booth inside of there. And then likewise, the CEOs. If the CEOs from the companies which are being featured reach out to you, I recommend to do your best to catch up with them today whilst you're actually here, or catch up with them tomorrow. I know we've had some of the companies fly in from Perth overnight. to be here today. So they may be a bit tired later on this afternoon, let's say, but do your best to try and catch up either today or tomorrow with those companies being featured. And last point before I get into my keynote, the power of one conversation. I am the biggest believer in this because I see it at every single event that we host, and that's why I continue to put this slide up no matter how many events we do. Every single conference we do, I have seen one conversation change the trajectory of a business or of an opportunity that someone is actually involved in. And that is what's beautiful about these environments and these events. And to me, and by the way, we'll try and create some space so that people can sort of stand on that side as well and try and get some more chairs in too. That's one of the most beautiful things about this space is that because it is an ecosystem, we're all connected to each other and there's a range of opportunities that get created amongst this ecosystem. So make sure you take the time to be proactive, network with everyone. We've got plenty of time for networking between the lunch break. And then also we'll be finishing around about sort of 3:15. So we've got plenty of time up until sort of 5 p.m. to be networking with everyone. So we've done that. So we've spaced out the day. So we've got plenty of great content, plenty of great opportunities for networking, and plenty of time to chat with companies which you think are relevant to you or that you find interest in presenting today. All right, so now I'll get into my actual presentation. And the first thing I'll say is this really simply is that I think this is one of the best times that I have seen for accessing for the foundations of growth, right? High growth and also high yield investments. And there's a number of things which come about this from a thesis perspective. And I started with a good portion of these at the start of the year. And then it sort of continued to evolve as it's sort of gone throughout. And so when I think about the direction which we're going to be taking things, for me, a lot of this started from a presentation that was hosted by Pep, right, at our event in May 2023, where he talked to me about the private capital marketplace area, or the private capital markets will grow from $13 trillion to $30 trillion from 2023 to 2033, so over a 10-year period. And that was interesting to me. And then I realized that I was thinking about my own business, not wrong, but there was a great adjustment to make to how we were thinking about our own business. But then when I started thinking about everything that was taking place in the markets, I realized that there was a whole bunch of business, technology, and macro trends all leading in the one direction. And the funniest part about it is I suddenly started to get super optimistic, even though in the last 2.5 years, it's been absolutely painful in the innovation space. Like this is without doubt for companies that have been raising money, for people for advisors that have been involved in the space, for investors that have been involved in the space. When we have this conversation in private, most people agree that over the last 15 years, the last 2 years have been some of the most challenging years to be involved in the innovation space. So then all of a sudden, I'm getting super excited about the future, even though you literally could say it's been some of the hardest years in the last 15 years. So what are these actual trends? And the simple ones to highlight from my side, and I said, my brain is very simple, so I like to keep things simple for myself. And the way it sort of played out was these are the 3 key areas which I saw playing a role in markets over the next 10 years. And by the way, that's sort of typically my personality. I think to myself, okay, where is the direction of where things are headed? And by the way, what was beautiful about all of these is I looked at all of these opportunities and think there's a whole bunch of different players, but everything's fragmented. And to me, that's exactly how we came into this whole innovation space. When we came into the innovation space, there was only a few players, but no one was really taking an ecosystem approach. Everyone was focused on their individual activities that they were doing, right? So the key areas for me that I see as the great opportunity, the great succession is probably the biggest opportunity standing in front of us right now, right? For the next 10 years, you are going to see baby boomers looking to sell their businesses, succeed their businesses either to family members or to staff, or just potentially go through a private equity sale, etc. And the reality is about 40% of companies right now are actually owned by baby boomers. So this is, and there was one of my shareholders that outlined it to me, this is the greatest wealth transformation, right? The greatest wealth transfer that we will see in the handover of these businesses. You are talking about the unlocking of trillions of dollars of value in this actual succession space. So for me, you'll see, hence today, a lot of the conversation is around M&A, it's around going to exit. And for us as a company, when it comes November, we're actually going to be soft launching our business sales product as well. Because a lot of people have been utilizing what we do from a capital raising perspective, but the reality is what we've built is perfect for anything that's capital engagement related, whether it be capital raising, debt funding, or M&A opportunities as well. So the expansion of private market opportunities, I'll expand more on that shortly, but yeah, the expansion of that, when you think about all those different areas. Now, what's interesting, I'm doing an article on this at the moment, right, is that it's incredible to know how much how in the last like 10 to 20 years, the amount of companies that are delisting, as well as the lack of new companies that are listing, and especially if you took out, in Australia, if you took out all the resources companies that typically list, it looks even more bleak as far as how many companies are listing. Even though the ASX is one of the most efficient, listing platforms for accessing capital on the way in on an IPO, doing secondary raises, and also, providing, access for investors to participate, it's still been an incredibly tough market because regulation has become more stringent. There's more and more compliance onerous on the CEOs and executives, etc. So now less and less companies are actually looking to list. And in fact, I caught up with an investment banker last week, and they highlighted that they were speaking with a CEO of a $500 million company. And one of the things that they highlighted was that it's too early to be listed at 500 million. Right? They're thinking the ideal range is at $1 billion. And you sit there and think that's what made the ASX, to me, what makes the ASX great is the ability to access the small cap companies. So if it's getting harder and harder for CEOs of $500 million companies, imagine what it's like for CEOs of $50 million market cap companies. So that's why this area of private markets becomes super exciting. But of course, it's not as efficient as what the listed markets are. And then the last one is the rise of non-bank lending and also private credit. Now, I said it's absolutely become a buzzword, but the reality is the infrastructure has been set in place where it is a lot harder for the banks to do some of the lending that's been done. The reason this opportunity is, and this is what's so beautiful about markets in their efficiency and how they operate. When an opportunity becomes available, operators then create products and then they create opportunities for people to participate in those products. And that's how this whole private credit space has become available, is because of where traditional banks have been left off from their actual lending. Now you've got the private operators and fund managers operating in this space. And there's lots of great new products and innovations that are coming out in this area. The next one is the innovation trends. Now, this is an area I'm obviously super passionate about. And so when you hear me talk about the first three, you think, well, does that mean we're not focused on innovation? That is absolutely incorrect. I think right now, and the funniest thing, it's still one of the hardest times to raise money. I think this has to be one of the best times I've ever seen from the investor side for participating in private companies. Number one, valuations are lower than what they were significantly a few years ago. Number two, what companies can do with a lot less money is absolutely phenomenal, right? And the key things I'll talk about, I know it's become hype from a buzzword perspective. The AI revolution is massive. There's no doubting how big it's going to be. When Sundar comes out, when Sundar Pichai comes out and talks about how it's the biggest technological shift in our lifetimes, absolutely believe it. Because not only have we seen what generative AI can do, right now we're seeing the rollout of AI agents. To me, that's just as transformational as what's happened in the last 2 years. I'll give you my own perspective. From us as a company, we did what every other company has gone through in this journey, right? We scaled up in 2020 and 2021. We scaled back in 2022 and 2023. The craziest part is we are now able to match what we were doing 2 years ago and actually go beyond it. And actually, we've increased out what we can do from a capacity and execution perspective with 1/3, nearly 1/4 of what the team members we had previously. That's the story that very few people are talking about, right? Because what you can do from a productivity perspective is absolutely amazing. In fact, there's 3 layers to the power of AI. Yeah, hang on. There we go. 3 layers to the power of AI, right? The first one is productivity. Everyone's experience. By the way, who uses AI on a daily basis? Okay, it's crazy. I'm hoping for the day that everyone's hands go up, because to me, it's like this absolute unfair advantage to have if you are, right? For me, I'll use like 4 to 5 different LLMs in a day just by normal course. Now, the reality is that there's the productivity layer. That's important. Then there's a second part to it that I don't think anyone's really talked about. The more you utilize AI, the more you save on your own cognitive capacity. For most founders, for most business builders, for most people in this space, we've got a million things being thrown at us every single day, right? We will have to make more decisions by 12 p.m. on a Monday than what most people have to make in their week, right? It is crazy how much cognitive capacity that saves us. The third part I discovered with my team last week. The third part that's really interesting is how much it saves team members' own cognitive capacity in dealing with each other. So I'll give you a perfect example of it. Who saw the article that we did on the US presidential elections polls? Who saw that? Surely someone did, because we had a lot of opens and a lot of interest from it. So the interesting thing about that article was that the graphic that was created for it was actually utilized with AI. Now, normally the process of doing that is that you'd have it would go to our head of brand. She would then work with the designer to go and create the graphic for that article. Now it's just a simple prompt and the graphic is done within seconds. So it's saving team members use of each other in the actual process as well. So, to me, that's where I think AI is so powerful in the team perspective. And as AI agents roll out, and I'm running out of time already, the convergence of technology platforms, I think, is a massive one. I won't spend too much time on that. Sorry. And the last one is the era of abundance. And so these are the trends that I'm focused on with AI. AI bots is a sort of starting point. That's been well done over the last sort of 18 months, but I'm still watching what it's doing, because I can see more and more how now it's even been rolled out across the execution layer, right? The co-pilot to co-worker, this is exactly what Microsoft took the lead in. Salesforce are talking about it. And it combines with that sort of enterprise AI. The power of enterprise AI means that the need for companies to have the amount of layers of internal redundancy that they did before is just not required anymore, right? AI agents, last week was pretty much AI agents week, which is why we did an article about it on Saturday, right? Anthropic rolled out their computer use, which actually shows the computer working in real time, executing on different tasks across multiple software. If you can imagine what that looks like 2 years from now, and then imagine what each team member's productivity and their capacity inside a company becomes, you start to realize that the potential for the businesses coming forward that are utilizing this tech stack, utilizing these technologies, becomes exponential. And I'd say for every investor, the question I'd be asking to companies that you go into, I know most people want to go for financials, they want to go for all sorts of areas. I'd be asking what's their tech stack they're using, because that will give you a perspective on where their head is thinking about the future. And then last one is Tesla. Tesla absolutely blew me away with what they did with their cyber taxi demonstration, right? They showed so much, and that's what, again, why we did an article about it, right? They literally showed everyone not only what the future of transport looks like, but also how the future product is where the consumer, the buyer of that product, can also turn what they're buying into a money-making opportunity as well. And it's creative how they're actually thinking about it, where they're thinking about someone buys a car, that excess capacity can now be a revenue opportunity for their owner. That becomes creative from a business model perspective. I love this comment, because what it means is that future startups you're about to see, they will not need as much money as what they previously would. Every company I speak to at the moment, they're only looking typically to raise between 1 to 2 million, right? There's very few that are saying, oh, I'm looking to raise 5, 10 million, etc. But the reality is, because everyone can do so much more with less, and that's exciting. So the impact that we'll see rolled out, firstly, the quiet redundancies will continue. This has just been ongoing. I said this at the start of the year, and it's been ongoing right throughout the year. It still happens today. That in 2023, it was popular to announce about making redundancies and saying that you're investing in AI. That's not as popular anymore. So they're just doing the redundancies, right? And they were even talking about that on the All In podcast, where they were saying, basically, companies are just not hiring like they were before. And the middle managers, supervisors, this is where you're seeing a lot of the redundancies go to. It's the middle managers, the supervisors, the cross-team coordinators, etc., because companies are looking to go for more activity, more direct action between leadership and obviously the workers in the company. And then the last one is the outsourced team members, right? Because if anyone's experienced, either investing into a business or owning a business over the last couple of years, going through redundancy processes, letting team members go, or just general workplace stuff is so a lot more people are actually investing in the outsourcing of team members going forward and then training them with AI, right? So not only getting, cheaper labor, but also incredibly productive labor when given the right training on how to use these tools. So, this is why I say a lot of companies can raise a lot less and do a lot more with that actual money. So for me, I think the explosion of startups you're seeing, but also the explosion of people doing more gig work economy as well, more gig economy work. The reduced need for large fundraising rounds. And last one is, you're about to start seeing some of the most profitable companies very, very early on because they need a lot less money than what they did beforehand. So the venture capital trends, all these are still in play, still things that we're seeing on a day-to-day basis. This seems to be the core focus for a lot of the companies that we're coming out. And it's all in different ways, whether it be AI, robotics, and by the way, this leads to sort of our next big event that we're doing coming up. Right, but these are still the most common talking points in amongst the ecosystem about what they're focused on from an investment perspective. Obviously, I'm not going to spend too much time on this because I've done a lot of sessions on this, but obviously on the crypto side, whilst it has been going sideways for the last sort of 5 to 6 months, it is expected to go into its banana zone. There's still plenty of money going into the ecosystem, plenty of money being built. And funny enough, what's been really interesting for me is out of the US elections, the biggest winner by far has been crypto, right? Because both of them have agreed to basically look to make their framework and regulatory framework more supportive for Bitcoin and for the crypto ecosystem. So that, and then you combine that with global platform access, the fact that every single one of you can log into your ComSec account and get exposure to Bitcoin and Ethereum, that is powerful. Because if you've ever experienced the process of buying crypto, it's an absolute nightmare as far as accounts being shut down, getting calls from fraud areas in banks. If anyone really understood what the crypto ecosystem had to go through to get to where they are, where overnight they would have banks shutting down their accounts, cutting off their mortgage loans, doing all that sort of shit. That is common for every ecosystem, every business builder in the crypto space. So now, if that framework becomes more positive, watch the money flow. And then this is Cathie Wood's prediction that by 2030, she expects it to go to $3.8 million, which is phenomenal, right? Now, of course, for all the crypto holders, we hope that she's accurate on that. Who knows? It's a bet, it's a play long into the future, but it's done on the assumption that if the big institutional funds just start allocating a portion of their capital to crypto as it becomes more, and when I saw BlackRock do it, State Street do it, etc., mostly BlackRock was the main one. As soon as they saw them moving in that direction, you can see the sort of allocation of capital. Correct, Bitcoin, Ethereum, and also now the push for Solana as well. Correct, 3.8 million is her target for Bitcoin. Yeah. So these are I won't spend too much time on this given I've only got 10 seconds left, but these are some of the areas which have been popular for the actual crypto space. The funniest thing is for me, the real world asset tokenization, we've been seeing those opportunities since 2000. It just for some reason got rebranded this year and suddenly become popular under the acronym RWA. But we've been seeing those opportunities since 2020. The one I don't spend any time on communicating, but a lot of people have made a lot of money is out of the meme coin area. I don't understand it. It's not my area. But I know it's done very well. But all those other, the one I think super interesting is the decentralized physical infrastructure networks. And I'm doing an article next week where I'll talk about Tesla's play on that. But that's also becoming a high growth area of interest. On the private equity side, once again, you notice it's the common theme that I'm talking about today. These are the trends that we've been seeing in private equity. there is a lot more opportunities for high net worths and family offices to get into private equity products or private equity opportunities now. It's amazing how many investors basically acquire businesses as well. There's people that are coming out of college, instead of doing a startup routine, they're actually looking to acquire traditional businesses as part of it. And this is going to be reflected in what we're talking about today, as far as these are the trends that are coming out in the private equity space. So, it is very exciting. We did an incredible talk at one of our events on the forever acquisition model. That was from Chris Rolls at our Capital 2024 event. But you will see that the private equity area is going to have some significant growth over the next 5 to 7 years. And obviously, us as a company, we want to play an enabling role in that. And to give you a bit of insight we're planning that in July next year, we're going to host a business exit summit, and it will be completely focused around sort of private equity and the exit area. As I said, there just isn't that much content on this space, and that's why I can't wait for the rollout of today's session. This has been common for everyone. Yield absolutely still has everyone's focus. We've done a lot of events on this, but the reality is, this isn't going away anytime soon. And the reason is because Australia's interest rates are not coming down anytime soon. You can see this tussle between the government and the RBA, about what's happening in the markets. But the ultimate reality is, whilst interest rates come down 0.5% in the US, they're now 50-50 on if they're going to continue coming down or if they might need to just leave it or potentially increase them again. But in Australia, we all know that interest rates are not coming down anytime soon. So hence why, going where I started from today's conversation, between the combination of innovation for high growth, the rise of private equity and for growth opportunities, and then also you've got the access to yield through private credit opportunities. When have we ever seen the environment like this, where it's so perfectly primed for yield, growth, and high growth? And so even though it's been a punishing last 2.5 years for the innovation space, that's why I'm most optimistic about what comes next. Now, the question is do I know the timing of this? No, right? But from a demographics and from a fundamentals that we're all seeing, because there's a lot of levers that can get pulled in this. And here's the levers. Interest rates, one of the biggest levers that can get pulled in the actual process. So these are the things that I'll be watching for my signals as far as what comes next. Will there be increase in money supply as far as, whether it be the central governments, buying and starting to stimulate and put money back into the economy, right? Will there be dry powder coming off the sidelines that there has been for the last 2.5 years, or that have been going into the private credit opportunities? And then the last one is, and we're less than 2 weeks away from it, is the US elections, right? It's undeniable that what happens in that election will have a significant influence in what comes next from a business perspective. So for me, these are the 4 levers that I'm watching to understand what moves I need to make. But fundamentally, the strategic direction around innovation, private credit, the non-bank lending area, what's happening in private capital markets, but then also what's happening in succession or business exit area, they are going to be the areas that we're focused on. And in my second keynote that I'll do today, I'll be talking about the opportunities that are coming up for us in that space and how people can be active with those opportunities. So that is it for my presentation. I hope you enjoyed the introduction as far as how we see things and how we're thinking about things. Whilst we're doing a bit of an intro to the first speaker, I just want to give them some time to put out some more chairs and also give people a chance to actually come in and then also sit down. If you've got some space in the middle, just move in one side so people can get some space on the side. We definitely have a full house today. So I hope you enjoyed that session. I hope you got value from it. I look forward to the second keynote. I'm now going to introduce our famous host for today, Jade. And by the way, the one final thing I'll say, can you just give a big round of applause to the Wholesale Investor team for this event? Because I said we made the decision to make this theme for like 3 to 4 weeks ago, and we pulled everything off to make sure that it was on point and we attract everyone that's relevant to make it happen. So a big thank you to the WI team. Over to you, Jade.
Thank you, Steve, for that insightful keynote. Good day, everyone. My name is Jade, and again, welcome to CapitalHQ Investor Day. Let's kick things off with our first set of company presentations. Please join me in welcoming David Hayes, founder and CEO at Babeltext.
Good morning, and thank you very much for the opportunity to present today. I'm presenting a company called Babeltext, which I founded some years ago. We're here to present to gather interest in investment and partnering. We also want to use that investment to take Babeltext into the AI world. So what does Babeltext do? It is a multilingual customer engagement platform. That's our strength. So what we're saying is try to avoid phone calls. Fundamentally, if you have phone calls, voice calls for customer engagement, it's not efficient and it's expensive. So what we are saying, we use messaging. So today, customers want to speak or engage via messaging. There's no question about the fact that if you have messaging as the engagement platform for customer engagement, it's not only provides that opportunity to use the data in that conversation through messaging, and it improves the opportunity to use the flexibility of AI in the future. So what we're saying is we have a platform by which you can engage in 135 languages. So by a simple example, guest comes into a hotel, they speak only Mandarin, they can message via their SMS, WhatsApp, WeChat, Discord, Telegram. That'll come into our platform. It'll be automatically presented to the concierge in English. The concierge will then respond in English, and that response will automatically go back to the guest's phone in Mandarin. We do it for 135 languages. So why messaging? Here are the sort of top line facts. The simple fact of the matter is that people want to use messaging. I can talk to you in detail about what customers prefer, what big business is looking at these days, but fundamentally messaging is the way forward. Customers use these platforms all day and every day, be it SMS, WhatsApp, WeChat, Discord, Telegram. Discord is the language for the crypto market. So we provide a multilingual, opportunity in the crypto space. So Babeltext provides all of those channels to go into one simple user interface in 135 languages. So here's a case study in a hotel group. Guest makes a booking, gets an automatic message prior to arrival. They have the opportunity to then engage with the hotel staff in their language. They can then make a change, make a booking, organise some food and beverage, etc., all from their mobile phone. But it's efficient. You don't have a situation where in the hotel you pick up the telephone and you wait for it to finally be picked up by the hotel staff. It's automatic. Another area that we're growing in is the first touch. We accept the fact that our language translation engine is not perfect for high-end legal and high-end medical. So what we're doing is we're providing the platform to telehealth operators to have a situation where that first touch, they can gather the information on that person. They can find out who they are, what their mobile number is, what their ailment is, and then they can use the platform to be able to schedule a telehealth provider with the appropriate translator. And we've had many interested parties in this space. So the solution is it's one interface. There's cost savings. Messaging creates efficiency. It reduces cost. The efficiency is simply because of the fact that an operator, a customer service agent can manage multiple conversations. It's as simple as that. We are obviously going into new markets with AI and the use of AI to manage the conversations, to enhance the conversations, to do sentiment analysis. And that's a very interesting area for us. We're currently building our sentiment analysis with AWS. So what we're saying is engage your customers in their language on their device. That's our key message today. And some of the product fit here. You can see in healthcare, cultural and language diverse patience. We have in Australia, we have approximately 27% of our population it is non-English speaking, or English is a second language. We're also providing the platform now in the US and in Singapore, and they've just opened a new service in the UK. Government and councils, I think that's obvious. Hospitality, we're in virtually a number of hotels. The corporate, we've just launched a service with stream music in the universities in America because they had this big issue with so many multiple language being dealt with in America. Youth and Crisis Centre, there's not one service in Australia that will provide multilingual support for people who've got depression in the young kids. So we then supported Youth Chat and also Couchsurfer. We provided the platform free of charge for them to be able to provide that support for the cultural language disaffected youth. So that was an important initiative for us. Immigration, obviously that's pretty obvious. And of course, the crypto market, which is expanding, we use Discord for that. So we have a nice, neat little team, which we're very proud of. It's a lean, mean fighting machine. And so we are seeking partners, we are seeking investors. We want to be able to provide this platform and grow this platform into the APAC market. The market opportunity in APAC with all the multiple languages is massive. US is a big growth area for us, and of course AI. So we're seeking investors and partners in the space. The AI sentiment analysis is currently in a build stage. So fundamentally, all of the conversations that come through the, be it SMS, Facebook Messenger, whatever, will be able to be analysed in a dynamic form for the client. We're looking at AI for possible agent support, predictive, the predict and prevent type scenario for the depression side. The opportunities that we learned from Crisis Text Line in America, where they use AI to be able to predict and prevent somebody from committing suicide. We want to introduce that into Australia, and they're doing 2 to 3 saves a day. So that's Babeltext. I hope that I've got my message across. It's very, it's a bit scary, all of this. I don't do much of this. So thank you very much for the opportunity to present Babeltext. We're seeking partners, and we want to provide customer engagement, customer support in 135 languages around the globe. So thank you for your time.
Thank you, David. Up next is Atlasia Capital. Now, please join me in welcoming its Managing Director, John Nguyen.
Okay, hi there. My name is John Nguyen, Managing Director of Atlasia Capital. I'm glad to be speaking to you today about our childcare property debt fund. Thank you to Steve and his team for putting on this fantastic event. I'm sure I speak on behalf of all presenters here today, but it's our passion to create change through enterprise that is our driver to motivate us to speak to you in front of the investment community. We thank you for this opportunity. Let's start with a quick disclaimer. The following presentation is intended for wholesale clients only, provides general information about the childcare property debt fund, and does not constitute financial advice or recommendation. Now I'd like to introduce you to Atlasia Capital, an emerging fund manager dedicated to investments within the childcare industry. For our inaugural fund, we are targeting a return of 15% per annum net of all fees over a loan term of up to 2 years. Our total target raise is 20 million, consisting of individual raises between 1 and 5 million. So for the next 5 minutes, I'll be sharp with the message. I'll share with you the opportunity and talk a bit about our team and strategy, and show you why we have picked this sector as our investment niche. And just some background around the team, key persons being myself and my business partner. My origins are non-traditional for a fund manager. My bachelor degree is in optometry. having grown my network of clinics to 7 across Sydney. Now, the day that I heard about childcare, I quickly realized the potential and scalability of the sector. So over the past 2.5 years, I acquired multiple childcare development sites around Australia, became an accredited childcare provider, started a fund, now I'm fund manager. And Richard Toe, our co-director, is a seasoned industry veteran with 20 years in childcare operations and property development. Our edge at Atlasia Capital is our 360-degree understanding of childcare. This multi-decade experience provides insights that enhance our site selection and project forecasting. Our fund has been set up with an outlook for long-term success. We're proud to collaborate with notable firms that share in our vision. Holder 993 for trustee, AFSL and fund admin, Kendall Gates for legal advice, A&M for taxation, and EY as our auditors. So what is it about childcare? Why are we so committed to it? And childcare is a $17 billion industry. And for Australians, childcare as a service is as essential as they come. Luckily for Australians, our government subsidised childcare fees up to 90% cover in many cases. So for families, kids go to childcare. It's a fact of life. And arguably, the biggest beneficiary of all is the Australian government. The official models show that the recent $1.7 billion increase to government childcare subsidies will boost the economy by $1.5 billion a year. Australian governments have a big problem that they need to avoid. That is the potential loss of revenue to the economy, as well as the potential negative social impacts that may follow. So we want to be part of the solution. Childcare businesses are highly profitable. We know the centres we build, business owners will generate somewhere around $1 million in net profits per centre. So demand from families is increasing and demand by operators is increasing. And on top of that, the data shows that childcare services are vastly undersupplied around the country. Up to 9 million Australians, over a third of the nation, live in areas of childcare undersupply. It's a highly regulated industry, making it difficult for new entrants. So it's simple economics. Demand is high, supply is low for this essential sector, and government support is increasing. The Childcare Property Debt Fund will help supply the construction finance needed for our related childcare development companies, and this will aim to deliver a 15% return per annum net of all fees for new builds. The fund will finance DA-approved permit-ready childcare sites with a defined exit, secured with a second mortgage over the property at an LVR of 70%. So if an allocation towards a target 15% per annum net of all fees lend product within the childcare space is of interest, please contact us. We'd love to align our values with like-minded investors. Our team is dedicated to closing the gap in childcare undersupply in Australia. Let us know if this resonates and we can provide our disclosure documents and have a detailed discussion on how the fund is structured, risks, and mitigation strategies. So yeah, my name is John Ewan, Managing Director of Atlasia Capital, and thank you for having me here with you today.
Thank you, John. And now let's move on to Greenigo. Now please join me in acknowledging its CEO, Vivek Panchakshari.
I'd like to thank Steve and his team for giving us an opportunity. Also, all of you for listening to us from Greenigo. So Greenigo is a premium eco-friendly Maplewood gifts and stationery brand. We are based in Melbourne. So all of our products are manufactured in Melbourne. So we have a simple vision to transform the gifting industry with elegant, innovative, and sustainable products. You know how the paper cards and gifts products are filled with a lot of coatings and adhesives, making the recycling process very difficult. So during this process, a lot of products will come out, and because they cannot recycle, they end up in landfill, and they release harmful substances. So at Greenigo, what we've done is we've taken natural wood, which is a wood veneer. So using wood veneer, we make standout gifts, which are very unique because of the natural grain, and also they're easy to biodegradable, obviously, because it's wood. They are innovative in terms of the technology we use to print on timber. So essentially, we have pioneered a new category under gifts and stationery sector. So over the last 3 years, we have positioned ourselves as a premium brand, and we encourage people to consider the effect of consumerism on the environment and purchase meaningful gifts and stationery. So with everything going digital, there is a huge need for touch and feel unique products. So some of our repeat customers, you can see testimonials, what stands out is they love the touch and feel, the natural wood product. So this is our journey in the last 10 years. We started off at weekend markets in Melbourne, and we went ahead and set up the first printing hub. And we used to be in trade printing service for agencies and wedding invitation companies. Due to COVID, there was, the event industry, a huge drop in the industry, and then we pivoted to gifting and stationery industry. So now we are here to raise capital to exit the legacy printing business, at the moment, and set up a new print hub. We are talking to Canva and Printify, and also expand our presence in US market to add new stockists, and potentially next 5 years create an exit for the investors. So the market size is pretty big in terms of the gifting and journaling industry, and it's a growing industry. So we are targeting just 0.1% of this market. So our current business model is we got stockists across the country. Some of the major stockists are mentioned there. Some of the airports, Brisbane Airport, Melbourne, Sydney airports, souvenir shops, tourist centers. So these are the stockists at the moment, and we got agents on board who represent us. And also we are building a website in terms of getting customers directly to the website through paid ads. And we want to come up with a subscription model where we encourage people to consider the effect of consumerism and on the environment, and they purchase only what they need. So at the same time, we are also talking to Canva and Printify, wherein you, for example, you design your wedding invite on Canva, and then there's an option to print on wood. So right now, Canva has a printer at the moment. They work with snap printing, so all the products are printed through snap, but they can't print on timber. So our strength is in-house innovation and product development. So we have more products lined up in terms of for design patenting. So our vision is to be like Vistaprint, but for printing on wood veneer products. So currently we are in talks with other established brands to white label the products. And also we have received government grants in the last couple of years. So today we are seeking $1 million funding from a strategic investor for next 12 months scaling. Essentially, we want to set up a print hub and grow the stockists in the US in the next 12 months. And obviously, partnering with Canva Printify will significantly increase Greenigo's valuation. And we are forecasted that we'll be hitting $100 million in revenue by year 5. So this is our small team at the moment. Myself, I bring in more than 20 years of experience in printing industry. And my wife, Priya, she looks after the digital side of the business. And I got great mentors on board. Jelly, who has sold her brand to a private equity firm, she's on board helping with us to get into the US market. We got Haley, who's our national sales manager. She gets in touch with our stockists. And Michael, again, has worked with OpenPay, and he's helping us to talk to large retail chains, for example, Govita at the moment. And our son there, who attends the trade expos, he'll get more warm leads than anyone else at the show. All right, so this is us. We have built the business as a lifestyle business for the last 10 years. So moving forward, we would like to focus and scale the company to position for substantial growth and successful exit strategy. So if you can, come and have a chat with me. I'm just across in the room, and you can come have a look at the product. Thank you.
Thanks, Vivek. And now let's get ready for our first panel session, who will be taking us inside a buyer's mind, insights from private equity, corporate, and serial acquirers. Please join me in welcoming Lel Smith, Managing Director of the Capital Network, Phil Tran, Head of Investments and Partnerships at Venturely Capital, and an ETA investor, Pete Seligman.
I have been presenting at Wholesale Investor for some time, but I must say it's always different when you're on the flip side. With the Capital Network, we help companies to connect them to capital, much like Wholesale Investor events do. And then recently, we decided that we're open for capital ourselves. So I feel like I have had to try and get inside the buyer's mind for the first time. And I'm delighted to have two investors here who are incredibly well-credentialed investors. And the goal of today's panel will be to get inside their minds, to understand what makes them tick, and to extract all of those pieces of knowledge that we need to hopefully have the most successful capital raising possible experience. So firstly, joining me, I will ask if you can introduce yourselves as well and the sorts of investments that generally attract you. Pete, yeah, over to you.
Is that on? Yeah. Yeah, Pete Seligman. So I've been investing in small and emerging businesses for the last 10 or so years. And prior to that was in a range of other corporate roles. I focus on what's known as ETA, or entrepreneurship through acquisitions. So very simply put, I back entrepreneurs who, instead of starting businesses, are interested in buying one instead. The businesses that we typically invest in are earnings less than 5 million. So usually between 1 or 2 and 4 or 5, in that kind of range for earnings. All domestic except for one where I've invested offshore in New Zealand. And also I get involved in a particular structure founded in the US in the late 80s or the mid 80s called search funds, which is a whole nother rabbit hole to go down, which we probably won't do here. But yeah, I get involved in buying existing operating businesses from typically retiring owners.
Excellent. And Phil, when it comes to yourself, getting inside your buyer's mind, what's your approach to investing and what investments are you generally looking at?
Hi, everyone. And thanks, Steve, for the platform. Similar, we are looking at investing in business that are brick and mortar. Previously, we did go into the tech space, but there was a lot of risk involved. So now we're focusing on succession planning, or the lack of succession planning, and taking the opportunity to invest in businesses that have high growth, high cash flow, and we use debt instrument to acquire these businesses.
Okay, so just to understand, I'm going to get a bit more so we understand you guys more before we get into the general lessons for everyone. The succession planning is a very interesting theme, and also you mentioned businesses under 5 million, and broadly speaking, I'm sure we've all heard there are a lot of a boom in businesses that are for sale. Pete, can you perhaps talk us through that global thematic? Because I've only heard these rumors, but what exactly is that? Are there more businesses for sale, and how does that impact you?
Yeah, totally. So, I mean, everyone's heard about the silver tsunami. We ran an event a few weeks ago where Bernard Salt was talking a lot about the demographic drivers. Obviously, baby boomers are coming to retirement age. Actually, retirement age for the baby boomer generation started about 5 to 10 years ago. But what's happened is that's kind of delayed a lot of people who people thought were going to exit their businesses at age 65 to 70 are actually holding on till kind of 75 to 80. And we're starting to see that run through now. So We'd estimate that in Australia alone, businesses that have earnings between, say, 1 and 4 million, there's probably about over 100,000 businesses that are in that kind of range. And statistically, over half of them would be owned by people of retirement age or baby boomers. So even only in the Australian market over the next 5 years, there needs to be at least kind of 50,000 of those businesses will either shut up shop or will be available for acquisition.
Okay.
And that's the same globally. Yeah, absolutely.
Awesome. And Phil, when it comes to succession planning and this thematic, how does that tie into your business and investing day to day?
Yeah, just echo on that point. The baby boomers are reaching, if not wanting to retire. So what we have come across is the opportunity to step in, either to help with the succession, where we can acquire the business and carry on the legacy. Working with the family to continue that business that they've built over 20, 30 years. Lack of succession will either cause the business to fold and have no one to take over. And it's very typical at the moment, because if you look at the 3-generation gap, you got your great-grandparents, you got your grandparents, and now you've got your parents wanting to retire. But when your parents were raising you, you have opportunity to go into tech and other businesses. So there's really no interest for the children to take over the business. So the lack of succession could mean that there's an opportunity for us to go in at a very good price and take over that succession. Or unfortunately for many of businesses, even my parents, they folded without anyone taking over the business.
It's it's interesting. Like just 2 quick points. One is that now that we're moving into the 2020s, as opposed to sort of 10 years ago when I was starting in this space, there are actually businesses that are sort of 10, 15, even 20 years old that are even in the tech space. The business that I'm invested in New Zealand is a cybersecurity specialist. But I've got another one in Wetherill Park that bales cardboard, right? So you can get every end of the spectrum in there. But the first business I ever bought back in 2013, the owner was looking to retire. It's in mining technology and services. And he had 2 daughters that were in the fashion industry. So he had no succession option there. And so that was really the driver for him to try and get out at that point.
Excellent. Well, thank you for the intro to you and the overview of where we're at. Now we're going to deep dive into investment criteria. So when it comes at looking at a company or an investment, what are the key attributes, perhaps Phil, that you look at before making an investment? What do you like to see, or what's a no-go zone for you before you decide to put your money into something?
So eventually we're quite small. We're a private equity firm. We're looking at 10 million in terms of revenue and less. So that's our pocket at the moment. We do partner with VC companies that aim for the bigger fish, but anything that comes across their path, they hand it over to us to look at. The succession business has to have a high cash flow, profitable before we jump in there. We don't go into a sinking ship and hope to revive it. So that's the major criteria. Because of the condition of the succession and the baby boomers that wanting to get out, what we find is an opportunity to get in there at a discounted rate, and a lot of time get away with prices that are 2 times EBITDA.
Yes, a great niche. And Pete, you mentioned companies under 5 million, but what other attributes are you looking at?
So the reason why I say 5 is actually just because that's kind of the level where private equity, even small private equity, don't go below. I've got a view. The reason why is because the issue we're raising here is that you need a new operator also to drop in, which is why I'm involved in the ETA space. So I back those operators who are then going to be the ones to drop in as the succeeding CEO or leader of the business. In terms of criteria, I mean, if I talk you through my portfolio, you'll clearly understand that I don't have a particular thematic. So except for the fact that all of them were owned by people of retirement age and looking for an exit. There are 3 things that usually I look for. You know, if someone throws me a teaser, what are the 3 things that I ask first? One is just make sure it's not in a market that's going backwards. I'm not one of those people that needs a massive tailwind, but you just don't want to be paddling upstream. The second one is that business in its marketplace, I think it's useful if it's got some ability to be special in some way. It doesn't need an absolute unique attribute, but something that makes it a little bit more different. So if it's an electrical services business, it's that, but it's got a communication specialty, or, it's a cleaning business, but it's really, really good at cleaning schools and the associated kind of parts to that. So something a little bit unique that it's got as a driver. And then the third one kind of links to the way in which I invest, which is the new operator that's going to drop in, what is it that they can bring to the party? Because value creation in these, I mean, the multiples that we're referring to here are correct. So the acquisitions that I invest in, multiples between kind of sometimes sub 2, but usually kind of between 2 and 4 of earnings. The real value creation is not only the multiple uplift through growth, but actually the operational change. So we need to know that there's something we can actually do to it.
Absolutely. Now, a lot is also, that's a great overview of the companies and investments that you're looking at. As we know, companies are run by people, and much is said about management. I'm sure we have many founders in the room. Before you have, or while you're having these conversations with founders and management, what are you looking for to hear from them that is going to give you some reassurance that they're going to take care of your money and help grow it alongside of you?
Sure. So the 3 questions I just gave you is like my first 5 minutes. As soon as I tick those boxes, the next thing that I spend all my time on is people. Kind of the third thing after that, after you're really sure, it's all the boring stuff like finance and legal and DD and all that kind of thing. But really, like the crux, I spend most of my time thinking about the people part. Obviously, in what I do, the person that I'm backing to come in new to the business is a big part of that process, and so really understanding who they are and what they can bring to the party is important. But then within the team, I think culture is really, really important. And it's interesting often, and I mean, I know we've got kind of startups and kind of growth founders in here. One of the things that I guess I'd encourage you to think about as well, but often what I find after we've gone in and bought a business that's been founded by someone and grown over a period of time, is that next layer down, there's often some hidden gems in there that of people in those kind of sub-leadership positions who actually have more capability than they've been allowed to deliver over time. And that's because the founder is such a strong kind of character in that process, which they need to be in those first few years, right? But so what I try to do in the next part is spend as much time with the next layer down as possible. Yeah.
That's very interesting. Extracting value from all levels, not just the obvious one. And Phil, how about yourself when it comes to founders and management? What are you looking to see or hear from them?
Yeah. So at Venture Capital, we are lucky enough to focus on a niche, and that's family-operated businesses. You find that there's quite a small team, so there's not really a culture fit. But what we look for is the founders obviously want to retire. They have no children or no interested children to take over the business. So the next level mentioned here is who has been helping in terms of the operation of the business. Sometimes the founders wants to move on, retire, but feel bad that someone's going to lose the job, but then wrap it up. So we go in there and we look at who's been in the business that's helping out the founders, and you always find a middle-aged guy or girl that's been in the business for 20 years, helping the husband and wife run the business. And we work with that person to ensure that they're not going to lose their job and understand what skill and talent that they have or what's lacking in the business that we can inject our shared service model into the business to grow and continue that growth.
Well, Phil, that's very interesting, but that also helps me lead into my next question, which is investing risks. I'm sure we've all heard that you shouldn't work with your family, and certainly when it comes to ASX-listed companies, one of the worst things you can see is if a CEO has given a board a job to one of their family members. When it comes to the investments you're in, what do you consider risks, and what is a risky scenario for you to come across that perhaps you would warn others against or getting into?
So once again, the niche area that we get into, we don't encounter some of the corporate style risks, but more of are there potential family conflict? If we take over the business, is there some rivalry that we're not aware of? So we make sure that there is no history of family trying to fight over the business or siblings trying to take over that hasn't succeeded. So they could cause quite significant risk. The other thing is we want to make sure that if the business is selling at a low price, understand why they're selling at that price, and if it's justifiable through our DD process, then we want to make sure we want to look at their peak. What was the contributing factor where they peak, and if they dropped to, say, if they were operating at 10 million and falling at 2 million, then do we have the expertise to build that up to 10 million? And those are the risk elements that we need to assess.
Yes, I'm sure you've seen some pretty interesting things though with family member against family member. Yes. Makes it for another layer of emotions that aren't usually present in business. Pete, yourself, when it comes to risks, what do you think makes you a bit nervous if you see it, or what are you actively trying to avoid?
Sure. I just used the word nervous. It reminded me of a conversation I was having with a CEO last week who said that she was a bit nervous about something coming up, and I said, it's okay. It's just like being excited. I think that the biggest risk in what I do inherent risk is key person risk. So when you're going in to buy a business that's been run by the same person for the last 10, 15, 20 years, clearly they're a key person, right? So the method of investing that I use to mitigate that is that we're backing an entrepreneur to come in and effectively directly mitigate that key person risk by jumping into the seat and managing that transition. So first one's key person risk. We mitigate that by bringing someone along for the journey. The second one is probably mostly in transition. So I think, once you get through, say, 12, 18, 24 months post-acquisition, most of the risk then just becomes normal business as usual risk. But in that first 12 to 24 months, it's highly likely you're going to get punched in the face. And it'll be usually, unfortunately, something to do with what the vendor did, meaning like the seller did in the 12 months leading up to completion. So it'll be something related to working capital, or it'll be something related to a major customer contract, or something related to that next layer of people departing or transition or turbulence in there. So I think, the second layer of risk that we spend a lot of time thinking about is that transition of ownership and that kind of 12 to 24 month period, which is really, really critical.
Yes, some very helpful risks to understand there. I want to ask you if you can give, and I'm sure many of us can relate to those risks. If you're a founder, you take too much on board, or if you want to ask a family member to help you, but you think, is this going to come back and bite me in the future if they say that they want to claim my business? Are there things that founders or owners of businesses can do or should do earlier on in the process before considering a sale that would help them position their sale better to you?
Yeah, absolutely. So I think if you're thinking about going for an exit, your runway should be at least 2 years, if not 3 years out. You need to be thinking a long way ahead so that you can get everything prepped, and there will be things that you can do in that period of time to prepare yourself a lot better. I mean, it's no different to selling your house, right? If you turn up on the weekend and say, right, we're going to list it for sale, there's a whole bunch of stuff you could have done that would have made it a lot better to sell, right? So think a long time in advance, and not just 12 months. Like, it needs to be 2 or 3 years in advance. I think trying to make yourself redundant is a really, really important job anyway. So even if you're thinking about staying for a long period of time, you should be constantly working on how you can make yourself redundant. I think that's super important. Then the third thing would be whether or not you directly learn it or you find someone that you can trust that knows it. Make sure you actually understand what a business sale actually looks like. Most of the people that we buy businesses off have a really, really well-intentioned, loyal tax accountant. And it makes it really, really difficult to successfully make your way through a transaction when on the other side is a really good tax accountant. And what you actually need is a really good kind of corporate advisory person that understands things like working capital mechanisms and valuation principles and due diligence and all that kind of stuff. So that'd probably be the last thing, is like the game that you're going to need to play during your exit is completely different to any other game you've played before, unless you've exited before. But it's a brand new game.
That's fascinating, and making sure you have the right people around you in more ways than one. And Phil, how about yourself? I think this is such valuable information. If you were to, speak to someone who's at the beginning of their journey, what are things that they can start to do now if they want that exit in the next 2, 5, 10 years?
It's an interesting question, because some of the business that I have come across, and in the generation that we're looking at, the economy is still very cash based. So when I approach a business owner and they're ready to sell, and then you give them a low valuation, and they say, "Why so low? I'm earning $2 million a year." But what they don't disclose is 500,000 of that goes in the back pocket due to cash. So I love the conversation. Give me 2 years. I'm going to start declaring everything to increase the valuation, and that conversation. At the moment, I think the cash and electronic payment is now almost 80%, and the government's trying to drive that to zero cash. But in the generation that we're looking at, it was mostly cash, and the valuation of these businesses are very low. And one of the preparation that a lot of business before they sell is to actually declaring a lot of those underpaid cash.
Yes. And just a question when it comes to family, that you're working with many of them. Do you think there's something that they should be doing at the beginning of their business journey in terms of, or even your views on partnership agreements and really legal frameworks in business? Does it make it easier for you then to do that deal when they're in place?
Well, we actually operate on the flip side. We target a business that actually fail those.
Oh, there you go.
Those partnerships.
An opportunity for you.
Yeah. So we see a lot of family dispute that makes the business fall apart. Partnerships, friends, best friend going into partnership with each other. I think in the startup space that happens a lot. Co-founders and they're like just don't see eye to eye. But they're the target. For us, it's an opportunity. It's a risk for the business falling apart, but it's actually an opportunity for us to get in there and use our shared service model to revive the business and take over the business from that point of view.
I bought my first business with a really good mate of mine, and because we'd both seen that kind of thing happen, like our principle was the stronger a relationship, the bigger the documents, right? So I think that should just be completely correlated. So, family, friends, all that sort of stuff. A lot of people say don't go into business with family and friends. I don't think it's impossible, but I think, your documents need to be really, really clear. And you actually it's better to have a difficult conversation about what happens if we don't like each other anymore. What happens if we disagree on what we should do next? It's much easier to have that hard conversation when it's actually not a real conversation than when it is a real conversation, because by that point you actually don't like each other, right? So Absolutely. Actually running that scenario planning, what are we going to do if this happens or that happens? Do it when the vibes are good, and write it down, and then you'll have something to go back to.
Excellent. Now, we have discussed the whole way through to the investment process, the criteria, the opportunities, risks, some tips to address those risks. When it comes to valuation, I'm sure that your expectations of what you're getting from a business are different to the founders and owners whom you're speaking with. And it is a dance that you enter into, and somebody, hopefully both parties end up happy on the dance floor. But when it comes to addressing valuation, Phil, perhaps how do you think that a founder or a company owner puts themselves in the best light when speaking with you for them to get the maximum value from their business? while still being a good deal for yourself?
Right. Fortunately for us, we've come across a lot of businesses that the owners have already been thinking about retiring, and sometimes semi-retired, so they leave the business quite neglected. So I can't speak to the advantages of the owners, but more the advantages for us. So what we look at is, first of all, were they performing at a high peak area at one stage? And using the expertise that we have eventually, especially our shared service model, if you look at any particular business, you have finance and accounting, marketing, IT, and in our case, investment. So we have those shared service model within our team, and if we can plug that into a business, then that becomes a very viable investment for us. So like I mentioned, we only target those investments where the owners are looking to exit, and in our favor, they are willing to negotiate at a very, very attractive price.
Excellent. And how about yourself, Pete? Valuation.
Yeah, so my first comment would be whenever I speak to a potential or an owner or potential seller, I ask them how they're being advised. So to my earlier point, I think entering into a negotiation with someone that's either not advised or poorly advised is really, really difficult. It's like, speaking two different languages. So that gets really difficult. Even then, when they get to the point of being advised, like all of the businesses in the area that I'm involved with will trade somewhere between 2 and 4 times. I mean, it's just the reality of the risk profile they are, the earnings margin that they've got, and the growth profile that they're likely to have. So it'll be somewhere in that range. Some will be slightly higher, some will be slightly lower, but you end up somewhere in there. So actually, it's interesting it's less about headline valuation. Usually the negotiation, it's around structuring and various other things that will come into it. Earnouts are a real thing, and they happen in pretty much every deal. The percentage is kind of marginal, and the KPIs are kind of different each time, but earnouts are a real thing, and they're a really important factor to bridge that gap between buyer and seller expectations. Working capital is material to acquisitions with valuations at this level. And so it's something that often people forget about. And I was on my way here speaking to one of my CEOs about a bolt-on. And again, working capital is pretty much the biggest part of that discussion. So working capital is really important because it does impact valuation, completion mechanisms, that kind of stuff. So headline valuation is rarely a big topic of discussion because, like, if they've got some ridiculously high expectation, that the conversation stops pretty quickly. So you usually end up in about the right band, and then it's a question of structuring. And that's where, again, if they need to be well advised, because otherwise it's difficult. And I'd prefer for them to be very, very, very well advised than for us to feel as though we're going to get some great deal because they're poorly advised. It actually ends up worse, right? So
fantastic advice. You've given us so much, and I'm going to ask you to, which is a struggle, to summarize it all into the one piece of actionable advice for founders or business owners, one thing that they could do to position themselves better in your eyes, that is something they could perhaps do today to just position them a bit better for tomorrow. Phil, how about yourself?
I think a lot of Asian culture, they tend to sell the business when they're going broke. So when they hear a business for sale, they're thinking, why are they selling it? Are they going broke? So my advice to the businesses that are thinking about selling, and plan ahead. Make sure that you're not putting cash in your pocket. Everything is declared so that when it comes to due diligence, everything's on paper. Your accountant will show the numbers that reflect the valuation, and make sure that there's a succession plan in place, not lack of. That's where we come in and take over. But I think overall, you sell at your peak, and I think most of the people in the audience know that.
Brilliant. And Pete, one piece of advice.
So So if you're selling, it means you're not raising growth capital, right? So there's a big difference between the two. If you're going to sell, you need the value of your business to be high, not the value of you to be high. So if I've got one piece of advice for anyone that's thinking about exiting, which is different to raising growth capital, you need to make yourself redundant.
Excellent. Well, I think that sums up very nicely the whole process and so many considerations. Thank you so much for your insights. And I hope everyone has found that very valuable. Please join me in thanking Pete and Phil. Thank you.
Thank you so much to our panelists for that engaging session. And now let's resume our company presentations. Please join me in welcoming Cameron Story, Head of Sales and Marketing at Rocking Horse Group.
Good morning, everyone. My name is Cameron Story. I'm with Rocking Horse Group. And this is a slightly different presentation to the others you may hear today, as we're not actually looking for any investment. We are, in fact, lenders, and we're here to give money to companies who are looking at it. So hopefully there are a few in the crowd today. But in saying that, we also get a lot of our referrals for prospective borrowers from investors themselves who perhaps already are working with a company and they see that company needs a bridging loan or a bit of extra finance, and they introduce them to us, and we can help them from there. So Rocking Horse specialises in providing R&D finance to startups and innovative companies in Australia. Our focus is on unlocking the potential of R&D tax incentives to offer financial flexibility. We've been doing this for around 8 years now. We've done about 800 of these loans. We offer anywhere from $50,000 up to $3 million, which in this market seems pretty handy at the moment. So what is R&D finance? Very quickly, R&D finance allows companies to secure loans against the eligible R&D rebates that they're getting from the Australian government. So rather than waiting for up to 18 months, a lot of the time people have to wait for 18 months, the end of the financial year, to get that rebate. We allow them to bring that forward, get that cash now while they're spending it on R&D through that year. There's also no recurring interest payments throughout the year, making it a very simple process. It's the way the loan is paid back at the end of the financial year. The tax return comes to us, so it's all paid off at once. So if you're looking at the benefits of R&D finance, what are they? There are a lot of them. Primarily, it's going to allow a company to have far better cash flow management. Instead of having a lumpy cash flow through the year, R&D finance allows you to smooth that out, and you're allowed to maintain momentum throughout the year. That's done through the flexibility of our funding. You can borrow just once if you like. A lot of people do come at the end of the financial year, get a bridging loan when they know that rebate's coming. But there's also the option, which what a lot of clients do, is borrow quarterly. So each quarter, as they accrue more spend, they can draw down more, giving you more access to borrow through the year. Thirdly, this is non-dilutive funding. So, it allows a company to retain control of their business for far longer until it's actually valued at what you see its potential to be. Finally, it is a very quick process. So, the capital raise process can take months and months for you to get what you're looking for, to go through, all the different deals you have to. But with us, you can get access up to about $3 million inside a couple of weeks. How does it work? Look, it is a very, very simple process. We've been doing this, it's actually all we do, so we've made it as quick and smooth as possible for companies to do. All you really need to do is confirm that you are eligible for the R&D tax incentive. Then you need to provide us with a very small amount of documentation. It's some financial documentation, some historical documentation of the company. We obviously do our DD on the back of that. And once we have done that and ticked it off, the money can be to you within sort of 48 to 72 hours. So obviously that's a lot quicker than you normally used to. So why would you choose R&D finance, and why would you choose to work with us? We're here to to help fund your innovation. You also know the importance of being first to market, so getting access to cash through the year allows you to accelerate that commercialization, ensure that you're ahead of your competition. If you're in the process of trying to raise capital as well, which obviously all the companies here are, getting that money through the year will allow you to sort of hit that milestone a little bit quicker and increase that valuation as you sort of head to market. It also, obviously, as I've said before, it allows you to retain control of the business. You don't have to be giving up more equity if you don't need to just yet. So we can sort of help you lengthen that runway. And like all startups or scale-ups, cash is king. So often everybody needs more of it right now. We can approve your finance in just a couple of weeks, not months. Really help you maintain that momentum. So really, that's it. It's a short, very easy process. It's time to unlock that potential of yours. If the hunting capital is taking longer than you sort of hoped, you can definitely consider R&D finance as a viable and fast option to sort of enhance your funding strategy through the year. Giles, our CEO, is also here today. He's speaking on a panel a bit later today, and I will be here in the room next door. So if anybody, investors, companies, would like to know a little bit more about the process, timelines, costs, please just come and introduce yourselves and enjoy the rest of the day.
Thanks, Cameron. The next company is Orijin Plus. Please join me in welcoming its founder, Rhys Williamson.
Good morning, everyone. My name's James. Rhys is the other founder, so you've got me today, but he's out there if you need to talk to him. So I'm going to give you a bit of a rundown on Orijin Plus. Before I start that, I'm just going to take you on a quick little journey. I'm assuming no one in the room knows what's happening here in this photo in Ohio in 1974, and nor should you, to be honest. But what is happening is the day the world changed as a result of the first barcode scan. Now, that barcode scan was done on a packet of Wrigley's chewing gum, just like what I've got here today that I bought. And the barcode is the same barcode that was scanned in 1934. Right now, there's an equally defining moment in time that is afoot, and that is the GS1 2027 Sunrise Initiative. The traditional barcode that we have is converting to a QR code. On the back of the original QR code, some of the largest software businesses went about building their enterprise systems with the standard. The standard drove efficiency across every facet of business, and it continues to do today. The code is not going to change. The way that it presents on a product is. And from there, what we see happening in the next 2 years is transformational and a once-in-a-generation change. The result of the change is because of consumers demanding greater transparency. Consumers are now demanding traceability, certification of documentation. They want to know the ingredients, how it hurts or harms their body, and how it impacts the world around us. On the other side of that demand coin, brands are demanding ways to connect with consumers. And QR codes offer this solution. So we have a standards change. We also have legislation change. Already across the EU, enhanced legislation for food traceability has already occurred, and it's only getting more and more month by month. Equally in the US, they have also introduced enhanced food traceability across a group of categories, and that is also increasing month by month. So these two forces are coming together and culminating into what is a catalyst for a new industry. The new industry is called connected packaging. At Orijin Plus, we are a connected packaging platform. We help the global food and beverage brands around the world connect via QR codes on their packaging to a suite of features that are in demand. From traceability, competitions, loyalty programs, and many others, we simplify this with a single solution, one that they are all going to need in the next 24 months. Now, our journey in creating Orijin Plus isn't a standard one for a software company. We actually started as a food and beverage brand. In 2018, we had a problem. We were exporting to the world, and consumers lacked confidence in our supply chain and supply chains in general. We looked to solutions in market. Traceability at the time in 2018, there was very few. So we went about developing our own. We're the first company to develop a blockchain traceability solution and track the product from farm across to another continent and in the hands of consumers. And we didn't stop there, because we also suffered from another common gripe of wholesale food and beverage brands. We did not know who our end consumer was. The retailers that we sell to and then sell to the consumer, they knew who the consumer was. We did not. And just like every other food and beverage brand in the world today, our products travel through supply chains and into the hands of a consumer, albeit we do not know who that consumer is. So we went about changing that also. In the QR code that was presenting our traceable supply chain, to give consumers confidence, we entwined a pack-level loyalty program. With this pack-level loyalty program, we changed the game because we got to know who our consumers were. And we managed to build a very loyal consumer base across multiple countries, and we unlocked this for us. As we were developing our solution, on a parallel runway was the GS1 initiative. Right now, GS1 is out there in market promoting to brands that they should choose to adopt the solution earlier than 2027. They are promoting that the reason why you should adopt the QR code and replace the barcode, which right now it is a choice, which will no longer be a choice in 24 months, is traceability, verified documents, the ability to run competitions, loyalty programs, and everything that we have in our platform. We were already developing it. We'd already put it into market. We already have it in play globally. So it made absolute perfect sense that we are a GS1 solution provider to help them and brands as they transform to this once-in-a-generational change. I can tell you as a brand, if you're dedicating a 4x4 centimetre space in your packaging, you want to make sure that it has the best chance to drive impact for your brand to win. And that's what we do at Orijin Plus. We help brands win. We have the right platform to service this demand that is going to be emerging in the next 24 months. We also have the right team. Amongst our team, we have two of the ex-CEOs of the largest loyalty programs in the world. Our CTO is the founding software engineer of Airbnb. And we have two other founders, James and Reese, but we're here, so I won't waste time introducing us. You can come and talk to us. Why are we here? We are raising capital. We're raising $1.5 million. We have $450,000 committed, for just over $1 million left to do. If you're curious about our company, please come and talk to us. We love talking about our company. If you're interested in learning about our team, please come and see us. If you're interested in learning about where we see our business will be in the next 24 months, please come and see us. Thank you for your time and have a great day.
Thank you, James. The next company is Rapid Response Revival. Please join me in welcoming its Head of Investor Relations, Damon Shrubsole.
Good morning, everybody. Thank you, the Wholesale Investor team, for setting up today. And it's a great pleasure to be here with you all. Before I start, I'll just quickly give you a bit of a background on CellAid, which is the product that we're delivering to 7 countries at the moment. It's an ultra-portable AED, or as they're known in Australia, packer whackers, for people to be able to carry on their person anywhere, anytime, in case of an emergency. And just quickly, I'll just play a video for you that'll give you a bit of an overview of the business.
Thousands of home defibrillators are being rolled out in Australian homes with hopes that one day every household will have one. They weigh less than half a kilogram. They're easy to use if anyone suddenly collapses.
David Whiting is getting back to doing what he loves after suffering from a sudden cardiac arrest.
Something I hadn't experienced before. At some point, I just collapsed.
Every year in Australia, around 25,000 people go into sudden cardiac arrest. 80% of those happen at home, but less than 3% survive.
Sudden cardiac arrest is sudden, instant, surprising. You need something immediate because after 10 minutes, it's virtually impossible to bring you back.
You can now purchase a miniature AED, a key life-saving device, to keep at home.
Having one in the home where the majority of sudden cardiac arrests occur goes a long way to narrowing that survival gap.
Survival for people like David, who was resuscitated by an off-duty lifeguard and an AED.
The number one factor that helped my survival and recovery was early intervention.
Designed with instructions for both adults and children, it costs around $360.
You need to make it affordable to get into the homes. If it's too expensive, it just won't be bought.
It's hoped that by having an AED just like this one in every single home in Australia, within 5 years, tens of thousands of lives could be saved.
It's going to be peace of mind that hopefully you never have to use it, but you have something at hand that is literally can save someone's life.
Nick Hose, 7 News.
So it mentions in that presentation, in that news article there, that we're looking to improve survivability of sudden cardiac arrest by tens of thousands in Australia in the next 5 years. Overall, with our product being a global application, we're looking to save over 100,000 lives across the world. And their friends and families and co-workers who you may not think anywhere near having a cardiac arrest, but I can tell you from experience, scars to that I almost had a cardiac arrest in June on the back of 5 blockages in my heart. And I would, excuse me, how lucky I would have been by carrying my co-worker. Cardiac arrest kills over 8 million people on an annual basis. It's a bigger killer than the top 5 cancers combined. It's 16 times more fatal than traffic accidents and over 300 times more fatal than house fires. We want CellAid to be as ubiquitous as smoke alarms, fire extinguishers, and other important emergency and safety equipment. Just here today, there is a likelihood that in the next 12 months, 40 of you may experience or know someone within that has a sudden cardiac arrest event. The survival depends on early defibrillation. Time is a key factor in sudden cardiac arrest, and for each minute you are without CPR and defibrillation, you're effectively losing approximately 10% chance of survival. And ambulances in Australia usually average somewhere around 8 or 9 minutes. So you are very dependent on the bystander who finds you in that situation and starts dealing with the problem early. So your chance of survival is over 90% in your first minute, reducing to 50% in 3 to 5 minutes. 10 minutes, you've got less than 1%. And the majority of sudden cardiac arrests occur in the home, where you have a less than 8% chance of survival. So we've created the world's first personal AED. It's 75+% lighter than a traditional AED. It's 70% smaller than a traditional AED. We've reduced the cost as a barrier to people purchasing AEDs. And we've also made it low maintenance. So while the device itself has manual features that allows people to see the green flashing LED indicating that it's good to go, we've embedded IoT capabilities within the device that allows it to report to us on a monthly basis so our customers can be confident that their device is ready to use. But it also creates an opportunity for our business to grow with the data that creates. Data is collected at the time of an event, which can be provided to those who suffer from cardiac arrest, their treating physicians, or just people who want answers. But it also means that we have customers who are very, very loyal to us. We've sold over 22,000 AEDs in Australia. We're the #1 seller of AEDs in the last 2 years, and we're outset at selling some of the leaders in the traditional space by 8 to 1. We sell in and deliver in 7 countries: Australia, New Zealand, South Africa, the UK, Ireland, Malta. So at the moment we have an English-only device, but we are expecting to deliver our first language device in French towards the end of this year, early next year. That customer has put their foot into the production queue for 5,000 devices, but they are also a sponsor of a first responder network in France that has over 750,000 people involved in providing first aid and emergency care to people prior to airborne's arrival. We also have a membership model embedded in our business. As I said, that data that we're collecting and the relationship we have with our customers. The membership is called Selling for Life, and it includes the replacement of the device, the collection of the data going through. From an addressable perspective, our device is designed for households. There's over 55 million of them with a person over 50 years old. 71 million businesses in the addressable market that we see for our devices. 2.6 million police officers. I mean, just in North America alone, there's 4 million healthcare providers in allied healthcare, doctors and nurses. Schools, government buildings, sports teams, and we believe our serviceable market is about 18 million. So just going back to the subscription model, we sell the device for just under $600. We include the first year's membership for free within that purchase price. And what they get for it, if you use it, we will replace it. So we want people to have confidence to use the device and not think twice about helping someone because they're destroying a piece of expensive equipment, remote monitoring, and replacement when the device expires. So I'll just quickly get through this. Many people say it can be copied for a tenth of the price and we lose our advantage. It's a Class 3 medical device. The huge amount of regulation that we have to go through is a barrier in the markets. We deal with 10 plus regulators on a global basis. There's thousands of pages of compliance documentations, and we've protected our device with 80 patents, design registrations and trademarks across the world. So we believe we've got a 5-year head start on our competitors. We are raising money, as everybody, most of us here are. We've got commitments in our pre-IPO convertible notes of 9 million. It's currently open. We're expecting a liquidity event in the next couple of years, whether that's IPO, trade sale, or strategic partnerships. And we're building a foundation for US global growth of our business. So thank you very much. If you'd like to come and see myself or the founder, Donovan Casey, and join us on our mission to save 100,000 lives by 2030. So thank you very much.
Thank you, Damien. And now to talk about opportunities with Wholesale Investor, may I call on our CEO and co-founder, Steve Torso.
That's so funny. I was literally just talking outside. I think, I'm sure I'm presenting soon. And then I hear, I'm up. Okay. All right. So this session is going to, just before heading into the break, I'm going to be talking about some of the opportunities with WI. Now, in my first session, I laid out my thesis, right, as far as how I see things unfolding. What is so crazy? Just to give me some idea, who's involved in the business exit space in some way? Okay, interesting. So what's so beautiful about our ecosystem is that, and this is what I realized very early on, everyone that's involved, that loves being involved in the innovation space, that only represents a percentage of their time typically, or a percentage of their capital. There's also typically got investments in funds. They've got typically investments. They're looking at business opportunities for sales sites and so forth. So for me, it's a natural, like you're going to see us in November next year, we're going to be rolling out the next stage of the business sales aspect. We're going to do a soft launch for our business sales product. And then next year we'll be a lot more aggressive in February, where we're actually going to be rolling out it completely, and it's going to become a core product. And you'll see for CapitalHQ, we're going to integrate effectively the components of capital raising, debt finance, and then also business exit into the one product solution for founders, for ecosystem, etc. Because to me, what is so frustrating about this space is I see the whole business exit space as exactly how I saw the startup space when we first come in 15 years ago, where it's very fragmented, it's disintegrated, and there's also very little information in it. In fact, one of the biggest frustrations for me about the startup space is that most founders get educated about capital raising. They get told that the capital raising process is send out your pitch deck and then wait for money to come back in, is pretty much the strategy. And in fact, everyone spends so much time on the pitch deck, not understanding the nuance of the relationship process and so forth. So for us, we're all about being an ecosystem player. We're about enabling opportunities. and we're also about education as well. So as I mentioned, one big initiative for us next year is we're going to be hosting a conference called the Business Exit Summit. And that's going to be for the ecosystem and also for companies that are thinking about the process of selling, right? Or involved in a business where, like, who can agree that session with Pete where he was talking about how to structure a business and things to do beforehand, basic stuff like that is fantastic. I can't wait to the session that we do with the panel session with Sam, Peter, and Ken, where we sort of do a deep dive on how they went from seed to scaling and then to exit at that sort of 8 and 9 figure level. That's super exciting to me. So to me, some of the opportunities that I'm going to be talking about in relation to Wholesale Investor is also about this. I want to create opportunities for whether you're a founder, whether you're an investor involved in businesses as a portfolio, or I just spoke to someone outside, they mentioned they've been brought in by their brother to assist, but they're basically been retired for 10 years, they're an investor. Either way, what I've realized, these circumstances and opportunities come about. So we want to create opportunities for everyone as actually part of that. So key things for us, that we've been focused on in 2024 has really been about that ecosystem approach. And today is a great representation of that. So just to give you some idea of where we sit right now, we've got now over 45,000 subscribers. That's across Australia, New Zealand, of course. Everyone forgets New Zealand, but Australia and New Zealand. We've got a channel partner in New Zealand as well. We're also got 5,000 to 6,000 subscribers in ASEAN. So if anyone's ever been to, who's been to any of our events in Singapore out of curiosity? A couple of you. Just as loved in Singapore as here, and people that have been coming to our events for like 5 to 10. Actually, we had a 10-year anniversary for how long we've been going to Singapore now, and it's one of my favorite places to go to. And then in the UK, like if you see in the UK, our investor evenings that we host there, we will literally send out 2 to 3 emails and we'll have 150 people coming along to our investor evenings that we host in the UK. Our emergence in the UK had 450 to 500 attendees at it, right? So it's an exciting time when you take a platform approach to it. The 2 markets that I'm super interested in at the moment personally is India. So I'm part of a cohort with the New South Wales government for India. And then I'm super open to strategic ideas as it comes to the US with big players from a platform side. But also sneakily, without even sort of thinking about it too much, but, just being relentlessly consistent as we are, CapitalHQ now also has its own ecosystem of over 28,000, right? So whilst we've been known for building the wholesale investor side, CapitalHQ has also built its own little ecosystem as well. But everything we want to do is focus around, just improving what we do inside that platform, because to us, the engagement component, these investor events, the online stuff is super important. But as you notice, we're now moving more into the educational side. So to give you an idea, when we actually work with a company, what makes us unique about what we do, because whenever someone becomes a shareholder in my business or they sort of learn about what we do for the first time, immediately in the next 3 months, they keep sending me an announcement of every single platform that gets announced. Now, just to be clear, we've been doing this for 15, 16 years, right? There is no one that I would consider a direct competitor to what we do. There's people with platforms, there's people that do advisory models, there's some people that do events. No one does the full integrated approach into how we've actually done it. So think about this, and also do it on a subscription basis, which makes us unique. So think about this. Has anyone ever been in a business for 15 years and still been able to say that they directly do not have any competitors? That is what's unique. I said people see competitors as crowdfunding platforms. To me, that's not my competitor. I do not lose business to crowd. Do you know when I lose business to? The craziest thing I lose business to is when an investor says to a company that, hey, we're going to look to invest. That's what I lose business to the most out of everything. But the reality is this ecosystem is so much bigger than just one conversation. And to me, it's about creating something that's also bigger. So what I realized was, because my background is marketing, the whole ecosystem's been geared on this approach of send out pitch decks, wait for magic to happen, right? We realized that the approach was how do we create a systematic way to allow investors to engage with opportunities, engage with the founders, get comfortable, and get to hear their perspective, their thesis on what they're doing, because really this whole game is one thing. It's an alignment of thesis. You've got your investment thesis about what you're looking to invest into and what you think is going to be happening. The company's got their thesis on what they think is happening in their space and what they think is the potential opportunity. But of course, a pitch deck doesn't really quite help you sort of understand that thesis. You can only understand that if you get to spend some time with the founder, or if you get to hear, you get to ask some questions. Well, it's like, well, how do we systematically do that through what we do? And this is how everything is being created out of it, and why the next step also we're doing articles on our clients as well, because we want to create different ways for companies we work with to communicate their thesis about how they're approaching things. And we want to give you, the investors, the opportunity to engage with that thesis. And then it's over to you to decide how you want to approach it. You can either decide you agree, disagree, or have a great discussion with them about your own thoughts. That's the way we've sort of thought about everything. But we've productized that in a unique way. Then, obviously, in March this year, we launched CapitalHQ, and we were blown away by the instant sort of take up in how we were actually doing it. And we've just continued to grow from there in building that out. And as I mentioned to you in the first part, the opportunity for this space is around the whole private markets area. Now, if you have a look at this, we've already been dealing, everyone knows us for venture capital, right? What's really interesting is that what most people don't know is that from an actual business perspective, 38% of what we do, of our revenue, comes from funds and financial services. Whereas other people would think it'd be in other areas. But the reality is, all this stuff we are already doing except for business sales. And that's the next big move for us, because that is 10 times the size of the area that we're already working in, but represents a massive opportunity for everyone, whether you're a startup that's actually building a business, whether you're an investor that's involved in startups, some sort of stage, whether it be an exit, whether it be a secondary market opportunity or a full exit. At some stage, those opportunities will come about. Now, of course, we've been working with digital assets going right back to 2013. Independent Reserve was the first company we worked with. They did their seed round inside of our boardroom. When we started doing property as an area, where is it on there? So, companies like Folkestone have been our clients. When they were in 2012, or 2014, when they just become a listed company. Charter Hall has been we've worked some incredible companies in this whole area. And so that's when I look at that, I think this whole private markets opportunity is such a big space for all of us to participate in, no matter which side we're on, whether it be the investor, the business builder, or the industry participant side. And maybe some people will also spread their wings into new areas. We want to play the role in facilitating and enabling that. So to me, everything we're thinking about is how we can enable global access to those private market opportunities and do that on the global front. So that starts for us November 1 on the business sales side, and that's the only missing piece in that. And then we'll continue to scale that out, over the next sort of 12 to 24 months. So these are the unique things. So whenever someone comes up and says to me, have you seen XYZ platform? Have you seen XYZ company? My thing I always go through, I said, do they do this? Do they do that? Do they do this? These are the 6 elements which make what we do unique, right? Said people do 1 or 2 things, but that's really about it. These 6 elements up here, I said, are all different, and it's all done for a reason, because as I'm fortunate enough to have been doing this for 15 years, so I've worked out what are all the friction points, what are all the challenges, what are all the issues, etc. And it's a non-perfect ecosystem, but I understand, I do my best to try and bring all these different parts together. For example, the simple thing, like in the actual deal rooms, of the companies, what we encourage is to provide their significant news announcement. We provide frequently asked questions, etc., to assist investors to get access to what they want before they ask it. Simple stuff like that. The matchmaking component, integrating today's event. The nice part for all of you is every company that features, you've got their information literally sitting inside your phone. You can connect with them directly and then go have a conversation, but obviously set up a time to meet with them directly as well. But all this, I said, we've done our best, and the easiest way I explain it to people is, imagine walking into an investment bank and saying, can I access your investor clients? can you filter them for me so that they're relevant? And then can I connect with them directly? That's effectively what we do. And then on the investor side is, can we do that as well for you? Say, can we filter things so that they're relevant for you based on what you're looking at, what you're interested in? Yes. Can we make it easy for you to access and connect? Yes. So this is the next big milestone for us, which is basically we're aiming over the next sort of couple months to execute on, is that one of the biggest time sucks for this whole process relates to information, whether it be, by the way, we're not aiming to help with pitch decks because that's there's plenty of stuff to do that. But then all the creation of content that goes alongside of that, we're basically building out processes to instantly create that for the founders so that instead of spending weeks and weeks and weeks creating all the content that they have to, it's instantly done for them. But the reason why it takes weeks is because they're doing it after hours, they're doing it on weekends, they're doing it in between, kids related stuff, etc. So it's just trying to facilitate. And then the outcome is that if they can have, potential, if we can make it easy for them to share articles, do investor updates, keep people updated, do social posts on what they're doing, etc., it creates more engagement points for you as the investor side. So some of the initiatives, I'll just go through this. These are, and by the way, I always start with the principles just so you understand where our head is at. The reality is, I think one of the biggest changes in business models coming out because of this challenging period over the last 2 years is rather than everyone trying to do everything internally, everyone's creating the opportunity for revenue share, but because everyone's got either different skill sets, different networks, different access to ecosystems, etc. So we've created these 3 principles to think about how we think about things. And then also to get feedback from industry, from investors, from companies, etc., on how we can actually make this more streamlined, etc. So that's the next stage. And then obviously, this direct access to our ecosystem, the reason why we do that is because we know that no one else is willing to do it, right? Very few are willing to do that because everyone wants to try and tie everyone in for different success fees and so forth, which is fine if that's what they do. But we actually want to empower what they do on the reach out part, on the engagement component, etc. If we can make everything more accessible, if we can remove friction, if we can create more financial opportunities, whatever hat you're wearing, then the whole ecosystem wins, right? So that's how we sort of think about it from our product perspective. And then this is us, really moving into our role as a marketplace in creating more online opportunities, offline opportunities, and then also just leveraging what we've built because obviously software is infinite in its capacity and what it can actually handle and what it can do. So hence why we want to keep on creating more layers of opportunities across those different sectors, across those different areas. So a few things coming up. The big one I'll sort of talk about from today that I'm happy to chat with people about. Obviously we've got our channel partner opportunity, which is also aligned with our enterprise solutions as well. But the channel partner and enterprise opportunity is really around how we can work with, whether it be really active fund managers who are across multiple deals, or really active advisors who are also across multiple deals, because the reality is most advisors will turn away more deals than what they can ever handle just because they don't have access to investor ecosystems. Well, we want to leverage that because there's lots of skilled advisors not working on opportunities because of their lack of access to additional investors. So hence our role in facilitating that. But the vertical solution, as I mentioned, will be really focused around business sales as a starting point. And then we'll also look to create a product specifically for fund managers and family offices. But the first step is really around that business sales because it just represents such a big area. And it's the natural conclusion. If you think if you think about for us, for example, we've now worked with, I think it's 73 companies which have gone through an exit at some stage. So whether someone's looking to go through an exit via IPO, via M&A, or if they're looking to get access to debt funding, the role for us is just to facilitate that as a capital engagement solution with CapitalHQ. And we want to come out with pricing and so forth in such a way where it's just affordable for companies to set themselves up right and be prepared as they go through this actual process. Now, the scaling globally part, I won't talk too much to, but as I said, we do have master license opportunities available for different countries. Hence why I'm part of that cohort with India as an example. We're open to discussions around the US. Singapore, we've got fairly well covered. The other area I think is very relevant is obviously the Middle East, because there's obviously a lot of capital looking to find a home from the Middle East. And then the last one is more on the enterprise solutions, in that we think there's a great opportunity to work with the industry on their opportunities. So one of the things I'm super excited about this year is we've got a relationship with Innovise. Innovise are probably Australia's most successful deep tech, technology transfer company, and basically taking deep tech ideas, turning it into an actual commercialized solution, and then going through that process and listing on exchanges, and yet no one knows them because they just don't do media. They literally just do deals. And what's even incredible is they're engaged by NASA to do consultation on that tech transfer process. Some of their companies that have exited now, they've got, I think, 4 companies that have exited at 9-figure sums. And yet, who knows of Innovise? Because they just not done incredible work, but just don't sit inside the journalist's ear at the AFR, selling what they're doing every day, but yet one of Australia's most successful companies in that space. So that's the sort of area where we want to spend a lot more time in. Life science, renewable energy, agri-tech, all those sort of focuses that will be strong areas of opportunity over the next decade, we're looking to be involved in. These are the events that are coming up. We've got our Future Disrupted Conference. The Future Disrupted Conference is one of my favorite conferences to host each year, because in my slide I talked about the areas of innovation that I'm excited about. Well, this focuses around the 5 platform technologies, and 5 areas, whether it be energy storage or the energy transition, robotics, AI, genomics, life science, because there isn't too many genomics companies in Australia, and I'm missing one. Life science, energy, robotics, AI, and energy storage. Oh, blockchain. Sorry, you're right. Web3. Blockchain's the other one, right? So that's going to be, that entire conference is just focused purely around disruption, and is we hosted it last year, incredibly successful. If you like today, you'll absolutely love this, because it's just nice to sit down for a day and just absorb into where is everything going from an innovation perspective. And we'll be bringing the people together that are actually leading this change, whether they're founders or investors, into that actual conference. And then next year, we're going to be hosting our Emergence 2025. Emergence is the biggest thing that we do each year. We'll have anywhere between 500 to 1,000 attendees at that. We will be hosting it at the Four Seasons event. If you came to our last Four Seasons event, which was our venture and capital, it is an incredible venue, absolutely beautiful. It's perfect for a 2-day function like that. So that'll be Feb 26 and Feb 27. That event covers everything from innovation, private credit, small caps, and also we'll be adding private equity to that event as well. So everything we're doing, I said, we're lining up to cover all the areas of interest for us from an opportunity perspective. From the channel partner side, if you'd like to have a chat with me more about that today, happy to have a chat. We've created a structure where effectively industry can work with us, or advisors can work with us. So whether you're a lawyer, accountant, corporate advisor, consultant in this space in some way, shape or form, we create a revenue opportunity for you out of it, whether it be with CapitalHQ or whether it be with Wholesale Investor directly, right? And then as part of that, you get access to, effectively multi-company management. We've got things like, obviously, our targeted dedicated emails, promoted and hosted information sessions, CEO interview, all the things that you see us do, inside of, all the things that you see Wholesale Investor do every day. We've incorporated that as part of our enterprise, offering, so that we can really, as I said, enable those that are working with companies that are looking to access capital or that are looking to engage with investors over a period of time. We've just built We've built a specific opportunity around that as well. So happy to have a chat with you about it, and we'll obviously send some more information about it tomorrow. So feel free to express interest. I'm going to do something very, very rare and actually finish ahead of time. But look, as I said, I know I said this when I first started this morning's session. There's no doubt, whether you're a small cap listed investor, whether you're an innovation investor, for the ones in private credit, you've had a great last sort of couple years. And likewise, if you've been involved in sustainability in any way, that's still been a strong growth area. But the reality is it's been a hard market for a lot of people. But the truth is that the foundations are setting up really nicely for what comes next. None of us really know what the full trigger is, whether it is interest rates related, whether it's US elections related, whether it's just market sentiment and cash starting to come off the sidelines. We don't really know what that trigger is to put everyone back into bull mode. Even though markets are up, as I said, stock exchanges are at sort of peak levels at the moment. Specifically, I'm talking about this innovation era. And outside of obviously the Magnificent Seven. When it does, it's going to be super interesting because you're talking about businesses that have learned how to operate lean. You're talking about utilizing software and AI tools which allow them to increase their own product. Like it's absolute, as I said, it's an unfair advantage for everyone in what they actually do. And then you're talking about building teams based on software and their AI solution capability, more so than just one skill set they have. So what teams can do becomes fundamentally phenomenal. So I'm really excited about what comes next from all the layers, whether it be innovation, whether it be private equity, whether it be private credit. There's opportunities for us all over this next period. And likewise, I hope that maybe there's some people that are just investors at the moment and you want to start working on the advisory side. Or if there's professional service providers that want to start being more active in this ecosystem. We just want to provide the solutions and assist with that enablement aspect, whether it be at our events, whether it be online, whether it be from our software. We just want to keep on removing friction from this process. So on that note, I appreciate that I'm getting in the way of between you and food. So I am going to finish my presentation. I want to say thank you for coming. Now look, what's coming up, I'm just going to tell you, like the panel sessions we've got coming up are absolutely ridiculous. So the first one is come back at 12:30. I'm going to be hosting the panel session, which is around maximizing value, the art and science of business exit. So it's going to go deeper into the actual process of building a strategy and building the highest sale value for companies. Then we've got 3 more presentations after that. And then my favorite presentation I'm looking forward to today is at 1:30, and that is from seed to scale, accelerating startups, basically going from seed to scale to exit. I said, all the people I know in this panel, I know them all personally. One of them's been an incredible mentor for me. One of them's been someone that literally I met 2 months ago at one of my events, and it's actually already given me incredible value for my own business as far as what I want to do. I said that session is probably one of the most valuable ones that I will host because these guys, and I said, knowing all their stories, they have absolutely been through everything, through navigating COVID, through navigating all sorts of financial issues, through navigating bad shareholders, everything, you name it, they've all been through it and been able to achieve a high value strategic exit. So pumped about that session. And then obviously more presentations, got some incredible companies featuring in the last session, which I know, said they're all got really, really strong growth tracks. And then finishing with a keynote presentation on scaling AI, which I said, Yash, I swear to God, I could just chat to him for hours just on ideas. Yash is phenomenal when it comes to AI, and everyone needs to understand this because it's not if it's coming, it's not is it's overhyped. Forget all that shit. It is about absolutely relentlessly scaling and getting a life back. The part I didn't talk about, do you know how nice it is for founders to be able to be absolutely maximize your productivity and actually go home to be a dad or be a husband? It's one of those things we've never really had before as founders and as builders of businesses. And then the last one is the innovative debt solutions. Such a prominent area for everyone and relevant to anyone in this space because at different times, different companies require different solutions. And as companies become more profitable, debt becomes more relevant because obviously it's a cheaper form of capital. So that is the day ahead for all of you. We're going to be kicking back off at 12:30. You've now got an hour of networking. Make sure you see all the companies in the exhibition area. So I hope you've enjoyed the presentation so far. Enjoy lunch and see you in the next session.
Okay, let's jump in next. So I hope everyone had a good break. Now let's get ready for an engaging panel session about maximizing value, the art and science of business exit. Please join me in welcoming our moderator, Steve Torso, CEO and co-founder of Wholesale Investor and CapitalHQ. Next one, please come to the stage, Rob Antulov, Managing Partner at Modus Partners, and Neil Bourne, Managing Principal at InSquare.
Okay, welcome. We're live. We're not singing today, Neil. We aren't. Wrong, exactly. Okay, so welcome everyone. So this session's focused around sort of building towards a high valued exit, and obviously I've had a really good start. Everyone seems to have enjoyed Rob's session this morning, and to me, this has been something that we think about a lot as founders, and it's something that I've been fortunate enough to have conversations with these two gentlemen during WI's time. So going forward, in this discussion, I want to touch on, some of the key areas that I suppose owners, investors, and so forth, because pretty much shareholders have a role in the way in which they work with companies, in that they can give guidance or give suggestions or give ideas to the founders that they're working with. So this session's really around sort of structuring and preparing for that. So as a first point, I'll get Rob to do a bit of an introduction to himself, and then I'll get Neil to give a bit of an introduction to himself.
Easy. Is this on? Yep. Rob Antolov, Managing Partner for Modus Partners in Australia. Modus Partners is a tech-focused corporate advisory boutique, a small office in Sydney and a small office in Singapore. And we basically serve the Australian and Southeast Asian markets. But we have clients typically from those markets, but with investment or acquisition partners from anywhere around the world. I've been doing corporate advisory for about 15 years or so. Prior to that, I ran a tech startup. Prior to that was my last corporate role. I was head of strategy and M&A at Fairfax. And I've got a sort of a tech background. So the majority of my career has been in technology, and the bulk of, or in fact, all of the advisory work that I do now is in tech or media. And typically the transactions we work on are in the $5 to $50 million range. So.
Thank you, Rob. So I'm also Neil Bourne from InSquare. We're also a corporate advisory group. We specialize, I guess, in companies in the sort of $10 to $200 million enterprise value layer. We have a strong emphasis on cross-border transactions. So we have partners in our group in America, Canada, Europe, and across Asia. My interests are also technology. I've been doing corporate advisory, either raising money or selling tech companies for about 20 years. Prior to that, I was at a venture capital firm. Prior to that, first career, I'm an electronic engineer and worked in techie roles in IT before my MBA.
Perfect. So one thing that was discussed earlier today, which I thought was really interesting, because in the capital raising area, we find that 80% of the companies that we deal with don't have typically an advisor attached to them. Often they're doing their own capital raise. And in Rob's session earlier, he mentioned that one of the things that if he's looking to buy a business, he likes sort of dealing with an advisor. So I'll kick off with you, Rob. You've worked with over sort of 70 different companies. What are the common mistakes that founders and entrepreneurs make when planning an exit, and how can they be avoided?
I think the key mistake that's made is that the planning and the preparation phase commences too late. I think entrepreneurs who are looking to exit or potentially looking to raise as well, but in the context of sort of exits and trade sales, it's often the case that business owners, entrepreneurs decide they want to sell and set themselves a time frame, which is sort of a 6-month circa time frame, and that's about the duration of a typical trade sale process. So in effect, they are seeking to kick off a process as soon as they've decided they want to exit. And in reality, a preparation that could last 6 months or even 2 years prior to that is a far better way to set up a successful transaction, to optimize the value of the transaction, to ensure that the business is positioned appropriately for the best potential new owner of that business. So that, in my mind, that's one of the keys. I love to work with my clients 2 or 3 years before they're ready to exit, rather than 2 or 3 months before they're ready to exit. It allows me to add a lot more value to the overall process. The comment about doing capital raises themselves also applies to exits. So, there are a number of advisors who will compare their ability to sell their own business with engaging an external advisor. And sometimes the role of the corporate advisor is it's an amorphous one. It's sort of like a project manager across a lot of different areas. And business owners will often understand the role that a lawyer might play in a transaction or the role that an accountant might play, but don't always fully understand a role that an experienced advisor might play in a transaction. So our advice is to our clients and our potential clients is always to engage with an advisor, because that is far more likely to increase the chances of a successful outcome.
So when you start working with a client, what are the sort of key things that you're thinking about? What are those critical aspects or critical steps that you're thinking about to take first with a client to at least start the foundations for that process in achieving a higher value?
Having the numbers of the business in order is just imperative. It drives so much of the ability to build a sort of a narrative around the potential sale or the sale process, and it goes to a large degree, it goes to some of the key issues that a potential buyer will look at. So having the financials in order is imperative, and sometimes that's in a sense as simple as fine-tuning the historical financials. But the reality is that if you give yourself 2 or 3 years to prepare for an exit, then getting the financials in order actually means getting the shape of the business in order so that you're positioning the business to match what a likely acquirer will look for. And that could be a stronger top-line revenue growth. It could be a shifting of the revenue from contract project-based revenue to contracted recurring AR type revenue. It could be a margin expansion over a couple of years. There's lots of ways to prepare the business to optimize for a transaction if you give yourself a couple of years. Getting systems and processes in order. I've seen clients replace their ERP or their accounting systems a couple of years prior to an exit so that they've got a strong financial platform on which they're building their business and from which they're selling it. So there's lots of activities like that surround the numbers, and then getting the story right, understanding where the business is likely to be sold, understanding who is the next natural owner of the business. Every entrepreneur and most business owners believe that they're the current best owner of that business, but understanding who is the next best owner of that business can be really evaluating in the process, because it allows you to either position your business in a way that's appropriate to appeal to them, or target them at the appropriate time. So a lot of that comes back to preparation, numbers, systems, strong bench, a strong management team, because if the entrepreneur is the leader of the business and they want to exit the business, then having a strong bench is critical. Otherwise, it'll mitigate against the valuation of the business.
Perfect. And for you, Neil, you've obviously worked with a lot of companies going through the exit phase. What do you see as the sort of main operational challenges that companies or tech companies face during that exit process, and how can they be sort of proactively managed?
Well, in answering that question, I guess I'd qualify it by saying it does depend on the scale of the company. One observation I would make, I'm asked by many software companies, would like to sell, we think we're worth 3 to 4 times sales, because we've been looking at the comparables on the NASDAQ and perhaps haven't the interaction with or regular interaction with buyers. We don't realize that there's a massive discount for companies of below a certain size. So for example, with a software company, if you're below 5 million, you're not going to get anything like the kind of multiples that you're going to get if you're at 10 million, 20 million, 50 million. I mean, we do occasionally come across very extraordinary situations where you see this tiny company bought by Google for some fantastic number, but that's really the rarity. So coming back to your question of how do you prepare? Well, Maybe I'll pick up on one thing which Rob mentioned, the word story. What is your story? What are you selling? So if you are a $5 million company, are you a $5 million company that's heading to $10 million? And you've got the elements of that story in place, which you can sell and therefore attract. Or are you a mature company? Well, there's nothing wrong with being a mature company. You just need to understand that's what you are and have a realistic expectation. If you are a mature company and you aren't wishing to put in the energy to take yourself forward, that's fine. But let's have a conversation fairly early on about your expectations of what you're likely to get. I guess a lot of my role as an advisor, certainly in the early days of the engagement, was shaking the chains of this future, which says, look, if we run out a process, this is how long it'll take, this is the work you have to do, and this is likely what you're going to get out of it. Now, I'm not the buyer, it's not my cash, but I can tell you pretty accurately the range of where your offers are going to come in to. And one of the important things I've learned through doing this many times, it's very important to have those conversations up front, because often business founders, if they've been working in the business a long time, their expectations on what the business is worth is sometimes emotionally driven around, well, what I want to do next is I want to do this and I need to pay off my mortgage, I need to do this. So it's kind of set from the internal. And if you go to a valuation company, you can get a technical valuation on your business. Well, that's great. But ultimately, when the M&A transaction, it comes down to what is the market prepared to pay. And
how much reliance does anyone play on those technical valuations that get done?
Depends on the context. I mean, in a divorce, perhaps that might be used in that situation. But if you're waving that around and expecting sellers to take notice of it, nothing, because it comes.
We've had that same in the capital raising area as well, where companies have got these technical valuations done. They're being told they're worth $50 and $100 million, and you're like, literally no investor will agree with you on that.
Yeah, no, so it's kind of meaningless, and actually, what it signals, it's like putting a sign you say, "I'm not actually commercial." So that's usually not very helpful.
So you walk in the door, Neil. You've basically been engaged by a company. They've said to you, "Hey, we want to go through this sort of exit process." Like sort of Rob detailed what he's thinking about. What are you thinking about? What are the first three go-to things that you're thinking about for that company on the story, the positioning, what you need to do, what you do successfully?
So I'm typically working backwards, which is when I'm meeting a company who says, "Look, I'm thinking to sell," I'm first thinking, who's going to buy this company? What's the audience? How do we? I'm really taking a product perspective. Say the company is a product, and if we want a successful, competitive process, which will drive up the likely pricing to the upper end of the range for what this asset's worth, how are we going to reach that? So I'm thinking. So, firstly, I don't want to take on a company that I can't sell. So I'm firstly thinking, is it sellable at all? Then fairly early on, I'm thinking, who are we going to sell it to and how are we going to reach those kind of people?
And do you have in your mind like a framework of like, if I go to this kind of buyer, I think I can achieve this. If I go to a financial kind of buyer, I can achieve X?
I think most people who work in our field, and certainly Rob would be the same, if you're working in a particular sector and you're selling, you get the repeat experience, so you know what the software consolidators are paying, you know what private equity are paying, you know the kind of deals. So you have a fairly good idea of what market is because you've got that repetition.
And the curveball comes with a strategic buyer who has synergies. So a lot of the conversation today has been, what does the business do to prepare itself?
That's the dream for every founder, isn't it? It'd be the strategic buyer that's willing to pay more.
Who's willing to pay more because they're willing to pay away some of their synergies in order to to get the right outcome. And so sort of Neil's comment about understanding who the buyer is critical. A strategic buyer will typically pay higher than a financial buyer because a financial buyer is, in a sense, backing their own judgment to take that business and grow it from either additional or existing resources. But a strategic buyer should have some synergistic benefits, and if they're willing to pay away some of that, then the vendors might capture some of that upside.
How would you describe the types of buyers right now? You've just described financial, you've just described strategic. What are the other types of buyers there are of potential companies?
Well, if I may, it depends what people are buying. So
we're going free flowing now on that. Let's go.
So a financial PE buyer has a lifetime on their fund, and they need to basically buy well, grow it within 3 to 5 years, and exit it in order that they can continue to raise a fund. There are funds who are lifetime hold funds who are basically looking at basically building a portfolio of cash flows from fairly stable businesses that they intend to hold and monetize for a long time. There are strategic buyers who are looking just to add revenue, so it's like a protein buy. And you have capability buyers who are looking to buy to maybe fill a product's missing, maybe fill a gap in their technical stack, maybe something else. You have people who buy customer bases, who basically, do you remember the ISPs a few years back ago? I mean, everyone was just buying them because they just bought a customer base, and they had very standard metrics about how they do that. Now, my point being, as an advisor, you need to understand what people are buying in order that you can understand the value of the proposition to them. But one last point I'd make. When you're selling, it's not necessarily all about the price, because people sell for different reasons. And certainly in the tech space, sometimes it's not unusual to have a company that might have the kernel of what could be a really, really major business, but they don't have the resources, and they don't have the wherewithal in terms of management talent and skill to take that global. And it is one valid strategy to say, you know what, let's go and find a strategic partner and essentially sell yourself into that, which is you're taking on the project and growth project, and you're looking to be taken up and supported by that. So it's a very different type of sale to a financial sale, which is about an individual exit.
And just quickly on that, sorry. A lot depends on the deal structure as well. So both a strategic buyer in a trade sale or a financial buyer like a private equity firm or a family office could structure deals where there's upside left for the vendor. So in a strategic acquisition, there's often
defined as an earnout.
So on the strategic side, it could often be structured as an earnout. Yeah. Vendor might sell 70% today and 30%, 15% over the next 2 years, etc. But in a private equity transaction, it could be a majority purchase by the private equity firm, by the financial investor, but the vendor could maintain their equity stake and continue to run that through, maybe with an option to sell, or likely with an option to buy-sell option 1 or 2 years down the track. So it could be that transaction today is at a lower val or a lower valuation metric, but both parties believe that by working together, they can increase the val dramatically, and that therefore the vendor might effectively retain some of the equity and capture some of the upside along the way. So it's not just the valuation today that a vendor needs to think about, but it's the overall consideration.
So what you're both saying is effectively when you're structuring these deals, there's no really set rules. There's who is the seller, who is the buyer, and then there's flexibility around in which the final sort of deal is done, depending on who you're sort of targeting, who you're selling to.
Well, taking that further, if you understand the buyer, the deal structure tends to flow from that. So if you are private equity and you're not looking to run that business yourself, you're backing the founder. And so if you're a growth private equity fund or even a buyout fund, and you're seeking to keep the founder motivated, you're going to structure a deal that, to the points made previously, that you can say to the founder, look, you're doing okay on the first deal. Happy you can pay off your mortgage and all the rest of it. But hang around and drive for growth, and you will make as much, if not more, on the final exit. And that's the story that's being worked together in that kind of exit. There are other sales where basically the person is just checked out and they want to hand over for car keys. It's a different construct and different deal structure typically that comes with that.
So this is for both of you. What are some of the common misconceptions founders have about the actual valuation process in the technology sector? Who wants to start? Look at them both jump.
Well, I'm just going to say delusional expectations is probably the thing. I'm not sure this is the right forum to kind of say that because everyone
Go for your life. That's why we're doing it.
And people show you your baby. Oh, what a lovely baby. One of the challenging
My baby actually is cute.
Conversations up front is what's it actually worth? Well, in two things. That aspect of it is worth what someone will pay, pretty obviously. I see a big part of being an advisor is providing that feedback that says, look, yes, I'm not writing a check, but I can tell you pretty accurately what it is worth today. And to Rob's point, if it's a story that's still maturing, if you were to make these changes, what could it be worth? And maybe that is a catalyst to taking some decisions which perhaps have been put off. I mean, people do get comfortable in a situation. You grow up, you're paying yourself a reasonable salary, you're maybe running some money for your business. It's all pretty comfortable. And then you start thinking, I'd like to do something else. It takes time to put in place the structures. Maybe it's organization you need to bring in. If you are thinking that you are wishing to exit from the business, well, who's going to run the business? Have you actually developed the talent within the business you can run that? Have you built the processes? Have you got systems? Have you cleaned up the mess? Have you got rid of that boat which you bought for your company because that was the kind of seemed like a good idea at the time? All that kind of stuff.
Got it.
Just quickly on valuation expectations, the majority, the bulk of the work I do is in tech. The majority of the clients I have in tech are relatively high growth companies, and relatively high growth companies tend to sell on a higher multiple because they've got relatively high top line growth, hopefully some bottom line growth as well. And it's a really tricky dynamic between a vendor, an entrepreneur believing their business is worth 100 today, 100 units, getting an offer for and believing it'll be worth 200 next year, say, and getting an offer that's less than what they expect today because the purchaser doesn't want to pay away tomorrow's value to today's transaction. So there's this tendency for the entrepreneur, and appropriately, to believe that their business, that their baby is beautiful, that their business is highly valuable, particularly because they can see stuff that no one else can see, which is their vision of the future. So they know at the core of their heart, because they have to believe it, because they live it every day and they get up every morning and reaffirm to themselves that they believe that this business is growing at that rate, that they want to sell tomorrow's business at a valuation that's reflective of having achieved those outcomes today. And sometimes the buyer will accept that and actually pay extra today because of the tomorrow's growth rate, but that's not always the case. And if there's a mismatch, then the entrepreneur goes, well, I'm not selling. I know it's worth 40 and they're only offering me 30. And so I'm going to hold it for another year and it'll be worth 50 and then I'll sell it. And sometimes they sell it for 50 and sometimes they sell it for 25, right? It depends on the market, timing, dynamics, demand, etc.
So if you guys are running a process and you're taking it to a larger corporate, right, a potential sort of corporate buyer or a larger sort of listed company, what have you found have been some of the negotiation sort of strategies or tactics which have, I suppose, either set the foundations or created the pathway to achieve a higher valued exit?
Well, I'll take a crack at that first. I mean, first, it's important to realize if your revenue is, let's say, only $2 or $3 million, you may not get the interest of the corporate buyers to even respond. So it's not infrequent with a relatively small company to get through to the corporate development people, and they'll just say, look, it's not worth my time to do the transaction by the time I've paid my lawyers and all the rest of it. And by the way, that corporate development guy has probably got a bonus tied to maybe acquiring $100 million worth of revenue each year. And so you're just not, they might be, look, it's a really interesting company, come back really bigger. So you're not even going to get the audience there. So coming back to the thing of what can you do to increase your value? I'll come back to the story aspect. Have you actually thought through what this company can do for that particular organization? So the way the process will work inside the corporate is that somebody, and it's usually the corp dev team, will put together a presentation that they take to the board, which is the rationale of why we should acquire this business, how it's going to fit, how it's going to work and integrate with the organization. Now, if you're smart, you try and, through intelligence and speaking to these guys, work out what those slides need to look like, and you write them for them, because everyone's busy. So if you can put it on or maybe repoint, a big corporate buyer will have a list of maybe 100 targets that it's looking at any one time, which are being shuffled for priority of whether to get money or attention. And it's if you can make yourself easier to buy, which is look attractive, you've got rid of the hairs of the dog, so you've cleaned up anything which would make it a tricky transaction, and you've written a story for them, and you've presented that story in an easy-to-digest form, you're going to more likely to get to the top of the stack. And the simple name of the game is that you want to be on the top of the stack for 2 or 3 people, and then you're going to drive a high valuation.
Just on the point of negotiation, one of the things that I'm sure Neil as well, one of the things that we focus on is trying to run a competitive process when we're managing an exit process. And if the parties involved know that it's competitive, and they'll know that because they'll understand they're in a process and there's timelines that have been set, and they'll know that there's structures put in place to manage multiple parties going through a process like data rooms, etc. If they know that they're in a competitive process, even after they've made an offer and even after that offer has been accepted, they'll be aware that they still need to, if you're then progressing through into the more detailed due diligence, etc., they'll still be aware that they've put forward an offer that's been accepted in context of a competitive process. And setting up that frame is really important for the negotiation, both for the term sheet, for the initial offer, as well as subsequent negotiations over the detailed transaction. I talk about a 2 or a 10-page term sheet going to a 200-page legal document, and that transition involves a lot of negotiation. So understanding that the counterparty understanding that they're in a competitive process throughout is really important. Otherwise, the power shifts to the buyer, because they're the ones with the checkbook, rather than the seller, who sort of have to, in a sense, accept what they're being offered. But fundamentally, from a negotiation point of view, my view is that the better the preparation, the more likely it is that me, as my client's advisor and their appointed expert negotiator for this transaction, the more likely it is that I can negotiate a quality outcome, because I'll understand the underlying context of the business that I'm trying to improve the valuation of, or the terms associated with the deal. But in that preparation phase, we also try to understand who the buyer is specifically. So if the buyer is, let's say, Orijin Energy, for example, who was a now announced buyer of a former client of mine, understanding who their corp dev guy is, understanding what transactions they've done recently, understanding the methodology that they deploy, whether or not they structure deals, etc., having that knowledge, or at least understanding their strategy and understanding what's important to them, all contributes to negotiating a sort of a win-win outcome. So
the for the final sort of 4 minutes and 7 seconds, what are some of the trends that you guys have observed over the last the last 2 years have been tough from an innovation perspective, but I'd love to know what are some of the things that you have observed from the buyer side as far as their appetite, what they're looking at, how they're thinking about sort of structuring deals, what options they have, etc., or who's most active in the market, etc. What's your sort of observation?
I'll have first crack at that. So from my perspective, in the last kind of 5 years, the big shift in terms of software companies has been the emergence of private equity as a major buyer of software companies. So we're seeing probably about 50% of transactions in the software space being private equity, and often that might be at the first stage, or it might be private equity selling to private equity. Second, it's the emergence of software consolidators. So people may in this room be aware of a Canadian company called Constellation Software.
We have talked about them a fair bit this year.
Yeah, okay. So Constellation now, I think, has about 20 different business units looking at different verticals. It's been around long enough that the early employees of Constellation have now gone out and raised their own funds. So there's probably in Australia operating now about 12 to 15 software consolidators with different strategies looking after different things. So you've got this emergence of these evergreen buyers looking for software companies. And so now when we're running a process, there's always a section for, okay, we're going to be talking to consolidators, which PE firms are we going to go to, and which strategics are we going to go to?
In the broader tech landscape, about 2 or 3 years ago, valuations in the US were super high, at a relative high, a sort of 5-year cycle high.
The good old days of 2021 and early 2022.
Yeah. Sort of post-COVID, the valuations went up. Listed tech companies, private tech companies, transaction multiples for B2B SaaS companies were through the roof. Companies were being priced at significant revenue multiples, let alone earnings multiples, etc. When that changed in the US, a few seconds later, it changed in Australia. So the impact of that for a year or so was that vendors still had high expectations, but acquirers and investors for capital raising moderated their valuation expectations according to the market. Everything else became cheaper, therefore private equities became, have to become cheaper as well. So listed companies and private companies. But in the last year or two, and venture capital funds and family offices and even high net worth individuals sort of held back on their investments, kept their cash, because as long as there's some volatility in the market, cash is more valuable than when there's capital abundance. In the last year or two, more funds have raised capital, more investors have come out, both as strategic acquirers and as investors. And there just seems to be more green shoots in the market now at the capital raise investment level, but also at the M&A level. So I think that the last couple of years we've seen sort of the peak and maybe not the trough, but certainly coming out through into a new part of the cycle. And that's sort of exciting for us in sort of M&A advisory land, because there are transactions that will happen and there's more demand for good quality assets, and vendors have got more realistic expectations around pricing, etc. So.
Brilliant. And in the final time, I'll just say that from our side, the observation from me, and I mentioned this morning, is a lot of the people that I've known from the venture and innovation space are now looking to basically either create opportunities or get more involved in the business exit space as well. So that's been interesting from my side, and you can even see, and the nice thing from our side, it's sort of one and part of the same ecosystem. I know a lot of you guys are involved with companies that are either thinking about an exit process or going through an exit process. So just on a fishing note, I just want to say a big thank you to you guys. Just so you know, we literally got through 1/3 of our questions. So we literally could have gone for an hour and a half. Thank you so much, guys. I'd love to do this again with you another time. That was a really, really good. We didn't even get on topics about, integrate, stakeholder management, going through the exit process, etc., post-transition, all that stuff we wanted to cover. But hopefully we can do it another time in another session. Thank you so much.
Thank you.
Thank you to our panelists for that interesting discussion. And now let's resume our company presentations. Please join me in welcoming Adam Good, founder and CEO at Auric Essentials.
Hi, everyone. So I'm Adam Good. I'm the founder and CEO of Auric Essentials, a company poised to revolutionize how you think about wellness technology. So in today's hyper-connected world, balancing life and balancing your life in this environment is extremely difficult. Those various different mood states you need to jump between, being focused, being energized, having a good night's sleep. Even the most health-conscious individual struggles with this constant ability to do this. Now, we've got visual aids like Netflix to help us relax, or music to do the same thing. But one of our most primal senses is very, very much under-indexed, and that's the power of smell. Now, aromas, especially those from nature, can profoundly impact our well-being. We know that the ability to regulate our moods, they solicit memories, and they provide emotional responses. And this is what we're doing at Auric. We're building and introducing the Auric Aromasphere. It is a beautifully designed, highly personalized IoT platform that blends the evocative power of scent with cutting-edge data-driven technology. I want you to imagine the elegance of ESO, the functionality of a product like Sonus, and the simplicity of Nespresso all brought together in one device. Now, what the Aromasphere does, it's equipped with 8 TGA-approved essential oils, and they're uniquely created to blend these rituals together. Now, the rituals are from scientific research to help with sleep, with energy, to help with anxiety, and they support these distinct mood states that we require, such as sleep, focus, relaxation. And the Aromasphere really gets rid of those key friction points with the aromatherapy industry. They're messy to blend. You're not quite sure what oils to use at what particular times, and it's certainly very low tech and not connected. And this is what sets us apart. We've got this Auric wellness signature. It's an algorithm that adapts in real time. It takes data sources from your calendar, from weather conditions, also biometrics such as Apple Health, Google Health, and combines that with the combination of your health questionnaires to actually deliver these bespoke rituals delivered at points in time. So if you'd think of Auric, it is really a mood as a service. If you and it can be the centerpiece of your daily habits. It's for the bedroom or the home office or the living room. So imagine at night time you're preparing for bed or thinking about it. The Auric Aromasphere will deliver a sleep ritual at that point in time. It's connected to other IoT devices in the home, so the lights dim, music can play. You might get a dash of lavender, peppermint, and bergamot. And through this sort of Pavlov's dog sort of theory, you will actually be triggered to get ready for sleep. So the growth drivers in this area is really the wellness industry. It's growing at a very large clip. It's about $4 trillion industry. We've got wearables now at over a billion users of wearables. And this convergence of your home IT, IoT technology in the home is also growing. But really, scent as a product category hasn't really been tapped into at the moment. So this idea of connected aromas for their therapeutic mood enhancement is an area of growth. What we're tapping into is sort of the convergence of 3 markets: the $1 trillion IoT market, the aromatherapy industry is growing at 13 billion, and then they've got the wearable wellness tech industry. And we see a TAM of $1 billion, and we're focused in on a 5-year plan of a sum of $100 million. It's a hardware recurring business model. So the device is at $299, which comes with the 8 therapeutic oils. And then from there, you go on to repeat purchases, which are high margin business of essential oils. You can buy one oil at a time, like you might do with a Scent Founder subscription, or we're moving people towards more of the subscription-based model. The founders, myself, I built a hardware recurring business model at Telstra some 12 years ago when streaming television was at its infancy. So we know about finding the right audience and the right product market fit. Alex is a robotics engineer, and we've also got a pretty incredible product team, including Eric Aldrin's part of the Meta team that's been doing the HoloLens work, as well as biometric experts, and Robbie Wells, an industrial designer from Breville. So competitive state, we're really, the aromatherapy industry and the essential oils with companies like Del Toro, Young Living. You've got your wearable sort of partnerships as well. We're more into this highly personalized, multi-sensory experience, working with the Google ecosystems and the Apple ecosystems, Philips Lighting, those type of products. Traction-wise, we've already had 45,000 in sales. We've got about 1,500 people in a wait list. We've recently been funded by Antler. We've been in this residency program downstairs, building this product out. Our manufacturing, our trademarks are all secured. And we've also secured a major media partnership with The Block. The block next year, we love that show, 1.8 million, 2 million users. They're doing a wellness season next year in Dalesford, Victoria. So 2 of the contestants will be wired up with the Aromasphere. That's a very large audience, 1.8, 2.6 million people. That'll really show what this product is all about, working alongside sort of new technology. We are the Australian Startup of the Year. Next week, we're off to represent Australia at the Entrepreneur World Cup in the Middle East and Saudi Arabia with our product. So thank you very much for the time. What the ask really is, we're halfway there of our $500,000 seed round. We are early stage, but we will have 3,000 units out on the cloud this time next year. So we take check sizes anywhere from $25,000 upwards. We close this out in the next couple of months. So that's Auric. We're at the forefront of personalised scent technology. Thank you very much for your time.
Thank you, Adam. And now let's move on to Harness Projects. Please join me in welcoming its co-founder and CEO, Chris Ventura.
Hi, everyone. Good afternoon, and thanks to Steve and the team for putting on today's event. My name is Chris Ventura. I'm the CEO of Harness Project, which is a global education and talent company. In 2018, we founded Harness Projects to bridge the gap between education and employment. We believe in a world where individuals can learn by doing on real-world projects to showcase their unique attributes to employers, and for employers to validate that unproven talent and make sure they don't gamble on new hires. So our mission is twofold. For our students, we solve the classic job experience conundrum. That is, you can't get the job without experience, and you can't get experience without the job. And on the employment side, we help hiring managers try before they hire, observing talent in real-world work environments so they can make a really important critical hiring decision. Perhaps nowhere is this more pronounced. So the future of AI has been talked about today, and we know it's going to reshape the future of our worlds, but perhaps nowhere is this more pronounced than in education and employment. Many will need to pivot their careers, and for those earlier in their careers who haven't had the time to spend building their experience or their workplace skills, the education to employment gap is only going to widen. So our model helps to build resilience against this disruption incoming from AI. So there's a lot on the slide. So we designed a real project learning framework that directly integrates company projects into the student learning experience, allowing students to build real-world experience and skill training all in the one course. Project experiences are where we build our technical skills, but also where we build our behavioral skills, things like critical thinking, communication, collaboration, and adaptability. These are the skills that make someone really great to be a part of your team. Now, in this example on screen, this is our UX design program, where our students will complete 3 projects with 3 individual companies. Each project focuses on a different skill area, and the overall program helps them build their behavioral workplace skills. And they do that through engaging with stakeholders in presentations, collaborating, and communicating. Now, I've crammed a lot into this slide, and it's because we've done a lot. In the last 6.5 years, we have partnered with over 125 companies, including major brands like IKEA, HSBC, Westpac, Qantas, Greenpeace, and many more. We have completed nearly 200 projects across Australia and the United States, and our customer feedback is exceptional with over 4.6 stars on Trustpilot, which is market leading for an education program. We've delivered projects in design, cybersecurity, product management, and digital marketing. And this is just the beginning. So we're now halfway to our mission. The B2C side of our business is growing at 40% year-on-year revenue growth with a 65% gross margin across 2 countries. The next stage of what we're calling our growth flywheel is the expansion of this real project framework into the talent pipeline solution side of things to help companies access talent in these high growth areas. Now, we've already seen this happen organically in some of the projects that we've delivered. We've had companies reach out to us and say, wow, that individual really was incredible. Can I hire them? So we know that there's a need, and we just need to productize it. So hands up, how many of you have hired someone and within a few months have found out that they may not have been the right fit for the role? Hiring managers often make these decisions off a limited set of job interviews, which are not really the best method to determine if someone is the right fit for your business and for your team. Our model changes this with a try before you hire approach, ensuring new talent can be chosen based on a distinct set of experiential data points throughout the journey. And the idea is to produce highly vetted talent who are productive from day one. We call this talent as a service, a model that leverages all of our learnings from our real project courses and provides companies a turnkey capital solution. Candidates work on projects within the company's context, they receive training, and we collect data points all the way through the project learning to give hiring managers that confidence in the hire. Now, did the candidate communicate well? Did they take opportunities for leadership? Did they show adaptability and resilience? These are the types of things we can identify. Now, this approach also ensures a smoother onboarding process for the candidate, as they can determine if the company is the right culture fit for them as well. Our employability report, which basically underpins how employers identify talent, was developed with input from some of the world's leading hiring managers, which is also our main core network. This includes heads of departments from all the major tech firms, including Google, Amazon, Tesla, Atlasia, and more. We've developed these relationships over 6 years, and it allows us access to a really high set of current industry data and what is happening in those employment teams. As part of this capital raise, we're going to be bringing some machine learning to the data set that we've developed to generate more confidence and insights into the hiring process. One of the largest demand areas that we're hearing from our mentors and our partners is in cybersecurity. So earlier this year, we launched a real project experience framework in cybersecurity. And we are now the only company in the world with a fully project-based cybersecurity course. That is, students work on cyber projects from day one to graduation with different companies. The addressable cybersecurity talent market across the US and Australia is measured around 5.6 billion, with an serviceable obtainable market close to 1.7. Now, this is just one of the skill areas that we're targeting. Our intention is to cover a lot of the major high-growth digital skill areas as AI begins to disrupt our workforce at an accelerated rate. Now, Harness Projects operates in a unique space between boot camps, universities, and talent provision services. Unlike boot camps that focus solely on training, we integrate real-world projects into our curriculum, allowing participants to develop their skills and in a hands-on environment. Unlike internship platforms or placement providers, we offer clear visibility on candidates' performance within a company's business context. This makes us a really logical solution, especially for companies who don't have the resources to invest in an internship program and maintain an internship program. In 2025, we're focused on 5 key strategic initiatives. One is our talent as a service product, and we aim to bring on 5 cybersecurity programs in different companies that perform a talent pipeline for them. We're developing a B2B2C tech platform, which is integrating both of our models together to give candidates access to employment through the employers that we have, and for hiring managers to determine which candidates are the best fit for their role. We're also continuing our investment in our employability scorecard, and we will be undergoing the accreditation process for each of our real project courses to access government fee help for our students in Australia. Now, finally, we're also collaborating with the Digital Health Cooperative Research Centre and Sydney Uni to co-design a data science real project framework. This last one is a really good example of some of the organic links out that we're seeing due to the interest of our model from government and universities. Now, our team has a proven track record of tackling tough challenges. Over the past 6 years, we have built a world-first educational model, scaled it across Australia and the United States. We've taken market share from highly funded competitors, and we've all done this as a bootstrap. Early in 2022, we did raise a very small family and friends round as we brought on our board of advisors. And we've been fortunate to have the guidance of some incredible team members, including former MD of Seek Education, former MD of Spotify and Peloton Australia, and the former CTO of Auric Essentials Pty Ltd. So we're now seeking $2 million to fund our growth and realise our vision of bridging the gap between education and employment in the AI era. Key roles in investments include technology, sales, business development, and product. We've fully modeled our target goals based off known historical metrics for our B2C revenue line and made some well-educated assumptions for our B2B revenue line. Our experience bootstrapping this business has made us laser focused on the metrics that drive our growth. So if this is a mission that resonates with you, if you're interested in being at the forefront of education and employment, I'm looking forward to you. Thank you.
Thank you, Chris. Up next is GlobalMedics.AI. Please join me in acknowledging its co-founder and CEO, Samir Sinha.
Good afternoon. Anyone here who has survived the pandemic, you would probably know the importance of reimagining healthcare. My name is Samir, and we started GlobalMedics.AI virtual hospital in the worst crisis, the worst days for humanity. And then we realized that researchers in the US have figured out that a doctor spends only 26% of his time actually doing clinical work for patients. And when you take that at a global level, the size of the opportunity is worth trillions of dollars. Sorry, the size of problem or opportunity, whichever way you look at it. So we've imagined, we are pioneering the concept of wide AI, which will enable each doctor to see 100 times more patients, deliver 10x better health outcomes at 1/10 the admin effort. Sounds too magical, doesn't it? This is how the magic comes together. There is range of narrow AI today automating various steps in the care journey. We bring it all together. Let me explain with a couple of examples. One of our customers is a GP clinic serving populations that have a high proportion of migrants. The patients and the doctors do not speak the same language. So these patients now enter their symptoms into our AI on the phone, and the AI investigates those symptoms with the same follow-up questions which a qualified clinician would ask. When the patient uploads any image of their symptom, AI promptly analyzes it. Like this seemingly innocuous wart on the ear is actually cancerous, and the AI has detected that abnormality and is suggesting a biopsy. All these insights are then summarized into a very short and succinct briefing summary for the doctor. And that has resulted in the doctors doing a 20-minute consultation in less than 8. And remember, these are multilingual consultations. So imagine the enhancement, the prevention of communication gaps that could lead to clinical errors. The experience of this consultation, from what we have seen, has been phenomenal. Cardion Hospital is a super specialty cardiac surgery hospital in India. They have a problem of manually written, handwritten patient clinical records. When doctors do their rounds and provide advice to the patient, that gets lost in the next day. And because this is a private new hospital, they are under pressure to have a competitive advantage. So they want to showcase a unique patient experience where they remotely monitor the rehabilitation of a patient using AI tools. So when handwritten notes are uploaded into our system, the AI not just digitizes it, but interprets it and copies and pastes the relevant data into the electronic health record system of the hospital. And this is how AI prepares each doctor before the consultation. It takes the inputs from the chatbot, from the image analysis, and just summarizes it in short bullet points. Next, it can read through 500 pages of the patient's history and retrieve those 2 important details that are relevant to the current complaints. And that's not all. It can read through evidence-based research literature to pick up what is the latest literature that is relevant to the current complaints. Puts it all together into a succinct suggestion for the doctor, a checklist of what they need to do when the patient walks in. But when the patient walks in, magic starts happening. The AI can understand 140 languages of the world. It listens to the conversation between the doctor and the patient, transcribes it in that language, and then takes the content and generates a beautiful, succinct clinical note. So the doctor doesn't have to be taking notes. The doctor just focuses on the patient. And when these notes are done, all that the doctor needs to do is tell the AI to prepare all the documentation. Any referral letter, any medical certificate, all the documentation is then written by AI, ready for the doctor to just have a look at it and approve. The platform also brings together multidisciplinary care providers and also brings together friends and family in a very patient-centered mode of care. So basically, that drives 2 social networks in terms of user adoption, bringing in virality into the solution design. We are selling to B2B hospitals, clinics, aged care centers, who bring in their patients, and each patient brings with them their friends and family and their other providers. And that's how we build social networking within the solution design. Our growth is structured around 3 phases. The first is product market fit in India, Australia, and Oman, and we have leadership teams in each of these 3 countries. Next is doubling down on the selected markets to establish ourselves before we launch a B2C version, which is AI-led care for the masses. Because we have this unique advantage, the strategic advantage of being able to serve multiple needs of our customers with one integrated suite, it provides our customers an easy to implement solution, but what it provides us is depth and breadth in data. That goes towards fine-tuning our AI for the specific purposes, thereby reducing the cost of delivery and enhancing access. It all started during the COVID, like I said earlier, when 130 doctors came together to remotely support 1,350 patients on our platform. These doctors today co-create the solutions and test the functionality that we built. The project was featured in Financial Review. Researchers from Australian National University have authored and published technical papers on it, and Microsoft have nominated 4 senior solution architects who guide us to build the most sophisticated AI healthcare platform in the world. It's that vision of reimagining care that has brought together very senior executives from diverse skill sets to join the mission. So we're raising a pre-seed of $900K, followed by a seed of $2 to $3 million, which would be used for product development, sales and marketing, and running pilots, medical operations. So if this is something that interests you, please scan this QR code. It will take you to a link where you can try out some of our products. You can play with our AI, and it'll also have details of our investment brief. We invite you to join us in using AI to reimagine how healthcare is delivered. Thank you.
Thank you, Samir, for presenting that promising opportunity. Now, please join me in welcoming Henry Okoye, Director at Lithtech Industries.
Good afternoon, all. I'll try and match Samir's energy and enthusiasm there, but I'll probably fail. My name is Henry Okoye. I'm the General Manager and Director at Lithtech Industries, and we're an early stage water and mineral processing technology company. Through some of the not so important disclaimers. And so why Lithtech? Now in 2022, according to the United Nations, approximately 700 million people globally were living with no access to basic fresh water. Now, as we stand here today, that number is closer to 1 billion people globally. Now, as you can see from the graph or the map next to it, that number will increase to almost 2 billion people by the year 2050. And if what the World Economic Forum and the World Resource Institute say is to be believed, by 2050, approximately 30% of the global GDP will be affected by this acute water stress. That is $70 trillion of the world's GDP. Now, what does this mean? This means that global desalination technologies will continue to evolve and the demand for them will only continue to rise. Currently, today, the market for that stands at around $20 billion, and it is forecast to reach over $30 billion before the end of the decade. And as you can see, I was actually surprised to find out Australia is actually one of the countries that will be affected by that acute water stress by 2050. And so what Lithtech has is a novel solution for high-growth industries, from water to critical and battery minerals like lithium, nickel, cobalt, and lead. Now the problem is, as I'm sure we all know here, there is this unending demand for those battery metals as we move towards the energy transition. Today, that market stands at over $300 billion, and it's expected to double to over $600 billion before the end of the decade. Now, the problem is there's limited resources, both freshwater, lithium, nickel, copper, cobalt, you name it, they're all in high demand, and no nation on its own can meet the requirements for the energy transition. And even those nations that are blessed with those resources simply cannot meet that demand on their own, especially with the current political instability around the world. Now, Lithtech's solution is a patented processing technology that's able to be employed in both existing and new operations to increase the yield and availability of these highly in-demand resources. And so Lithtech, as I said, the technology is patented. It's been independently verified and validated by the University of Queensland's Dow Center. It is targeting high-growth industries, and so we believe that we are here to make a significant difference long-term. We have sustainability at our core. Our technology takes any aqueous or water streams, and we're able to not just liberate clean hydrogen as a product, we also give you green cement in magnesium hydroxide, which can be used to sequester carbon. The company is founder-funded, so our founders have put their money where their mouth is. Today, they've invested over $500,000 to get us to the point where we're at. And we also have a very experienced board with a clear pathway to an exit via ASX listed. Unless, of course, we receive a takeover offer that we cannot refuse before that. We also have existing commercial interest, which we can discuss because it still has tonight, so we can discuss it in the end. Like I said, we have sustainability at our core, so our technology has multiple ESG advantages, from being able to help assist the prevalent problem of huge mining tailings. Today, I think as it stands today, there's about 217 trillion liters of mining tailings around the world globally. And sitting in those mining tailings are key minerals that we need for the energy transition, such as lithium, nickel, cobalt, copper, and rare earths. We also sequester carbon, as I said, because a byproduct of our process is magnesium hydroxide, which can be used as a green cement. We are able to produce cheap and clean water while leaving zero harmful substances in the environment. We also preserve resources. So as of today, the traditional methods, say, for example, of processing lithium, leaves about 40 to 50% of the lithium as a waste product. Now, the analysis that we've done and the testing we've done to date show that we can get that number up to about 90 to 95%. And so we're able to preserve resources. We have best-in-class partners. ANSTO, the Australian Nuclear Science and Technology Organization, are one of our research partners. I've mentioned the University of Queensland's Dow Centre have endorsed our technology from both a technical and an economic standpoint. Our chief technologists and where we do all the work is run by Agile Technology in Lismore in New South Wales. We have Forecast, who are a global leader with clients like Fortescue and Wesfarmers, and they do all our financial forecast modeling, making sure that we know where we're going into the future. We also have corporate advisory run by Keops Group, and so both general and specific corporate advisory is covered. And so we are well aware of where our technology is going into the future. So I'll just quickly skip over this not so interesting slide on technical. So what the technology itself is a process technology that selectively separates magnesium ions from aqueous water solutions. Now, why is this important? Magnesium is very ubiquitous. And so in the processing of both water and those critical minerals like lithium and nickel and cobalt, magnesium is always a contaminant. And so our technology is able to selectively take that magnesium out, and not just take it out, but we also give it to you as a useful byproduct. The process uses what is called an electrodialysis cell, comprising of 3 chambers, and in essence, it's a magic box where you put in your feed water stream into it, and we selectively take out the magnesium from the water, while also giving you clean hydrogen as a byproduct. Now, why this is important is because conventional processes in industry today use harmful chemical reagents that usually need to be trucked in over large distances, such as soda ash or limestone and stuff like that. And they are very toxic to the environment. And ESG, as we all know here, is at the forefront of any push towards the energy transition. Like I said, there's multiple use cases for our technology, whether in water and wastewater treatment and desalination, or in the production of green steel, as our process gives you hydrogen as a clean byproduct. There's more use cases that I couldn't touch on today given the limited time, but please know there's multiple use cases for the technology, from lithium to nickel to copper to cobalt, rare earth processing, and of course the big one is in desalination. Now, as I said earlier, the University of Queensland's Dow Chemical Centre has independently validated and verified our technology. They conducted a techno-economic analysis and found that for a typical lithium brine process, our technology was able to preserve the lithium by over 95%. Now, in industry today, that number is around 50% in the best operating processes. We also recover 90% of the magnesium as magnesium hydroxide, which is a green cement. And if what they say is to be believed, for a typical 35 kilotons an annum lithium carbonate plant, our technology can generate a net present value of over 300 million USD with an internal rate of return of over 20%. Now, those aren't my words, but their conclusion was that our process demonstrates a compelling case for continued development. So this is some of the independent testing we've done recently. We showed that we're able to liberate the magnesium hydroxide without any lithium precipitation. We showed that the process was able to operate continuously for over 40 hours with 98% Faradaic efficiency for the hydrogen gas capture. So very, very clean hydrogen. Next round of testing, which we aim to do with some of your help here today, we'll be looking to optimize the process for efficiency in terms of the amount of hydrogen we're able to collect, as well as the amount of magnesium hydroxide we're able to liberate. Now, Lithtech is founded on expertise. Our chairman, who's here today, has advised multiple ASX-listed companies. He was involved in Citadel Mining. I don't know how many of you here know about them, but I believe they were, at the time of their takeover, they were $1 billion company from a $7 million company. David Vincent, who is also a chemical engineer like me, has over 20 years in the industry and is actually a pioneer in the biochemicals industry space here in Australia. I think he was involved in the launching and operating of the very first biochemical plant in the Asia Pacific. Adam Blunt, who is our Chief Technical Officer, has been involved in the commercialization of numerous processing technologies to date. And so he runs all the testing that we do of our operations. I myself am the general manager as well as a director. I'm a chemical engineer as well by background, and I've worked in multiple lithium projects in the past, including for Standard Lithium. Angus Keneally is our BDM, who couldn't be here with us today. He's worked for companies like Alibaba and Qatar Airways, helping them increase their business revenue. And so I think, just to finish off, we're conducting a seed round of $500,000 at 2 cents. So it's a pretty modest valuation. And we aim to use these funds to get us to pilot plant readiness, after which we aim to be deploying technology in field late next year. I think that is it. And if you do have any questions, please come see us at our table. Thank you very much for your time today.
Thank you, Henry. And now let's gear up for our next panel, who will unpack the critical elements that accelerate growth, from securing early-stage funding to scaling operations and navigating the challenges that come with rapid expansion. Please join me in welcoming our expert panel, Phoebe Teo, Director at The Art of Capital. Please come to the stage. Kenneth Shaw, Partner at Shaw Investments. Sam Riley, CEO at Rova. Rob Neely, founder at Securely Group, and Peter Neal, founder at PowerPow.
Hello, everyone. This is Phoebe. I run a small fund and a corporate advisory firm, and we specialize in cross-border transactions. And today, I'm very happy to be with you and moderating the session. Should we start with Ken to do a self-introduction?
Sure thing. Ken Shaw. I spent 15 years in the United States, did 2 SaaS companies back-to-back, a B2C and then a B2B. So we've sort of gone through the startup journey twice, sold 2 companies, one for a pretty miserable outcome and one for an okay one. Returned to Australia recently, worked at Potential Capital, which is, in the previous panel, they were talking about, software PE firms. So Potential Capital is a $1 billion fund, just buys software companies. I'm now investing independently and advising startups. I met Steve a couple of months back, and happy to be here.
G'day everyone, Rob Neely from Securely. Securely is a fintech and paytech innovation provider for banks and financial institutions worldwide. Our claim to fame with this startup is we've got a patented technology that allows banks to certify social media profiles and then provide their customers with a digital wallet that's attached to the social media profile that then solves the issue of marketplace purchases on marketplace. That's what we do now. How many startups have I done? A lot. I'm 64. My most recent one prior to this was an animal health startup, completely different to fintech. And we did a NASDAQ exit on that. We sold to a NASDAQ company in 2017. So it's not my first rodeo, put it that way.
G'day, Sam Riley, was CEO and founder of Ansarada, a company that built software for due diligence used in M&A, capital raising, large procurement of infrastructure type uses. Grew that from $30,000 in startup capital from the founders to we just exited off the ASX for around 250 million, and recently founded a company called Drover, which is about helping companies transition to better business models and more sustainable ways of operating. That was actually products that were part of Ansarada. We're doing 40,000 M&A deals. We noticed the level of compliance and risk and governance inside companies was usually substandard, and when they went to do an exit, it got found out in due diligence and eroded a lot of value for them. So years ago, we wanted to help companies run their businesses better so they can do what they do best with their products and services, but not have significant gaps on the way that they're operating with risk and compliance. So so carve those businesses out of Ansarada and put them in a startup called Drover.
Hi everyone, my name's Pete. I'm the founding CEO of PowerPal. PowerPal is a home energy monitoring and energy efficiency platform with 250,000 users across Australia. We were acquired by an energy retailer called Amber Electric in, what was that, end of 22. And I stepped down as CEO of that business earlier this year, now advising a range of startups on go-to-market strategy.
Thank you. Well, Kent, I think that everyone's very interested to understand what are the biggest challenges from startup to scale to global companies. So could you tell us a little bit about what are the common challenges that you face? And perhaps I could help everyone here.
Yeah, sure. Just getting a feel for the room. Raise your hand if you're an entrepreneur here. Hi, investor or advisor? So pro? Okay, about half. Look, I think one of the challenges I see in Aussie startups is just thinking too small, right? Not thinking global from day one. There are certain industries that, you know, you've got to, that are niche to Australia and whatnot. But if you're not chasing a global play, I'd really sort of look in the mirror hard and ask yourself, why not? You know, and maybe pivot. I think that's sort of one big observation I have about the Australian startup scene, having been in the US for so long. And coupled with that is only looking in Australia for capital, right? And so I think like there's systemic and structural weakness in the local capital ecosystem for startups. And I think, again, thinking global when it comes to your fundraising would be another big sort of bit of advice I have. Be very interested to hear what you gentlemen think on that.
That's a good question. Having worked both in the Australian startup ecosystem and also the US, they are so dynamically different. It's like black and white. The VCs, all of the fundraising over there is completely different. And going to your point about pivoting, I call it sliding doors. You've got to, as an entrepreneur, you've got to recognize a sliding door and grab it. And you've got to go grab it with all your gusto that you can, because it may lead you down a completely different path that provides you international access. And I've seen it happen on many occasions. One of my previous businesses, we had 35 startups that we were mentoring. We had a piece of each of them, and this is in the US. And again, anyone that shows any interest over there, and they're all over you in the US, non-stop at networking events, and the ecosystem is completely different. So, look to the US and don't, hold your blindfold on for Australia, because Australia is just very, very small.
Yeah, I tend to agree. Like if you found a company in Australia and you're just building something here, you inevitably end up building a culture that heavily suits the Australian market and everything around that. And then if you then, say 3 or 5 years later, start to think about overseas, you might find that some of the things you've made really strong here don't work overseas. And then you'll you'll have to change and manage those changes. Whereas from day one, you can probably have more of an international view and make decisions and shape the culture that way. And yeah, I find the investors in the US probably the number one thing they have intrinsically is a lot more risk appetite, a lot more forgiveness for failure, but they do want you to learn from it very quickly. But it's probably something we could get better at here.
Yeah, I can share some experience from business that I worked at for 13 years. I had got a background in telecommunications, and we did it the opposite way. So we became market leaders in Australia and then exported technology into Asia, starting in Singapore. So we were building solutions for mobile carriers, and we signed up Optus and Telstra and Vodafone, and they were all having a good time. And we thought, well, yeah, we've kind of done it here, right? Where's next? And selling into Asia was a completely different culture. The way you had to sell, the way you engaged, well, it was a hell of a lot of fun doing it. Yeah, sort of working out how these large organizations buy and how to match your solutions to them. Yeah, we ended up with, 60 different telco solutions across Asia Pac. So I wouldn't discourage people from trying hard in Australia first. If you do a good job, you can take that case study anywhere you like.
Thank you. Well, Rod, I'm very interested in your NASDAQ exit. Could you maybe let us know a little bit more about what are the financial milestones or indicators should investors look for when assessing a fintech startup potential for high value exit?
Fintech startups, I'll go back to your point. It's all about scale. Can you scale it? So the metric might not necessarily be the financial metric you're looking at first. If it's scalable outside of Australia in a fintech sense, the world is your oyster. Quite literally. I mean, we spent a week in India about a month ago, and we're now dealing with, it's just incomprehensible sometimes, but we've got 2 discussions going on over there at the moment, and one bank has 400 million customers. Okay, so, and you look at the whole of Australia with 25 million. In fact, one bank does 25 million KYCs a month. Right? So, you know, it's a different sphere. So it's not necessarily the financial metric. I know it doesn't answer your question, but I'd be looking at scale again.
Well, I mean, I'd jump in there and be like, if you're building a tech product today and it's an English language product, again, I would really challenge you to say, why is it not global, right? Like, and I'd argue with you hard. Like, if you're going to tell me, no, it's only an Australian thing, I'd be like, eh. I mean, like take Wise as an example. Wise is a neobank that is global, like, and they're, like, how is NAB and ANZ and CBA going to compete with someone like Wise? The world's changing. AI is accelerating that change. Yeah, so like global from day one, both for product and for funding.
Do you have anything that you want to add?
I think, look, the world's a big place, so you have to diagnose where are you going to win and where are you strongest. And, the foundation and biggest mistake I've ever made is prematurely scaling products before you've got really strong product market fit. And I think entrepreneurs can fall prey to that because you've got a lot of strengths around vision and strategy and you see the problem, but maybe you see the problem earlier than the market does, and you can spend a lot of time with a good idea that's the wrong timing and burn through a lot of money. So product market fit, validation of that in different markets, and being able to scale profitably. Like your customer acquisition costs have to be scalable or at least on the path to scalability. Otherwise, going overseas will just make you go broke quicker.
Well, Sam, you were actually started from a self-funded venture, right? Could you maybe let us know and share your experience with the audience here today? How did you manage to go from self-fund to where it is today and manage to get an exit?
Yeah, I think the whole tech and startup world and investor world's quite, as any industry matures, it gets culture and processes. So, you have angel and then C, A, B, C, D, whatever. We just got together because we saw a problem and we literally just put money in and no one left their day job. And it was what I think the cool kids today call it a side hustle, where I used to work making ice creams and I'd do 2 day shifts, 2 night shifts for 12 hours. Then I had 4 days off. And in my 4 days off, I would go see potential customers who could use our product and just diagnose what problems they have, what would solving them look like for them, and then we would design some software, build it, show it to them, get their feedback, and they'd say, oh, look, I don't always want that feature on. Can it be able to be on and off? And say, okay, we'll make it, discretionary control, whatever. And eventually that built trust with them, because, you can meet someone and you listen to them and do what they say, they end up trusting you. And then a few of them ran an M&A deal on our product, and that gave us credibility and trust. And I'd say not having capital creates constraints, and those constraints forced us to be very, very focused. And then that meant like sort of co-creating your products with your customers. They were sort of the outsourced design team. So, what helped us, I wouldn't even say it was a deliberate strategy, we just had to. And then we picked off the top 3 customers who the rest of the market would respect and follow if they liked us. And then, because we diagnosed quickly, our industry was based on a lot of trust and it's very risk adverse. So we're like, how can we build trust? How can we build trust? And then we would just self-fund it from there until we needed some capital to expand overseas.
But that got you that got you product market fit.
Yes.
By working so close. So you said a lot of smart things already, like don't spend money, like international expansion or just marketing in general until you've got product market fit. Raising too much money can actually be really evil, which is what happened in my first company. And co-creating a product with customers, the very best way to fund your company and hold on to equity is fund it with customer money.
Yeah. And the best is if you're in a meeting or online and they show one of their colleagues and they're like, yeah, I built that feature, and you're like, yeah, okay. But at least they feel like they owned it and it was their idea, and they feel like it's their product. Yeah, no, good point.
Yeah, it's interesting. So, talking to startups that have got very promising technology, they've got demonstration units in market, they've got a lot of people that are sort of flocking around that technology, but they haven't got a sale. And it's like, well, if you've got all that traction, you've gone to the trouble of making a prototype, you've got ready for market, you've got all these people expressing interest, just ask for the sale, right? It's not that hard. And yes, you might not have the product fully finished yet. It might not have all the bells and whistles on. But if you can make that sale and then, as you say, co-develop the product with them into what's going to be to win the market, that is by far the most powerful way to move forward.
Just to check with you guys, but I find to get product market fit, the best way is day one to try sell something. And they might laugh at you, like, would you buy this? And it's like, they might laugh at you and say, well, no, you don't have 6 things that I need. And it's like, okay, what are they? And then you do those 6 and go back and say, would you buy it now? It's like, well, no, it's too big, it's too small, it's yellow. But like you have to sell it.
Product market fit. Like what really pisses me off is all these young entrepreneurs who are like, oh, I've got this many downloads, this much engagement, this much word of mouth, like all this crap. Product market fit. There's somebody's opening their wallet. You don't have market fit. There's got to be economic exchange, right? And that is then when you get interesting metrics like what's your CAC? If you can't tell me how much it's going to cost to acquire a new customer and scale that channel, why would I invest? Why would anybody invest? And so just like for the entrepreneurs in the room, product market fit means somebody's got to give you money, right? Not download, use, refer, like on Facebook. I mean, that's nice, but it's not PMF.
And I think in the past 2 years has been very difficult for everyone to raise capital as well in the macro situation at the moment. Well, because Rob, I think you may have to leave. Are you good? Okay. Yeah. So I think that it will be good for you guys to share some of your experience, because since you guys have done so many startups and then have successful exit as well in the past, during a bad market, what would be the best way to go out and raise capital, but still being able to maintain the business, keep it running?
Okay. Well, I mean, my rule of thumb became double. So whatever amount of money I thought I needed to raise, double it, and however much time I thought it was going to take, double it. I did 14 rounds of capital over 15 years, about $40 million across all those, across every type there is, venture, what would now be called seed, but for us it was Series A. So So seed, A, B, C, then growth equity, venture debt, and finally sold to private equity. But double. Raise twice as much, takes twice as long. And if the market sucks, like now, don't raise. But the inverse rule is always be raising. But like runway is everything once you get like hooked on the cocaine of venture capital, and that's the right metaphor. It's dicey stuff.
Is it pink cocaine or is this normal cocaine?
Having never used that product, but people don't understand the risk inherent in taking venture. It's not talked about much in the market. I don't.
Yeah, absolutely, and it's all consuming when you're raising. I watched my American CEO. We did a flip. The last company we did a flip from Australia to the US in Kansas, of all places, but that's the animal health capital of the world. And I watched my American CEO. It consumed him non-stop.
Full-time job.
Yeah,
full-time job.
So, and he was a doctor, he was a vet, and it took his view away from what he should have been doing, looking at the potential commerciality of the products we were representing over there. But going back to raise or not raise, and how it can change your view, take your eye off what you're doing as an entrepreneur or a founder. This time round, we decided on purpose to use our own family money through the family office to build the company. Then we decided to do a raise, and then we pulled the raise because it was taking our eye off what we were doing. And we also had some very large companies starting to talk to us, and the valuation changed, obviously. So you've got to be able to pivot quite quickly. That's one of the rules.
Well, I think like VCs bury their debt very quietly, and like there's a lot of horror stories out there around raising capital or the wrong structure for capital. Like if you're very certain of your metrics and you've got strong PMF and you're growing month on month, maybe you can get venture debt or convertible notes or some debt-based equity, but that's very risky if you get debt-based equity because if things go wrong for you as a company, those investors are not as concerned as helping you get out of it as they are at just getting back their capital. Whereas if you've got an equity-based investor, you're all in the tent together and you have to work through problems a lot more diligently, usually. I think the type of capital matters a lot, and it depends on what stage your business is at. And again, entrepreneurs are prone to overusing their strengths in this area where they devalue risk and future scenarios that come back and be highly dilutive. So I think another consideration is some investors are really good at being hands-on and they've got practical experience in your industry or in your geography you're trying to expand in. They have networks. They can roll up their sleeves and actually help you execute, and they become an extension of your team. Now, depending on the company, that may be very valuable to you more than money. But the other thing I'd say, I'd read this quote once, and before I took capital, I said that can't be true, but I'll just test it with the panelists. They say once you raise capital as a CEO, 30 to 40% of your time will be spent on capital raising activities, including investor relations and things. Is that true?
Yes. Half of in my second company, which we went to the Series A, B, C, went the whole way through, I reckon 50% of my time was what you loosely call IR, but it was just dealing with the BS of a cap table, right? And it gets more complicated when you layer in different types of investors. So if you got, early stage VC, later stage VC, growth equity, private equity, they've all got different expectations, they've all got different demands. Nightmare. What you're doing now is how I would do another one if I ever did it. Self-fund and family office, and I actually think with sort of what AI is doing to costs, that is the most achievable now that it's ever been before.
Yeah.
To get a product to market, to achieve PMF, is now far more attainable with a small check.
Just as how it gets worse as you get bigger, I was at a risk conference, and they're all chief risk officers, and Matt Coleman, the CEO of CommBank, was there, and he said, "Oh, I'm a CRO too," and they go, "You're not the chief risk officer, you're the CEO of CommBank," and he's like, "No, I'm the chief repeating officer." Because he goes 80% of his week, he's just repeating messages to the team, repeating them to regulators, repeating them to investors. He spends 20% of his time on strategy or anything else. He's the chief repeating officer. Like and that happens in a small way. As soon as you take capital, it just gets me.
Thank you. Well, I think that we can probably jump into AI questions as well, because in my opinion, AI could really help us to cut down the time of operating as well. Well, Ken, do you, from your background, because everyone here we run a technology company, is there any way that you think could really help you to balance the time of raising capital at the same time trying to run a business at the same time?
I don't know about raising capital. That's a very man-on-man sport. Man on woman. I mean, I'm not trying to be gender biased here.
Person to person.
Person to person.
I'll help
Thank
you through.
Okay. Very American over here, right? Yeah. So no, I mean, I don't think AI is going to play there. But in terms of running your business, I mean, fundamentally, right? Like every single department. I was listening to a podcast the other day where McKinsey, I mean, big company and meant to be smart, but they had an average response time to inbound inquiry of like 48 hours, and using AI, they've cut it down to 30 minutes. And that's the sort of thing that everybody should be doing. But every single process inside a company, like my second company got up to 200 employees. I reckon if I was running it now, I'd be running it with like 40, like no joke, And so, yeah, jumping on the AI bandwagon hard. If I was CEOing right now, I would only be hiring like process engineers, automation guys, DevOps people, Yeah, that's where I'd be focused. Yeah, sure. But I mean, like I'd be forcing the creatives to learn Zapier and Make and, and some basic coding. And I think the most important hires going forward are going to be jack of all trades, like baby COOs, which is what an entrepreneur and a founder and a builder is. Like you've got to be across every function. You're usually T-shaped. You get skills across every domain and deep in one. Yeah.
It's an interesting topic. I spoke in India a few weeks ago on AI, on this specific topic. And there's some 67,000 or 70,000 AI startups in the world right now.
99% of which will die.
Correct. And therein lies the problem. So we were talking AI and KYC and so forth. But the problem is they're all good actors at the moment. The ones that are going to die, which you just talked about, are going to become potentially malicious actors in the AI scene. So they're going to go to the dark side. So if you're not in AI at the moment, your company should be, or your startup should be. You should be utilising it as much as you can, as Steve has done just over the last 6 months or so. But that's the biggest problem. AI can be used for good and for bad.
And exponentially, AI can, like every technology is like that. When we first made fire, it can cook your food and keep you warm, or it can burn your village down. But the AI is the same. It scales exponentially both ways. You asked a good question on email and on AI, and I was just thinking about bringing AI to market for your customers, and it made me realise that you have to bring AI that your customers are ready for. Not like, let's say in the future, AI in your industry for your customers could do predictive analytics and predictive decision making and real-time scenario analysis, etc. However, if they're not ready for that and they're more in looking at AI as an efficiency tool or an automation tool for a few key functions, and maybe they're not even ready for that until you can prove that the privacy and security of them using your AI stays in their confines. They're not going to engage with this one if their mindset and maturity around AI is lower. So you have to design and bring AI to market in line with your customer's mindset and maturity, or maybe just be the next step ahead. But if your marketing is really glossy and you think it's awesome, but it scares your customers to death, they're not going to engage with your AI initiatives, in my opinion.
So that's I agree 1,000%. That's where I think the number one place for AI is in-house. It's internal. It's doing with one human what you would previously have done with 10. I'm working with a client right now who wanted to do that, right? They wanted to add AI to all their public-facing products and services. Their customers don't want to borrow it, right? Way too avant-garde and privacy issues up the wazoo. And so my advice to them in the pivot has then been, right, we're just going to radically change every internal department, and who knows what sort of like cost savings we'll get. But it's going to be real and it's going to cost jobs.
Can I just go back to you asked a question before about who was entrepreneurs in the audience. I was at a US university not long ago, and they have a course for entrepreneurship. And when I started as an entrepreneur, there was no courses. There were no courses, and there still should be no courses.
Yeah.
And when I challenged the dean, and she's a lovely lady, I said, "Come on, what is this entrepreneur course you're running?" I mean, because it's
innate. Who's teaching it?
It's innate. It's inside of you. Okay, it's not something you can teach. If you could teach it, everyone would be buying it, wouldn't they? But in the end, she came around and said, "Well, Rob, it's really a sexy name for a business course, and we can sell a lot more courses if we call it the entrepreneur course." And that's the difference. An entrepreneur is someone that gets to the Friday of each week and does not have the money for payroll on Monday. That's what an entrepreneur is, rather than just starting a business.
But it's a mindset, I think, is what you're saying, rather than it's not really something that can be taught. Yeah, I mean, I think you can learn skills along the way, but I probably agree with that. I think it's baked in.
Well, Pete, did you want to add on the AI talk? Because your business is empowered, right? So it helps people to look into saving energy.
Yeah, it's really interesting. So our product was a digital product. It's delivered as a mobile app. And we built in all sorts of advisory components into the app, and we have product-led growth strategies to drive people into those feedback loops that help them to understand and help them to choose the next round of product. And people engaged with it. They loved it. They gave us great feedback, but they didn't buy. We had to hire a sales team to pick up the phone and talk to these people and work them through, person to person, on what their drivers were and convince them that what they'd learned through the app was actually the next step that they wanted to take. So I think AI's got its place, but I'd agree it's more of a back-end tool. At the end of the day, businesses sell to people, and people like to talk to people, and I don't think that's ever going to change.
I agree, because relationship is something that you can never replace. That's my understanding for everything. Well,
and closing a deal is like, that's an immutable skill set. If you're good at closing, life's going to be okay. Yeah.
Well, we don't have much time left, but if you're going to sum up one sentence, each of you, for business to go from startup to scalability, what would you advise to everyone here, whoever that is running a business right now? Okay,
And 5 seconds.
As much as you want, okay?
Buckle in, it's a long, wild ride.
The most important thing at any startup and any journey is get the right people around you. Don't take anyone's check. We handed 2 checks back recently because they weren't a good investor fit as we got to know them better.
Yeah, probably like if you get better, your customers will demand you get bigger. So an obsession around the customer and their problems and how can you help them more, how can you help them faster, what other problems do they have? Like the more you know that, that's the foundation for everything else. You can scale that with the brand or other things.
Yeah, I've got a favorite saying, which is it's nihito. Nothing interesting happens in the office. You got to get out there. You got to talk to customers. You got to be in front of people, and you're pumping that learning cycle as fast as you can. And once you get to product market fit, growth is inevitable.
Okay, thank you, guys.
Thank you.
Thank you so much to our panelists for that incredible and truly engaging panel session. And now let's resume the company presentations. Please join me now in welcoming Simon Pothecary, CEO at frontierpet.
Hello, everyone. I'm Simon Pothecary. I'm the CEO of frontierpet, and I'm going to tell you a story about pet food. So Frontier Pets, we're here today. We're trying to raise $7 million this year. So we've already raised 5, so we've got $2 million remaining in our growth raise. And that puts us in a $24 million valuation. Now we've got a cornerstone investment from a company called Atlasia Capital. So they've already invested. Initial close of 3.3 million, and the balance due in the second half of this year. So this funding is to enable us to continue to expand our growth channels through further export markets, additionally premium retail, and going from there. And also to enable us to continue to build systems and our processes within the business. We're forecasting to grow revenue to nearly $39 million, with an EBITDA of about 11.6 by 2008. And we've got a number of opportunities for growth, particularly through Southeast Asia. And so the reason why we exist is we're pet food with a purpose. So it's a freeze-dried product, and it's using free-range proteins. So rather than intensively reared animals, the Frontier Pets is made with free range. So it's better food for you, better food for our planet, and better food for our pets. And so we're the highest quality raw food and the largest freeze-dried manufacturer of pet food in Australia. And so we take 100% free-range proteins and organic vegetables. So these are premium, high-quality ingredients, all Australian-made, and turn those into a freeze-dried, biologically appropriate raw pet food. So this is stable, shelf-ready, comes in bags, so you can just feed your pet raw food without any of the hassle. The recipes are all developed by vets, and they're biologically appropriate. And you can feed the product either wet or dry. I've got a range of samples next door, so you can come and see some freeze-dried food and some freeze-dried treats. So we're vertically integrated manufacturing, so we own our own manufacturing facilities. We own the freeze dryers that make the product. We're currently located in Brisbane, and we've got 3 state-of-the-art freeze dryers. For each of these dryers is about the size of a small container, like a 20-foot container. And we load in about a ton of raw meat, and then you get out around 350 kilos of dry product. So what the freeze drying process does is remove the moisture. So you end up with a shelf-stable dry product. What's really fueling the growth of the business is really some of these mega tailwinds behind this growth. So the growth of pets has been phenomenal around the world. COVID was a huge driver of this, and that growth has continued. Particularly in Australia, around 70% of households have a pet. And these pets are treated really well. You may remember when we grew up, then the dog might have been left in the yard, fed on scraps. That's not the case anymore. These dogs are really, really well looked after. They're dressed in premium clothes, premium leads, and they are really, really pampered. And a significant part of that is their nutrition. Yes, if you really want to look after your dog as well as you can, you have to feed it properly. And then Frontier Pets is a straightforward way of giving it the most extraordinary pet food in Australia. And people increasingly looking after their pets as children. Is that better? You hear me now? Yeah, so that growth in pets and pet food has really driven Frontier. So Australia has the highest number of pets in the world. Some 70% of households have a pet. So that's over 5 million dogs, and then 63% of consumers are looking to keep looking after their pets even in these difficult economic times. So often we see it similar to baby food. That's sort of infant nutrition. So looking after your pet is really, really important even when times are harder. And the market is enormous. So some $5 billion in Australia, and we're growing at over 4% annually. So it's a significant market with significant growth potential. In terms of retail channels in Australia, then most pet food is sold through supermarkets currently, with premium pet food retailers being behind, and then online channels. So these also represent significant opportunities to grow for Frontier Pets. So we're currently a direct-to-consumer business, so that's enabled us to really focus on knowing who our consumers are, because we have their data, we know where they live, and we know how often they buy their products. So we spend a lot of time researching our consumers to really know who they are. There's 4 main groups who are buying premium pet foods, and we focus on 2 of them. So suburban loyalists, that's what we're calling them. So these are people who tend to be sort of between 35 and 55. They're in secure relationships, living in large houses with large disposable incomes. And these make up the most loyal part of our customer base. And they spend on average $180 on their pet food orders every month. The second key channel is aspirational urbanites. So these are younger people, tend to be 35 or so, living in apartments in major cities. And again, these people tend to be pre-children. So rather than, the kids haven't left home yet. So these are pets that are being looked after as well as a first child. So again, high incomes, people who are used to looking after themselves very well, and they go on to look after their pets very well as well. Slightly smaller in terms of average spends, but still, very loyal customer base who really look after their cats and dogs. So we have a whole range of cat food, dog food, and treats. We've got a range of new products being developed as well. So not only pet food, we've got a whole range of boosters just coming to market. We've just upgraded our packaging, and we've done a whole new range of marketing materials to really maximize our opportunity. At the moment, we focus predominantly on Australian sales. So export is a significant growth opportunity for us. We've become the #1 brand in Korea for freeze-dried pet food, and we've recently expanded our operations into Singapore. We've just made a delivery to Japan, and also just started in Singapore, and we'll be exhibiting in Hong Kong in February. Our proteins are split between pork, beef, and chicken currently, pretty much evenly. Beef is our biggest seller. And then also, at the moment, we're about 95% pork. So we just launched cat food in the last 18 months. So sort of developing that cat food market remains a significant opportunity. We've got a very, very loyal customer base who spend, over time, have continued to grow their loyalty and their spends. So our average customer value is around $165, and that continues to grow year on year. And as we get someone, we keep someone. Keep moving it here. So we recently transitioned our manufacturing to Brisbane. So we had a small site in Evans Head, and we've now completed our move to Brisbane. So we're in situ manufacturing in our new facility. We've got 3 freeze dryers in that facility, and we've got room for 10 in this. So the manufacturing capability to grow the business is in place. We're growing into retail. So we've recently listed in Harris Farms. We've sold successfully in Harris Farm over the last year. They've just expanded the range. And we're also in the process of expanding our distribution into some of the major pet food retailers in Australia, as well as forging these overseas markets. So the export represents a significant growth opportunity for Frontier Pets. We've consistently grown revenue over time. So we did over $7 million last year, and we're on track as of today to hit our budget for this year of $11.8 million. So ongoing revenue growth, and we've been EBITDA profitable for the last 3 months. So we think we can genuinely grow our business into $11.8 million of sales this year, through a mixture of export and retail opportunities in Australia, but potentially to grow even faster. And on the upside, how we see the business growing over time, it's getting up to around $56 million of sales over the next 4 years. And we can do all of that in the facility we currently have in Brisbane. There's room to grow there. Pet food industry is very exciting. There's been lots of growth potential in the industry. and some of the multiples being paid for businesses are significant. So there's a clear exit strategy of being able to potentially a trade sale, but great multiples for pet food businesses compared to normal food businesses. Got a strong team in place. So I've been running the business now for 2.5 years. We have a manufacturing expertise with a long time in the business, manufacturing at JBS, and an experienced commercial and marketing team. We've got an experienced board of directors. A couple of them are lurking in the audience today, if anybody wants to talk to them. And but also focused on growth and very focused on keeping the business with this growth mindset. We've also got a strong advisory board where we'll be able to pull on for manufacturing advice, finance advice, and particularly around e-commerce advice over the last year. So Goldman Sachs, Poolworks, Alta, a really strong team on the advisory board as well. The use of the money we're raising is so of the 7, we've raised 5 already. So we're looking to secure chunks towards the next $2 million, the final $2 million. So we want some working capital reserves so we can go and buy some more freeze dryers, improve our marketing technology, and then look to also scale up our automation in the manufacturing facilities to generate more and more efficiencies and cost of goods reductions. Yeah, it's just put a little bit at a time. In summary, so it's a growth-focused business. We have a strong brand with Australian success to date and lots of potential to grow into Asia in a proven manufacturing facility with the existing management team in place, ready to go. Thank you very much.
Thank you, Simon. And then the last company to cap off our company presentations is InSquare Fit. Please join me in welcoming its founder and CEO, Matt Graham.
Hi guys, I'm just working out the technology. Now, hopefully my voice is loud enough, so I'll go through a presentation with you. Thank you for coming today. It means a lot that you're spending your time and listening to people such as all the startups here today. It's a journey and we appreciate your time, and thank you, CapitalHQ. Now, I'm the founder and CEO of InSquare. So it's a little square and it's got endless possibilities, and I'm going to go through those possibilities, not just possibilities in health and fitness, but also possibilities as an investment. What is InSquare? It's a world first, revolutionary, painted 1 square meter platform that for the first time measures functional body weight movements, resistance strength movements, balance movements, and isometric movements for all ages, all abilities, and all markets. There is nothing like this in the market. So, big problem, guys. Remember we used to run around as kids, we were active, kicking the ball? Well, it doesn't happen anymore. Alarming statistic, 80% of adolescents don't meet the World Health Organization standards for activity. That's going to cause big problems later on. Currently, 31% of adults don't. So what does that mean? It means a lot of the adults are inactive. 1.8 billion inactive adults at risk of diseases from inactivity. It also means 2.5 billion adults are overweight, and nearly 1 billion of those adults are obese. This and the leading cause of death globally by more than double is cardiovascular disease. Now that's alarming. And there is one antidote for that, and it's actually movement. And we're on a mission. We're on a mission to make movement medicine through enjoyable, sustainable, and accountable exercise. So how do we do that? We've got to overcome some technology problems in the industry. There's a lack of innovation in the industry. For 150 years, every cardio product that's been ever made, if you think about it in a gym, you go and use a cardio product, or at home, it's based on a single movement. If you're going to get a product for home that you want to train on, you're going to get a bike, and that's what you're going to do for the rest of your life, bike. Or a treadmill, you're going to just run. Or a rowing machine, you're just going to row. And the last innovation in a gym for connected cardio equipment was actually 15 years ago. There's a lack of innovation, and this was evident when we just showed at the Oz Sports Fitness Expo. We're being interviewed by magazines because it is actually new innovation in this space. So we're going to bring innovation through the platform where you can do millions of routines, not only in cardio format, so you can go from running on the spot into push-ups, into burpees, into slam balls, into skipping, and into then resistance strength by pulling resistance bands, all on a square platform that not only gives you the metrics of how many you did and how the tempo of what you did it on it, but also tells you how hard you did it. So there's a big difference between squatting like this, massive difference in power and effort. And we track that effort. That effort can translate into really smart data. So whether it be body weight, balance, isometrics, resistance, we measure it all. Now, I said all ages and all abilities, I mean it. And this is really important because there's nothing really, no piece of exercise equipment that addresses every ability. We can, just at the Sports Fitness Expo just recently, I had a guy roll up on his wheelchair, and he rolled his wheelchair onto our device and then started training resistance movements. Whether you're in a Zimmer frame, whether you're elderly and you need a balance bar, we can attach those to the machine, or whether you're an elite athlete, there's a position for you. I can take an elite athlete through 55 seconds of burpees with a 5 seconds rest, followed by 55 seconds of squat jumps with a 5 seconds rest, followed by 55 seconds of bicep curls with 5 seconds rest, followed by 55 seconds of running on the spot, and literally drop him in 5 to 7 minutes. Or your grandmother can use it. She can just simply do some squats, put a chair on it, sit down and sit up the chair. And we can measure, not only do we measure their weight every day, we measure their mobility and we measure the amount of effort they're putting into it, which gives us some really fantastic data. But we're all markets as well. Gyms, PTs, aged care, whatever it is, we have a place in those markets, not just because of the multimodality that we have and what we can measure, but because of its space and size. It's 1 square meter, it's very low profile. So tests, think about the data that we're going to get. So we can do strength cardio balance tests. We can do gamifications. We can have 4 of these on the floor and a screen, and people can compete against each other in a gamified format. We can do competitions. You can do competitions against people remotely or inside a gym. Classes, we can have this whole wall full of data, well, your own little piece of data on a wall, and this whole area full of 1 square meter platforms, everyone training, much like Pilates, but with the data, strength and cardio training. Remote training, we can deliver these remotely and put people through exercises, opening it up to 80% of the world that don't go to gyms. Why don't they go to gyms? Because it's intimidating. So we can basically bring the gym to them and all those and deliver the routines remotely and have that data come back to the PT or the gym and monitor them, congratulate or motivate. Preemptive data. All of a sudden, if your friend or your mother or your father's using the device and all of a sudden he's lost 5 kilos in weight and is 20% in strength, that might be a trigger to send some preemptive call to you as a sibling or a carer to say there could be something wrong. We've been getting some incredible data. We're working with CSIRO and some deep machine learning algorithms. So there's a lot going on in that area. Now the markets, 47 billion connected equipment market, 198 billion weight loss market, and the aged care market's huge at 872 billion. Now that's just 3 of those markets. I haven't even mentioned the domestic home markets and the defence markets and NDIS markets and so forth. So there's lots of opportunity for us. But interesting thing, McKinsey just interviewed 5,000 people and their number 1 priority, 80% of them said wellness was the number 1 priority. There's an issue, guys. We are, because of our diets and screen time, we're getting unhealthier. So it needs to be addressed. Now, traction-wise, we've been granted a 20-year patent in Australia. We've got 2 international patents pending. Signed agreement with one of the second world's biggest sports retail distributor, PTP Fit. They're also an investor. We've just gone through the Industry Growth Program grant. We're now applying for match funding. Their advisor, who does hundreds of grants, said we are the most prepared business that he's seen in regards to giving that grant. We've got a French B2B distribution. We've also got global gym a global gym chain goes a letter of intent, and also we've raised $1.1 million to date, and 98% of our respondents said they would use our product in the gym because it's a new method of training and it's using your body weight and resistive strength. Oh, now, to make this happen, I've got to go back. How do I go back? That's it. To make this happen, my job as a CEO is to surround myself by good people. I don't want to be the smartest man in the room. Cornerstone investor, Merrick Howes, we couldn't ask for a better cornerstone investor. Merrick was the head of Anchorage Capital Markets, $32 billion US fund. He started up Goldman Sachs in Australia. He also started up Macquarie Bank Asia Pacific, but he sits on the board of Athletics Australia, sat on the board of Rowing Australia for 10 years and is a world-class athlete. He's seen our product and he can understand the value and the impact it can have in this area that's been lacking innovation for a long time. So we're very happy to have him on board. But we've also got an amazing team behind us. Lee's the CEO of ASX-listed lithium sulfur battery manufacturing company. He's got a doctorate in artificial intelligence. We've got Darren, who's here today. He ran a $100 million scale business, largest in the Southern Hemisphere. He ran that for 15 years as CEO, so he understands manufacturing and scales. Matt Ward, he was headed up Shelton IP, arguably Australia's best patent attorney. Also, a lot of these guys are also investors. Alexandra Sloan, she's a head marketing officer at Optus, ex-Meta marketing director. Kathy, CEO of WeatherFX. Now, WeatherFX make Avatar, Iron Man, make billion-dollar movies, and she's also on our board. And Roger, CEO of World Gym, and a fitness expert in the industry. And Nicholas, who is a data expert, does all the data back end for Reserve Bank, Microsoft, IBM, etc. So we've got an amazing team that supports us, and that's really important because we've got a lot of opportunity. Now, talk about competitive value. Green is good in this slide. You look at Hydro. Hydro, the first one, they've raised $350 million for an innovation which was just a water rowing machine with a screen. $350 million. Tonal, a strength product which sits on the wall, innovation for strength. They've raised $500 million. And you talk about going global, going big, the people before us, and that's exactly what we're going to do. We're going to go to the US markets because there is massive opportunity for us. Vitruvian is an Australian one. It's a strength-based product. There's nothing there that competes with us in modalities and the markets that we can serve. So we're in our seed round at the moment. We're raising $1.7 million. We've raised 38% of that, $650,000, a pre-money valuation of $7.5 million, min investment $50,000. But we're also an ESIC. And if you don't understand the values of the early stage innovation company, that means that there's a significant 20% tax rebate on your investment. And also you have no capital gains from years 1 to 10 if you sell your investment. So not many people understand it. I think if you don't, it's very, very valuable as an investor. We meet that criteria on a 100 points based test on both tests. So use of funds, we've got obviously sales, we've got sales, administrative, also software development, and then sales and marketing, where we're aiming to do a reward-based crowdfund campaign in the US and the Australian markets. We've researched those markets, and some of our competitors have done those, and they've raised $2 million on products with far less capability than ours. But we also, along the way, we have R&D grants coming in, some pre-sales and some crowdfunding, the income from crowdfunding. Our timeline, we're really going, as you can see at the end of the timeline, we're really going to hit the US and AU markets and UK markets. That's where our opportunities are. They're massive markets, and there's a lot of uptake for things, a lot of money going to this space in those markets. So if you liked what you hear, we've actually got a prototype here. We've made 4 prototypes, and there's one prototype here, which I know some of you have already been on and had a look at, and you'll be amazed about what we can measure and where we're going. So thank you very much for your time. Take time to take an image of that if you need to contact me, and sweat smarter. That's what we're all about. So thank you very much for your time.
Thank you so much. And now our next speaker is someone who stands at the forefront of AI innovation. Today, he'll be sharing insights into how the next wave of AI breakthroughs can unlock immense potential for businesses and what it takes to stay ahead in this dynamic landscape. Please join me in welcoming Yash Varma, founder and general partner at Empress Capital.
I want you to listen to this for a quick second.
Invest in the future of the AI wave, where dreams turn to gold and the bold get paid. In a heart attack, we're pushing past the brink. Algorithms humming through everything we think. This ain't just a game, it's a revolution.
I'm waiting for the chorus, and then
That's the solution. Invest in AI, watch your profits fly. Digital dreams catching that gleam in your eye.
all right, I won't put you through the whole song, but that song was actually for this conference, and I wanted to start off with that. I did say to Steve, was it okay to have a song about the conference? That was generated from literally one prompt saying, I'm going to be presenting at Wholesale Investor this week. This is what I'm going to talk about. Help me out with this song and make it catchy. So, but look, my name's Yash Varma, founder and general partner at Empress Capital. Empress Capital is a venture capital firm that focuses on early stage AI companies. And look, we really believe in the power of investing in companies early, and we think there's a real shift going on. I've talked before with the wholesale investor community about this platform shift, probably about almost a year and a half, 2 years ago, about how this is going to change. And every time I see things, I'm more and more validated this is happening. And so today I really wanted to sort of give you a bit of a run through, not of our fun, but really about where we're going and what that could be. So I wanted to start off by really giving you a bit of a background why this is a once in a generation opportunity, not just to invest, but to start a company, and why it's such an exciting time to be where we are. I want to talk about three key breakthroughs in AI for 2025. And I really recommend that, whether you're a founder, you're running a business, you're an employee in a business, if you're not looking at some of these things, you really are missing out. And I know Steve talked a bit about this at the beginning. I'd love to give you a few examples of what that looks like. And then last, I just wanted to really talk to you about how you can capitalize on this. And whether it be, once again, running a business, I'm just talking about investing, but also about how you can capitalize from your mindset to what you should be doing, and some of the things that I also talk about. And so let's kick off. I'll be quick on this because I'm sure many of you know this is a massive opportunity in terms of AI. We believe this is once in a generation. Our research prior to launching the fund was that this area would grow at over 40% a year. That's what we're starting to see. Not only that, AI is now outperforming humans on so many fronts, if not almost every front. And so what that means for most businesses, it creates opportunity to be more effective in what they're doing, or more efficient, or I would say actually augment what you're doing. And you really need to be looking at that. We have a large number of language models that are like bunnies, they're multiplying. And each week there's new models outperforming each other. And what that means is it's creating more opportunities in different niches. And I'll cover a little bit of that today in terms of what that might mean and some of the applications of how, what you're able to do now that you previously couldn't. The other thing is more funding. If you look at what's happening in the US, almost 35% of funding went to AI companies. And if you take out the Mag 7 from the S&P 500, you probably have very little or negative returns. And so we believe this is going to continue for a while. And also the fact that really a lot of earlier, smaller companies we think will start to do some really great things. Last but not least, I had to throw in my Chewbacca, baby Chewbacca. Generative AI is also a big thing. And what we're seeing, some people believe it's a lot of hype, but we believe it's going to drive out hyper growth for companies. And so the evolution of what's happening in this space, not just for generating images or songs, as you heard, there's many more applications to this, and I'll cover a few examples of that. So let's kick off with those sort of three key breakthroughs for 2025 and what we see. And I sort of canvassed our team about what do they think. I just made it up as well, but and I used some AI in this, so just to be clear. And that is a key point I would love to say is being able to use these tools really allow you to generate. And so I don't know if any of you have used something like Google's Notebook LM. That is the best product that Google has on the market right now. So if you've never used this or heard of this, it'll create a podcast of any content. If you uploaded your deck, for example, as a founder, it'll create a working podcast of yours. And it's pretty great, but just for researching and doing things. I'll cover off some of our portfolio companies which we're using as well. But look, the first thing I want to touch on is the rise of vertical AI. And by that I mean we're really focusing on particular niches. So when we're looking at companies, we're looking at what can you do that other people aren't doing and what's that sort of focus. And this is going to be a really big area of growth. And we think this is going to be the next big evolution of sort of enterprise software. And so if we look at what that sort of vertical SaaS is, not with AI, that's a $300 billion market. And the research that we have shows that that was going to grow by up to 10x. So we're talking about $3 trillion market opportunity and what that's going to do. So with that in mind, early companies getting involved. So if it's your business and you're involved in something, so I've seen a few, companies today. This is a great time to be building companies. It's a great time to be investing in these companies. And so we think moving early in this space will be a really great opportunity. I wanted to give just a couple of examples of these niche vertical AI companies. One is a local company. I want to give some perspective. Funnily enough, a company that we've invested in called Merry Technologies. Now, Merry Technologies is a legal AI company. They take what used to take weeks and maybe even months of data. So I think many of you probably watched some legal shows on Netflix. People come in with a whole box full of evidence. They dump it on the table and they spend, every night sifting through those boxes of evidence to come up with what you call a chronology or a timeline of events. And so what Meritech does is they take all of that data and within minutes, sometimes even maybe a bit longer, but take what would have taken weeks and turn that into a chronology which is relevant for that case. Now, this is a very high value task that creates a really great opportunity for lawyers and paralegals. And a little example, I guess, of that. Same thing in the medical space. We saw Samir talking earlier on about how they're looking to automate with agents, and I'm going to touch on that as well. But there's also a US company. The low-hanging fruit for doctors is transcribing what's happening during a medical appointment. There's a lot of time spent post-consultation, and so they've Bridge have a really great tool that really makes that process automated, does a great job in terms of being able to help doctors spend time on treating patients. Little examples, there are plenty more examples I could give, but we'd be here all day. So second thing I want to cover off is really around AI agents. And we're really moving into the phase of going from taking these large language models and taking the output to taking action. And so in a lot of ways, AI agents are our little helpers. They're like little programs that can go and execute, some value to a business. And so what we're starting to see is this agentic approach to developing businesses. And I'd essentially say, this key idea of moving from output to action is really starting to happen. And next year, you're going to see many, things that are happening in this space. And it's around this term of agentic workflows. And so I'd really love you to think in your business, whatever you're doing, what is that? And so the way this works is you'll be able to have agents that can observe, look and see what's going on, look at what options are there, and execute on certain decisions off the back of that. It's very human-like, decision-making in terms of taking options with technology. And so it really will streamline the way we can develop certain types of businesses. Far more productive than what we're seeing with traditional software and language models. A couple of case studies, another Sydney-based company, agency, a very early stage company. In fact, they're raising money now. I don't know if Tim's here today, but focusing on helping small businesses use AI. How can they have agents that help them write in the tone of their company? How can they help them triage emails? How can they be personal assistants? So they have a vision of helping smaller companies. And then we have Relevance AI, who have a lot of different agents that help people around sales, help them around marketing, help them around support. And so we're starting to see voice make a big play, but equally in that support space. So many of you will have businesses where you support people, funnily enough,
we're going to move very rapidly from just chatbots to being able to have voice agents and really add value like we've never seen before. I wanted to see if I could quickly show something which Steve mentioned this morning. If I can just show you here, this is actually our only non-US, non-Australian investment. The investment is a company called Anthropic. Many of you may have heard of them. Just want to show you what this computer use is about, and think about this. I'll show a little bit of this because I don't think we'll have full time to watch all of it, but I do recommend you go and have a look at what computer use is for Anthropic. It's going to be quite busy.
So I'm Sam, and I'm one of the researchers here at Anthropic. Computer use is something that we felt was going to be important for a while now. And so today we're going to be talking about a very early version we have of computer use and walking through a representative example of the things we think it's going to be useful for. We're going to be going through a quick demo today. In this fictional demo, a customer, in this case the Ant Equipment Company, has come to us and asked us to fill out a vendor request form. The data I need to fill out this form is scattered in various places on my computer. What we're going to do is ask Claude to look at the spreadsheet, check if Ant Equipment is in there, and if not, move over to the CRM and try and find some more information there. Once it has this data, Claude's going to then fill out the form for us and hopefully transfer the information across to the vendor form. The first thing that's going to happen is Claude's going to start taking screenshots of my screen and quickly realizes that the Ant Equipment Company isn't actually in the spreadsheet. So the first thing it does is it swaps over to a CRM and searches for the company we're interested in.
I just want to pause that and I'd love you to go and have a look at that. But essentially what you're seeing there is a large language model looking at your computer, looking at your screen and taking some action. No one is telling the computer use to go and do this thing. You're just giving it a task. And so if we start to think what we can do and think about what we do within our businesses, this is going to have a big impact on where we go. And it's going to open it up to a really large number of people to develop. So I'd really encourage you to go and have a look at this, see how you could start to use this. Now, this will take some time, but unless you're thinking in this agentic way, it's going to be really hard to compete with people who are using this. And so once again, we believe there's businesses that are using this approach to really have step changes in the way that they operate. And I think Steve talked about having a 10-person billion-dollar company. I'd probably disagree. I think we're going to have one-person billion-dollar companies. There is that option. And if I had time today, I had some AI bedtime stories which you can come and talk to me about later, but I don't think I'm going to have time, which is exactly that sort of story. A great story. So look, the next thing I wanted to talk about was really around AI's leap forward into the way these models are working and thinking. And so there's a great book, Thinking Fast and Thinking Slow, or Thinking Slow and Thinking Fast, by a psychologist named Daniel Kahneman, I think his name is, and talks about two modes of thinking. And if we want to think about what we have previously, the first mode of thinking is thinking very quickly, reacting very, just instinctively to something, which is what they call System 1 thinking. With the release of the new OpenAI model, which is called the O1 model, what they discovered is it's moving more into this System 2 thinking, which is taking more time to think about things, reevaluating, looking at what decisions are made and adjusting, which is very similar to what we do as humans. And so often we'll do this System 1 thinking where we'll just go and do something quickly, we'll think about it, but then when something's difficult, what we do is we take a bit more time, we take more time in terms of evaluating it. And funnily enough, one of the sort of lead researchers at OpenAI discovered that when they gave the model 20 seconds more time, it actually had 100,000x on performance. And so we've thought these improvements are going to come through more compute, but what we're actually seeing is there are different modes of how they can use these models to get more efficiency. So if we add this with all the different changes, this is definitely going to be a big game changer. So I'd love you to think about what can I do with this kind of thought process as an assistant with me. And so this is, we're seeing some really interesting things. When you're trying to come up with an idea for something, I recommend you have a chat to either one of these, and you'll see some really interesting things that are coming out. Once again, Steve, you talked about you're using this within your businesses, and I would really encourage you. I'm using this throughout everything I do. So yes. So what can you do to capitalize? I'm going to be super quick now. We need to think about what the future organizations look like. And we believe investing in AI first companies is a real opportunity. So really thinking about how you can leverage that in your organization. The concept of experiments, really trying to bring these experiments, not everything will work, but having this approach is something we really encourage you to do. And then thinking about the thought process, what is it, what do you future leaders need to be thinking about? And so really going into this sort of mode of continual learning. If we don't adapt and evolve to try some of these experiments, it's a really important thing. So if I had more time, I'd cover off more of the mindset around the future leaders that we believe are there. So we also believe there's a big opportunity. You need to invest in AI. And that means whether you invest it in your business or as an investor, you invest in AI. And so, we look at that with 3 buckets: applications, tools, and infrastructure. And we believe that, look, this is hard. There's a lot of noise. I always hear people saying, how do you, there's so much out there. There's a lot of AI washing. What we're starting to see is now not just AI washing, but agent washing. So there's a lot of noise, and that's what we spend our time on, is really looking at that complexity, looking at the volatility of this, and really how we can help organizations. So we'd love to talk to you more if that's of interest to invest in that space. But I would say, when we think about investment, invest in your own businesses using these tools. And I think this is a really important part of what we're talking about. The other part I mentioned was really around community, and this is a community here. So another way to make sure you get involved in this space is to attend events like this. We also host various events. Would love, any one of you are welcome to come to many of our events. We have an event in Sydney on the 11th called Dazed and Diffused. We've been doing these for almost 2 years now. I think this is an important part of how we learn collaboratively. And this is a big part also of how we adopt AI. Everyone talking about how they're using it. We are at this very early stage. And this is deja vu for me. My first business that I built and sold was the early days of the internet. It was very much like this. So community is a big part of it. And the last thing is, we really encourage people to co-invest. So if investors that are interested, come and talk to us. We have some great opportunities. We love to share those. And come and talk to me later on about the 2 AI bedtime stories. I'm not going to be able to tell because I've run out of time unless I'm allowed to. But thank you so much. I want to just sort of finish. I always forget to tell people about the QR code. So all of this is, if you scan the QR code, all of this is available in there. I'd love to talk further to any of you today or outside of here. Thank you so much.
Thank you, Yash. Our next panel brings together financial experts who are transforming how businesses access capital. They'll explore cutting-edge funding alternatives that go beyond conventional lending, from revenue-based financing to hybrid instruments that can fuel both organic growth and strategic acquisitions. Please welcome to the stage our distinguished panelists: Vanessa Hayes, Portfolio Manager at State Street; Tim Davis, Principal of Private Credit and Strategy at Causeway Asset Management; Giles Carhan, CEO at Rocking Horse Group; Chris Flavel, Managing Director at Atlasia Capital Investments; and Stephanie Hamlin, Investment Manager at Partners for Growth.
Good afternoon, ladies and gentlemen. I know it is Monday and it is the last session. I'm glad you're still here, and certainly it is not a panel that you wanted to miss. My name is Vanessa Hayes. I am a portfolio manager at State Street. I mainly deal with institutional investor, manage the currency exposure and currency overlay. Innovation of debts is certainly not my area of expertise. However, I am seeing increasingly interest from my client in that, mainly from 3 reasons. The first is diversification. Second is a yield premium. Lastly, the lower volatility. So without further ado, our panelists, can you please introduce yourself and what your firm does, please?
I'll start. Giles Curran. I founded Rocking Horse Group about, exactly 10 years ago. We lend against the R&D tax refund. Quite simply, we bring forward to provide cash in advance of the R&D being paid by the government. Quite simply, basically year revolving facilities to help companies continue to spend while they wait for the government to pay the benefit.
My name's Christopher Flavelle. I'm Managing Director of Auric Capital Investments. That's my personal investment vehicle. I've lost far too much money on startups in the past, so in my education there, and now advise companies who are looking at growth companies and SMEs across the capital stack, right from deep through week.
Hi everyone, my name's Stephanie Hamlin. I'm an investment manager at Partners for Growth. At PFG, we are a global private credit fund and we provide custom debt financing solutions to high growth technology and life science companies globally. We've been doing that for over 20 years now, and in that time we financed 84 companies here locally in Australia. We've deployed over $900 million of capital in our local ecosystem. The types of companies that we work with are growing companies. They're typically investing ahead of their revenues and they're looking for alternative sources of capital. That might be in addition to an equity raise or maybe standalone debt. And so we come in and provide asset-backed facilities along with working capital facilities and just general growth financing facilities as well.
Tim Davis, Causeway Asset Management. We're an Australian-based private debt firm. We lend to companies in what we call the lower mid-market. So we're generally lending anywhere from $2 million up to $25 million. We're industry agnostic, but we are regionally focused, as in Australia and New Zealand. And we tend to be investing in companies that are going through a growth phase. We're not startup debt, we're not venture debt, but we're pre-bank debt. We're getting companies through their growth phase onto the next stage of their business whereby they will be looking for bank finance. So that's where we play.
Gary, thanks for the introduction. First and foremost, I want to say that private debt means so much more than just direct lending. I think our panelists will agree with me. We're seeing, I'm seeing conference actually spend hours actually just focus on music loyalty, right? So if you're a Taylor Swift fan where your daughter, your son is, you can be actually investing into music. So this is just one simple example. Obviously, there are a lot more different type of private debts. So maybe you'll start from you, Stephanie, if it's okay. Post-GFC, post-COVID, we're seeing different innovation. Based on experience, are you seeing any new trends? And in general, what kind of direction is going?
Yeah, great question. I think private credit as an asset class has evolved significantly since pre-GFC days to today. And, that was driven by a number of factors. A lot of the traditional banks really withdrew lending in certain asset classes and sectors post-GFC. And that then created this wave of what the media outlets are calling the golden age of private credit, where, there was this gap in the market, lots of other private asset providers came in and realized that it was such an underserved market and there was such an opportunity here, not only in Australia, but globally. And so what that's meant is that that has made, that meant that there was a lot of innovation in the space, and that has continuously evolved since the GFC to today, and it still continuously evolves. I think, Australia as a market compared to offshore markets is still relatively immature in comparison to the US and Europe. I read a stat in the AFR the other day that said, 10% of loans provided in Australia are actually from private credit providers and the other 90% are from traditional banks, whereas that is actually flipped on its head in offshore markets such as the US and Europe. And so what that means is that because there's been lots of new entrants, lots of new competition, it's actually been a great thing because it's created a lot of awareness in the sector. And it's also meant that there's been a lot of new innovative products that have come through in the last decade or two that are available for founders and companies to access. And that's at all different stages of the company life cycle. That starts at in the venture debt space, You've got lots of facilities around, revenue-based financing, convertible note structures, which are a hybrid between equity and debt, which are, quite complementary to early stage business models. And then you've got growth stage capital as well. And so there's lots of different structures within that growth stage bucket. Asset-backed lending is, becoming more and more popular in Australia and overseas. And within that, there's various structures within that bucket as well. And then, of course, you've got your more traditional lending as well, where a lot of private credit players are playing in real estate, for instance, in special situations type credit, where it's maybe a little bit more distressed, or more opportunistic style credit as well, where, there's companies that are providing acquisition financing, or more just opportunistic loans. So we're seeing a lot of growth in all stages in private credit, not just one product.
Yeah, I'm surprised to find out that only 10% actually is private debt. So still a lot of opportunity there to explore for sure. Let's pivot into different industry as well. We know there's not only tech, Giles, so we're chatting earlier, you're saying more agriculture, right? There's really different industry, and your firm focus on R&D. Can you please?
Look, I think there, as was just said, I think there's a lot of different areas that you can lend in, different assets that you can borrow against. So, for example, we do it against our asset is the R&D tax refund. So we need to be able to value that, and that's our asset. Now, why don't major banks do it? Well, fuzzily, they did do it through us. But it's not big enough. It wasn't at the time when we started 10 years ago. Now, estimations, 600-700 million is lent against the R&D tax refund. That's a significant amount, but still not big enough for banks and things to come in. So it really is left to the private credit, and it's in a very attractive market for investors. Personally, why the R&D for us is because it's great because it goes across all sectors. I mean, R&D is a very good program in Australia. It's in Australia, the UK, and Canada. Germany's just brought it in. The R&D program as a government program for the early stage sector is very positive, in my opinion. And it's bipartisan. It's been around for 25 years. No one's really mucked around with it too much. In the UK, they cut the rate that the R&D is paid by half. Rishi Sunak said, there's too much fraud in it, so we'll just cut it by half, rather than fix up the compliance. So Australia's been really at the good in the last sort of 5 years in, rather than cut the rate, fix up compliance, stop the fraud, which can get quite frustrating because you're dealing with the ATO, but they're at least trying to make a more robust platform for early stage companies to use. Through that, we've seen it's been quite interesting over 10 years. We've been able to see growth in certain industries. So when I started 10 years ago, there's a lot of cloud computing. Then there was a lot of drones for a few years. Then there was quite a lot of agri that was coming out. Now it's obviously AI, and a bit more AI. And SaaS, sorry, I should say. They come in a very distant second. But no, look, and it's the great thing for us is we can value that asset. And that's the problem with borrowing and lending, and is trying to value the asset you're lending against, but you have to have some sort of security. And so the banks have been, are very closed in what they will do. And so private credit is going to take a bigger role. The thing that for Australia, in my personal opinion, is we need to understand risk better. And we need to understand there is going to be risk in these things, but it doesn't mean you can't invest in them. You can invest in them, but you've got to price that risk. And if you can understand that, then you can lend against it, because debt is, in the end, should be for companies better than equity.
Yeah, and one good thing about R&D is to have short duration. I think we talk about average just 7 months, right, to a year. So as an investor, if you look for a short duration investment, that's maybe something, again, not my area of expertise. I'm not giving financial advice, but it's a good channel to distribute, to diversify your portfolio. Let's talk from an investor angle, I think that's probably you're interested. Chris, you have a very successful career, continue having very successful for your firm, Auric Capital. Based on your experience, where have you seen that the innovative debt solution help the startup you advise and invest grow?
Thanks, Vanessa. I think the important thing is to match whatever capital you're raising against where the firm's at on its growth cycle and what the cash flows are. So the exciting thing is just about all of the new solutions and fintech solutions that are out in the marketplace now. So banks used to provide sort of basically debtor finance for being able to finance your debtor, but most of the banks are out of lending anything under 3 million, which is why we have so many new credit managers in Causeway and others are coming into that area of the market. But the cost of that capital is actually quite high. And the reason why a company can afford to pay that is because they can't get funding from anywhere else, but it's a lot cheaper than equity funding. So the cost of debtor finance might be anywhere between, the nominal cost might be sort of 15 to 20%, but when you put in place, when you look at unused facility lines and other things, the all-up pricing that is usually in the order of 20% plus. So you need to make sure that the company can afford it, but it's a way of being able to have matched funding when you have large orders coming through or growth. And there are new products now coming out where you can just factor individual receivables. So there is a lot of new products in the market. So you can see debtor finance, R&D finance, grant finance, lots of these initiatives that are being fulfilled, tractor, living finance, as well as the venture debt. So I think this expansion actually opens up opportunities that can be used either for in the acquisition process for buying companies or just for straight growth. But it's a matter of looking at what's appropriate for where a company is at in its growth cycle. Probably the thing I'd add on that in terms of being able to state is if you look, for example, at the earlier stages, most of them are raising now in the current market. These things like safety is effectively a debt instrument where you're not pricing the equity at this stage, you're agreeing to price the equity, value the equity in the company at a stage in the future. So that's a way of bringing a debt instrument into the very earliest form of a startup company.
Thanks, Grace. Let's continue the path of a startup angle. And Tim, I'm going to turn to you. Simple question, private debts versus bank. Why? Because you specialize in corporate loan, right? Why investors should be looking, not investors, startup should be looking at corporate loans rather than a public bank traditional financing.
Yeah, thanks, Vanessa. So I think my fellow panelists have touched on the fact that there is a lot of innovative solutions in the private debt space, and you're going to see that more and more, the 10% versus 9%. And as my colleague said, in the US, it's the other way around. So you're going to see Australia get more and more into private debt. But that doesn't mean that the banks don't play a role. The banks still have a role to play in this market. And the thing that a bank can't do is look at a $3 million transaction and that fits outside of its box and say, oh, okay, no, I'll put all my credit team on this and actually do the work to understand the risk, the reward, how I get paid out. They have to have a box that they work through because they've got thousands of transactions that they go through a day. In the private credit space, we don't. We're very selective. So we can actually go in there, sit down with a $3 million lend and talk to the directors, have our senior investment team talk to them as well. So we're filling a gap in the market that the banks used to play in, but they can't anymore because they've got to fit within a certain box. Now, what we look to do is get a company from not fitting within that box to fitting within that box. That's usually our exit strategy. So we're coming in, we're looking at a company and we're saying, okay, in 3 to 5 years' time, doesn't necessarily have to be that, but generally, are you going to be able to refinance us to a larger NBFI or a major bank? And that's the risk that we're taking. So we're looking for those companies that are on that growth trajectory. Now, a great example is one that repaid us recently. It was a alternate milk processor. So they do like almond milk, soy milk, the like. And they came to us in 2021 and they were doing about $5 million in revenue. We wrote a loan for them. And in September of this year, so about a month ago, they refied us into CBA, having doubled their revenue and halving their interest rate. So that's a success story. That's where we as Causeway play. And that's what you're going to see more of as the private debt space grows. You're going to see more of these opportunities and these innovative solutions be able to actually get a hold of these opportunities.
Can I just add something as well? I think where it's going as well with AI and a lot of the data-driven stuff, if you look at insurance companies for years, they've got so much data and they've been analysing that data for so long. Private credit's going to get to the same. With the ability to actually analyse data and really refine it down into such minute sort of details and then be able to lend. And it gets back to my point before, is that understanding what your asset is and being able to analyse and, take huge data sets and then analyse those, and your private credit is going to go down the path of insurance companies and being able to take massive pieces of data. And because the world is becoming a much smaller place, there are so many comparisons you can take from all over the world into Australia, into any other country. And I think that's going to drive private credit and the growth in private credit hugely.
One more thing I would like to add as well is, another key differentiator is actually time to implement. So a lot of private credit funds, they are smaller, nimble teams, and they have less protocols, less checklists to tick and tie, and less people to talk to. And so that means that you can have a similar solution that's slightly more flexible for your capital requirements that is implemented quicker as well, generally speaking. So I think that's another key differentiator too.
Yeah, that's a great point, because actually my next question is for you. Again, simple question: equity versus private debts, right? From a again, non-investor startup angle, sometimes you do not want to dilute your equity early, and you may want to look into the equity may not be the best strategy for you, right? It's a grow-wise. What's your thought on that one?
Yeah, so there's quite a few differences actually. And I will just start by saying that you don't have to pick one or the other. Debt is actually quite complementary to raising equity as well, and you can have a solution that has both. And so, taking a step back, looking at debt versus equity, really key difference is time to implement and execute. So debt generally is a lot quicker from a due diligence perspective to complete, a lot quicker from a documentations perspective to complete as well. So that is a key driver. So if you're looking for debt for a bridging round, for instance, that may be quicker to implement than raising equity. My fellow panelists touched on that you don't actually, with some debt instruments, and most of, actually all of them, sorry, you don't actually have to have your company valued. So that is a key difference. Separately, one of the biggest differences is around dilution. So a lot of debt products are up to 80% less dilutive than raising equity. And for founders and for shareholders, that is a huge difference, and not only from a cost perspective, but also from a time perspective as well. So, that's really one of the most sensitive points, is around dilution savings. There are some debt products out there that are 100% less dilutive, but most in the venture debt space are up to 80% less dilutive. So for founders, that can be a great option. And then other key differences are around operational requirements. So some debt facilities don't require any board seats. Some may ask for observer seats, but I would say that's quite rare. And then separately, debt facilities do have reporting obligations and financial covenants, and will likely take some form of security over your company. So that is something to be mindful of. And, stating the obvious here, that debt providers do want to be repaid. And so, generally there are cash flows associated with those loans, whether it's interest, whether it's principal repayments, depending on the structure. A debt provider is looking to be repaid, and they generally don't want to convert to equity. So that is a key difference with the market as well. But, fast to implement, flexible structures, and actually not all of the capital needs to be committed and applied from day one either. Can be tracked. So back to that flexible.
Yeah, thanks for that. We talk about from a startup angle. Now let's pivot to investors angle. And I do, as a financial service professional, I always want to make sure the investor is protected. So what's your thought on that as an investor looking into private debts? How investors can protect themselves?
Yeah, so that's a good question, because naturally as private debt grows and you see more opportunity, there are going to be more people who enter the market. There's going to be more managers who enter the market. Sometimes that does attract bad players, and unfortunately that's the case in anything. So when you are looking to invest in any asset, but private debt, you want to make sure you do your due diligence on the manager. Do they have the experience? Are they true to label? When I say true to label, private debt is a broad spectrum. It's property, it could be corporate loans, it could be asset-backed security, the list goes on. The manager has a lot of opaqueness is the wrong term, but they have a lot of a power imbalance in terms of they can see what they invest in and the investor cannot. So you really need to make sure you do your due diligence on the manager and understand, are they being true to label? Are the investments they are making actually what they say they are making? And then the other key thing would be making sure that the management team has experience. You want to make sure that the team who is investing knows what to do when things go wrong, because that's really what finance investing is about, right? What happens when things go wrong? We can all invest in something and, if it returns 10, 20, 30, 40%, great. What happens when your capital's at risk? And do you have a management team who's actually experienced things that have gone south, and how have they managed their way through portfolios that have gone bad?
That's a great point. When the market's under stress, that's the reality check comes in. Now let's focus on the main core of this panel is about innovative solution, right? So I'll open to everyone here. What do you think is potentially we're going to be seeing in the future? And or let me say another way, they are innovative energy transition, sustainable development as well. Any area or development that can be captured. Anyone?
Yeah, if I can jump in, just one of the good things I think, and I'll quote a wholesale listed plan, NRN, which is National Renewable Network, just the ability to bring in a debt instrument that sits around, in this case, kind of solar panels and batteries as a financeable standalone element, just meant they didn't need, as they were growing, they didn't need to raise equity. Their debt was very much part of the solution. So it led to much faster growth, much acceleration of the transition stage for moving for energy transition. And sunshine hydro, there's several examples of kind of where you get to a stage where debt makes sense and becomes non-dilutive after you've exploited all of the grants. So it's a process of going through, and probably the other thing is just how technology, and I was just talking about AI insurance, but if the provider can tap into Xero or Mile and see what your future revenue is going to be, they can lend 6 months in advance, and revenue financing too. So all of these instruments, all of these solutions are now starting to become realistic.
Yeah, and I think just on that, I think there's also, it's going to be more defined in the asset. That you're going to be able to do more due diligence on the asset to be able to actually lend against a certain asset. So you're going to be able to have better understanding. Banks won't do it. Banks, as we were talking before, it's very much a box. Do you fit in? If you don't, you're out. Private lenders with this ability to analyze data sets is going to significantly change the way debt is provided. And then it will come down to price. You know, if you can value an asset, you can value your debt. Well, if it has to be riskier because that asset is riskier, well, margin have to be bigger, but you can still do it. And so I think that is going to be the biggest, in my mind, the biggest change, of being able to lend against things that at this point cannot. And it's going to be all data driven.
I'll just agree. I think everything tech related is going to be really fascinating over the next 5, 10, 20 years. You're going to see things come out that we wouldn't have thought of now. I mean, I saw the presentation just before us was AI. Even 5 years ago, I wouldn't have thought AI or ChatGPT was even possible. So yeah, watch this space.
We're just 3 minutes and a half from our network session. Before we end this session, if I may ask our panelists one last question that I don't think we have a cocktail out there, but if you were able to innovate a cocktail as an innovative solution, that solution, would it be? I'll give you a minute to think about it. I'll tell you my answer first. It's tequila soda. A, because it's simple. B, it's because it's easily accessible. C, and then most important, possibly just for me, it doesn't get me hungover. So, which means when you have fun, when you look into something, you're gonna think about the longer impact, right? The next day, the longer impact as an investor. That's what you want to focus on.
I'll give you one. Okay, Long Island, an old school one, Long Island iced tea. There's a lot of different elements that will go in to get the eventual result, which is exactly what I was talking about. More input, more data to get the eventual result. There you go.
It's opposite from simple, is it?
Yeah, that it will.
Mine would probably be the recovery from the hangover. So the Bloody Mary, kind of nice and spicy, and you know, and blood red, and just the same to match the eyes. The morning after.
I would say an espresso martini to supercharge your energy, which in my products is facilitating growth and helping companies along the journey.
I'll go the Manhattan. It's a classic cocktail, but you can actually make some adjustments to it and make it fresh and new and do some exciting things with it. So debt's been around forever, but let's see what else we can add to it.
Thank you. With that, we'll end our panel session here. Thank you very much. So thank you.
Okay, ladies and gentlemen, thank you so much. What a great panel session question to finish on. So just as a final thing, I hope that from the whole entire outline today, I started with the conversation that I think this whole space sets up the perfect foundations for growth, and then also high yield opportunities. And I think what's been so cool about today is you actually see that across the entire panel sessions. For me, this is probably one of the most, like, just so you know, the whole concept of this actual event come around 4 weeks ago, where I sort of pivoted from doing a demo day to being what we saw today, which is our direction. And do you know what? Today has been one of the most fun days. I've got so much value out of myself personally, and that's one of the best things about this is I can get some of the questions I have in my own head answered as part of the panel sessions. It's been great to have some of my friends involved as well with it as well, that sort of the other events sort of weren't quite relevant. But just a big thank you to all the panelists, a big thank you to you for coming along. Enjoy the networking. As mentioned, all the companies are in they've got their trade stands in that area. Make sure you go and have a chat with them. Make sure you just take that time, have a chat, learn about what they're doing, etc. So we've got some great businesses that we get the opportunity to work with. Like I thoroughly enjoyed the frontierpet panel session. Engine as well. So Orijin is quite interesting. InSquare, Matt's innovation as far as from the fitness area. There's said, I'm just going literally off the top of my head here. But said, we work with some great companies. We had some great panelists. Thank you again for all coming today. I hope it gave you either additions to your own investment thesis or created more questions for you to dive deep onto. Have a great afternoon.